Sector guy.
We certainly will. Some single stocks we need to be focusing on, but let's talk about the macro picture as we open this market up this Thursday morning. Here it is, the opening trade. We're expecting it to be fairly negative this morning. We are suffering from a hangover, an American hangover from yesterday's session. The 20-year auction, it's not even an equity market hangover, it's a bond market hangover, but it is causing headaches around the world, and we are starting to see equities rolling over a little bit here in Europe. We're down by 0.2–0.3%. Maybe we'll start to see a few more losses gathering momentum as we start to fully open these markets this morning. We're anticipating that we're going to be down, let's call it circa 0.5%. Not a big move, but that's kind of what we've got now on the screens. The CAC 40 and the DAX both open up around those kinds of levels. This as we price in the turbulence around what we saw on that bond market story yesterday in the United States, and we keep a firm eye on what is happening surrounding what is going on in Washington, D.C. right now as we watch the passage of the big beautiful bill or not through the House of Representatives. What are we seeing in terms of the sector story, Critty?
Absolutely. Let's start off with, I think, the biggest weight, and that is really just coming in light of the massive move we've seen in oil in the last, I want to say, 30 minutes or so, and this coming from the OPEC news and the OPEC headlines that they are weighing another hike just yet when it comes to the output. That's going to weigh on oil prices. You're already seeing Shell and BP become very quickly your biggest weights on the index when it comes to the FTSE 100. A similar story, though, that you are seeing in the Stock 600 as well, except that one maybe joined by a little bit of weakness in tech.
Yeah, it seems like energy is being sold off in various directions. So you see a weaker oil price, so BP and Shell go down, as you suggest. But then we also see renewable energy under pressure. So Vestas, Ørsted, both of those down by, more than 4% in both cases, more than 6% in the case of Vestas. And this is to do with bringing those tax credits to an end more quickly than had been anticipated over in the United States.
EasyJet's down 5.25% this morning, and in some ways it looks like the market is looking back, not forwards. There's been a miss in terms of the revenue line. That certainly is being felt this morning, and I think that is why you are seeing the stock go lower. Kenton was talking about a solid summer. There's one read you could take on the statement this morning, that it's a little on the vague side when it comes to that outlook, but he sounded fairly convinced. And it's interesting that the oil price story is not factoring into the thinking. So maybe you back that kind of positive news. I haven't seen Ryanair this morning. That positive news
down 0.4.
So this is an EasyJet specific story. So Ryanair is down despite the oil price as well. So it's not like the airline sector is getting a boost this morning and EasyJet suffering more. So I think you just need to factor those two stories into that narrative. But it does look as if the numbers are where the miss is, not the outlook from Kenton.
Absolutely. Can we? I'm just going to quickly put a spotlight on another stock that I've got my eye on, which is BBVA. It's one of your biggest volume movers to the downside. At least it was initially, and now it's facing a volatility interruption. I'm not seeing a reason for that, but it's one you want to keep an eye on, given that it has that exposure, one, to the United States, and two, to the emerging market story as well. Let's get a little bit more expertise on how to navigate these markets. I'm pleased to say Freddie Late, managing partner at Latitude Investment Management, joins us around the table. Freddie, lovely to see you this morning. We are trying to work out what the read-through is around the deficit concerns, not only in the States, but arguably if that creates a roadmap for the rest of the world into the equity picture. How responsive should the equity market be to the volatility in the bond market?
Yeah, it's never a good sign when we're talking about bond markets. I think it will. We believe it'll be a repeat of what we saw in the last sort of 6–12 months. Really, that there's weaker around the valuations because the U.S. market is still very, very expensive, and the primary driver that it feeds through initially is the valuation level. So very high PE, very high bond yield. You've got alternatives for capital. You've got a higher cost of capital. And then secondarily, it feeds through with higher interest costs, lower consumption, lower demand, lower capex, which is a much longer-term build. So It depends. These bond yields are moving quite rapidly, and I think it will spook the US market in particular. How much it impacts the underlying earnings and operating picture is the bigger question, and that really depends on how much it sustains. And then to the broader equity market, what we've seen so far this year has been very welcome, in our opinion. It's been a rotation. There hasn't been a reduction in equities particularly, but it has moved partially from the US into Japan and Europe and emerging markets and elsewhere. And even intra-US, the very expensive mega-cap stocks have sold off to a large degree, although they've rebounded now. And some of the other less appreciated businesses that are still very high quality have done well. So the more of that, the better and healthier the market could become.
Yeah.
The risk is it could cause some kind of liquidation event and more of a exit from equities full stop. But I don't think we're there yet.
There's this question of how much exposure do you want as an international investor to these dynamics you just laid out in the United States. And I'm curious if that's showing up when it comes to European companies or even British companies that have that exposure to the United States. Are you seeing a difference in the way they trade?
There's certainly been a little bit of people sort of diving through and saying, well, actually, I'd rather have more European exposed stocks, which is the first time in 10 years. Normally, it's just been, I don't know if you remember 15, 20 years ago, when every stock that over-indexed to the EM in the BRICS story traded at a premium. And you could see these scatter charts of everything, EM sales, PE premium. It's been like that with the US for the last 10 years, and I think that's reversing. So it's certainly coming a little bit. What we're seeing in terms of when we talk to the businesses is less capex, less hiring, not necessarily stopping forever or withdrawing from the US, but the incredibly high level of uncertainty with marginally positive news in their domestic markets, meaning they may just rethink some of that allocation. So it's a pause at the moment, rethink, potentially reallocate to other markets.
And are you reallocating a little bit more to Europe? I was looking at the stocks that you own, the top 10 holdings. I see quite a heavy representation of French construction, for example, in there. And we've got ourselves quite excited about the German fiscal plans, of course, in this part of the world. What is that based on?
So we've owned Vinci, which is in the top 10, and Eiffage for about 4 years. The stock's been doing brilliantly. The underlying earnings have been growing 10, 12% a year. It's really an infrastructure business now, more than construction, but it does both. And the stocks went sideways. So if you pull up the chart later, it didn't really move. And then this year, they're both up about 50%. So we've been there for a while. The performance has been delivering at an operating level. And these things are just starting, I would say, to get recognized by international investors. So we've been positioned like this for a number of years. And I think it's starting to see that broadening out, and it's to the benefit.
How high expectations and how much should our portfolios reflect up these expectations for better growth out of Germany then? Because we've got a conversation coming up later on with the Council of Advisors over in Germany, and they've taken their growth forecast for Germany for next year up to 1%. I mean, 1% on the back of all of that spending. Is that all? I mean, how much are you reflecting that in your portfolio?
So we haven't made any real changes this year, so all of the recent 5 months of news flow hasn't really impacted us making decisions and changing. So we're not standing behind huge European growth too much. And the one thing about defence spend is it's very low multiplier on GDP. You build loads of rockets, you put them in a warehouse, you hope you don't use them. It's not terribly constructive for long-term GDP growth. But I think that is one of the core problems that everyone has been talking about, the end of US exceptionalism and capital flight from the US into other regions. And I think those tourists are looking around at the moment and thinking, where can I put capital? But when they get there, it's not all that appealing. And, so I think we're in the very early stages of this discovery rather than a huge flood of capital coming to Europe or the UK.
So what I'm hearing a lot from investors is back off from the US a little bit, rest of the world. What does rest of the world mean at the moment?
Well, that's kind of it. I mean, it's, we've all got our own problems.
Yeah.
The situation in the UK is
the
not
market's told us
fantastic.
that. Yeah.
Exactly.
So where is the rest of the world? If I'm looking at the rest of the world, I've got the US over here, I've got the rest of the world over here. Where's the opportunity in the rest of the world? It doesn't sound like you're convinced that it's in Europe. You've got to be very stock specific. You may have to wait. Is it in EM? Where is it?
So I'm afraid, my answer is that it's very stock specific, and we are picking businesses. They happen to be in France.
But if you were looking, if you started with a blank piece of paper right now, would there be more in emerging markets? Would you be looking elsewhere?
Well, we have the ability to change anything anytime we want. So I still have more than half the portfolio in the US. So there's still a huge amount of value in US businesses. It's just outside of the Nifty 50 and the Mag 7 where all the attention and volatility is and most of the overvaluation is. But just below that, there's thousands of other businesses to consider and look at, and which we think are brilliant. So we just don't invest regionally per se, but I do think...
But sorry, carry on with the thought.
No, I was going to say, I do think that's where the limitation to this argument comes. Everyone says, oh, well, the US is too expensive. I say that too.
Yep.
And people need to go somewhere else. But when they look somewhere else, it's not that compelling. It's
Precisely.
probably lower trend growth than the US, and it's got its own problems.
But the valuations are, maybe that's what...
So a little bit of the valuation's closed, but it's not that attractive.
Is the dollar a headwind to investing in the United States right now? For dollar earners in Europe, and B, for dollar investors in Europe as well. How big a headwind could that be in terms of detracting from your returns?
So quite a lot of the European equity story in the past 10 years has been growing their sales in the US, and they're now going to get translated back at a 10% lower level. And so factoring that through the models takes away a fair bit from the European equities earnings growth story. So that's not going to be good. It's going to be felt in 6 or 12 months' time when hedges roll off. And in terms of investing in the US, it's always been this wonderful thing. You can buy great companies and clip an extra 3 to 5% on currency.
Yeah.
And so it was a lazy, unhedged, easy way to invest. And suddenly you've been reminded that currency risks matter, even in America. And so I think, again, it just causes that extra layer of volatility, or a higher required return from underlying international investors if they might have to suffer another 10% devaluation on the currency.
Yeah.
So all else equal, valuations should be lower again.
We spoke to a business that has benefited from the weakness in that dollar earlier on. We spoke to the EasyJet CEO.
Yeah.
And, of course, a lot of the things that you buy as an aviation boss are priced in dollars, and so if that's cheaper for you, then that's all to the good. But you own the sector, don't you? You own Ryanair, which, of course, has done pretty well versus EasyJet over recent past. I mean, how are you looking at that kind of sector right now, or that kind of investment?
So, yeah, we only bought Ryanair last year, actually, in July, and it's the one airline we buy. So to be really clear again, it's...
Because they come with an interesting reputation in terms of long-term value creation.
They do, but they've done very well over a large number of cycles, and I think it's their cost discipline, it's their newer fleet. They've already got the planes they need. Everyone else is desperate to get new ones. EasyJet CEO was on the show earlier saying he wants to retire his planes, but he can't. Yep. Whereas Ryanair's average plane is only 3 years old. So the sector in general, is doing quite well. Demand is reasonably solid across Europe, potentially seeing a little bit more international flow as well. And the supply of planes is tight because Boeing and Airbus have both, stalled their deliveries. So right now you've got a reasonably good intersection on the supply-demand. Fares are drifting up a little bit. Even Michael O'Leary talking about the ability to have slightly higher fares, rather, they've been flat for 20 years, fares in Ryanair. So I think a little bit of positivity in the sector. Lower oil prices will help, but most of them are hedged quite substantially for this year. I think Ryanair's hedged 80% for the whole of the next 12 months, so it'll only feed through for next year's numbers.
Yeah, but at a much lower level. So it is something to bake in.
Freddie,
great to see you. Thanks for stopping by to see us this morning. Thank you very much indeed. Freddie Lake, Managing Partner at Latitude Investment Management. Call 6 looks like this. Quick perusal of what is going on. This is the picture, as you can see, largely red. In fact, really very red, particularly Novo Nordisk, which is down quite hard this morning. Oil stocks are certainly under pressure as well. Let's talk about some individual moves. Joe Easton has all of the details.
So we are seeing some movement in EasyJet. It does look like the revenue numbers possibly taking the attention away from those strong summer bookings that the CEO was talking about. Bear in mind, we have just seen that drop down in oil as well, but that doesn't seem to be boosting the stock at the moment. Investors seem to be focusing on that miss on the top line, the ancillary revenue, all those extra seats and snacks, probably not actually as big as expected in terms of the growth on that one. Kind of underperformed Ryanair on that one over a long period. So EasyJet significantly lower today. Then we've got BT. That one actually looked a bit better than I thought. That's probably moved down a bit more than I expected to. But BT, pretty much this is a competition story. I've got weakness in a lot of the key markets. That has been the key thing for them in terms of what we've also seen at Vodafone as well. So seeing earnings flat for the year ahead and a bit of downside coming into BT this morning. Then in defence, Kinetic Q or Kinetic, I'm not sure how I'm supposed to pronounce that one. I'm going to go with Kinetic Q, it just sounds more fun. But this is a defence company actually listed on the FTSE 100, one of the UK's biggest defence companies, heavily exposed to the US as well, like BAE Systems, but much smaller market cap. But the earnings looking pretty strong. Unsurprisingly, a big order boost for that one today. So Kinetic or Kinetic Q doing pretty well this morning in the UK. Then one stock not doing well is Embracer. Now, I understand this is Lara Croft, Tomb Raider, also SpongeBob SquarePants. He doesn't get enough shout-outs on this show, but this is a video game company that makes all of those games that I just mentioned, and they've given a really bad update on not only their games, some delays on some of their games, but also a spin-off of one of their units, which seems to be called Coffee Stain. I wasn't really aware of that one, but that one is heavily hit over in Sweden today, down 12% on Embracer this morning. Then another sector firmly in the red is those renewables. Citi called it right on that one. They said Vestas would be weaker because of these tax credit issues for wind energy in the US. Republicans potentially looking to actually end these credits sooner than expected. So ending potentially in 2029 instead of 2032 is the headline news from that. So Vestas lower, Ørsted, Nordex, EDP, all of them underperforming the drops we're seeing in the broader market today. Then we will finish on one big one that we did have our eye on. This is a massive mover in the UK. Johnson Matthey up almost 33%. They're going to sell their catalyst business to Honeywell, £1.8 billion. That was unexpected and a much bigger premium that would have been hoped for that. So we'll keep an eye on Honeywell in the US. Johnson Matthey surging 33%, the best performer in the UK following that asset sale this morning.
All right, Joe Easton from our equities team, we thank you so much walking us through some of those early movers. As Joe was speaking, we did get French PMIs crossing the wire. The May composite PMI rising to 48. The forecast was about 48.1, so those numbers coming bang in line with estimates. You are seeing slight, and I emphasize slight weakness when it comes to the services PMI, though, rising to about 47.4 reading. The forecast was 47.7, but slight strength. And look, we're still below 50, but manufacturing PMI rising to 49.5. The forecast there was 48.9. So what I'm seeing is better than expected on manufacturing, not as great on services.
We've still got the German number to come, haven't we? That's coming a little bit later on this hour, so we'll certainly bring you that. That one is expected to stay above 50, so we'll see if that materialises. Still to come on this programme then, US lawmakers work into the night on Trump's tax and spending bill after House Republicans release a new version, that new version designed to bring in those at the edges in the Republican Party who are not keen on voting for it. We're continuing to monitor these pictures as they come to us from Washington. And a reminder that the Qatar Economic Forum is still underway. It's its final day. Currently, Michel Hussein is speaking with the former Greek finance minister, Yanis Varoufakis. You can watch all of the panels that are taking place there in Doha on your Bloomberg terminal. You just type live go and it'll take you to all of the output coming to us from QEF. This is Bloomberg.
I always want to read it and I never regret it. Similarly with Spotify, when it recommends music to me, I actually like it, usually, and sometimes I love it.
Because it knows you very well.
I have trained it to train with...
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Welcome back. We are 90 minutes, let's call it 20 minutes into the equity market session thus far. As you can see, there's a weakness on the screen in front of you. A number of different factors for that, but one of which is that we are seeing lower crude prices today. That is rippling through into some of the oil majors on the major markets here in Europe. WTI currently flirting with 60. We're at 60.59. Brent, a little further north than that, 63.88 is where we're trading at the moment. They're both down, let's call it 1.6%. Bloomberg News reporting that OPEC members are discussing the possibility of another big output hike, which is why you're seeing what you're seeing on the screen in front of you. Bloomberg Senior Executive Editor for Energy and Commodities, the perfect person to talk to. He, of course, Will Kennedy, joins us around the table. What do we know? Why would the Saudis, why would OPEC do this?
Well, it's a continuation of a strategy that they've been pursuing for several months now. A couple of months back, they surprised us with this 3-month in one increase of 400,000 barrels a day. Then they did it again, and now it seems that they're talking about doing it a third time, although I should stress that it's not decided yet. The decision will be made next week, and that means over 3 months they would have brought a total of 1.2 million barrels back into the market, which is more than 1% of global oil demand. It's a fairly big move, and obviously we've seen oil prices come down substantially. I think it's interesting, though, that on this news, yes, prices are down, but right now we're still holding firmly above $60 a barrel. So some of the cataclysmic price forecasts that we had heard, especially when the trade war was at full pelt, aren't coming to pass. So maybe that's given them some confidence to pursue and continue pursuing this strategy without the impact on oil prices being completely cataclysmic for their fiscal balances.
Will, what's the doomsday scenario here? If we start to see trade concerns ratchet up, global growth concerns weigh on oil prices, at what point do the Saudis or OPEC broadly look at those falling oil prices and say, we need to reverse course? Is there a line in the sand?
There's always a line in the sand. I think clearly they knew the implications of what they were doing, and I think that the Saudis in particular would have realized that to pursue this strategy will mean that they are going to have to face a period of lower oil prices, and that will have an impact. I don't think there's any sense that these prices are near to that doomsday scenario. Otherwise, they wouldn't be discussing this for a third month in a row. After this, I think a lot of people in the market that our reporters talk to say they may pause and take stock through the summer into the autumn because there are still more barrels that they're keeping off the market. But this has been a pretty substantial move, and I think the Saudis and other leading members are ready for a certain amount of pain.
Will, the idea that they're doing this to stop those who are producing more than they should, why now? Why has that suddenly become such an issue for the Saudis? Or it's just always been an issue? But
it's always been an issue for the Saudis. I mean, if you look at the last few years of OPEC policy, one of the most common themes is the Saudi oil minister, Abdulaziz, berating other OPEC Plus members for their failure to comply and trying to force them to make back payments, sort of cuts to rebalance the book with varying amounts of success, shall we say. And I think that one thing that we can say is that patience ran out on the Saudi part, and from their point of view, they're pretty disciplined in their target. If other people are busting targets like that, they're sort of free riding on Saudi discipline, and I think they came to a point where they're losing market share, they're not getting the price benefit, other people are taking advantage, and I think they felt that they needed a different approach.
Okay, well, thank you very much, Bloomberg Senior Executive Editor for Energy and Commodities, Will Kennedy. Now, let us move to other macro matters. The US dollar hovers at a one-month low as Treasury yields and the dollar go in opposite directions. Let's bring in Bloomberg's Valerie Teitel, who has more. So a lot of people are making a lot about the fact that the dollar and the yields are moving in opposite directions. Valerie, how concerned do we need to be about that?
Look, I mean, it is frankly very concerning, but I think the more concerning thing is this theme continues to come back. And it's almost one of those notions that once you see it, you can't unsee it. And I guess the momentum for this trade to come back on any worry about the U.S. deficit is just, it might change the direction of how the market trades from here. There's many weird things going on in the market. One I know that you keep talking about, Guy, the fact that just yields are this high when the economy is slowing. Normally that's when we get lower yields.
They're not so high. Jamie Dimon's telling us they're not that high.
Yes, exactly.
But you and I were kicking around this earlier. Is the argument here that in order to attract foreign money, you need a cheaper dollar, and you need higher yields? You see this in other economies. When push comes to shove, that is what gets money back into the economy. Is that what we're seeing here? Effectively, the market forcing us into that kind of a scenario.
Yeah, in some ways, it's a revaluation of U.S. assets, something that normally happens in emerging market economies. You know, like Brazil, for example, has had many of these blow-ups when foreign capital leaves, and the way to attract it back is a central bank hiking aggressively, the currency moving aggressively weaker in order to almost revalue assets in this country to attract them back home. Now, that kind of dynamic is not really one you want to be facing when you have a treasury market that is set to balloon in size. And I think that's the more concerning thing about this price action. You look at the CBO's projection for how much the treasury market is going to grow. You know, in 2020, it was 20 trillion. This year, it's set to reach 30 trillion, and in 5 years' time, it's set to reach 40 trillion. So it begs the question, there needs to be another buyer of treasuries out there. And the market is telling us that, yes, the U.S. government, if you want to run these deficits, that's fine, but you're going to have to be paying up here for it.
Walk us through then you just paint out such a doomsday scenario.
Critics are reeling from that.
I'm like, oh my God, this actually is really, really bad. But I guess what I'm trying to figure out though is there any merit to the idea that the plumbing can't actually stay afloat? Basically, that if there is this much supply, at what point does digestibility become a bigger concern for Wall Street?
Yeah, definitely. And I think it almost begs the question, you know, at what point do Treasury yields really attract Washington to pivot and take a different direction? And I've thought about this for a lot, and I think, you know, it doesn't take just instability in the Treasury market. I think it has to lead on to the corporate bond market, where you see, you know, corporates, maybe the funding frees up for corporates, and maybe that's the big wake-up call. I don't think we're there yet, but maybe that's the line in the sand for Washington.
Valerie, thank you very much. Bloomberg's Valerie Teitel with the latest on the bond markets and how that's feeding into other assets. Coming up, German PMIs are due in just a few minutes' time. We had the French numbers. We'll discuss what all this data means for the ECB's reaction function. That conversation next. This is Bloomberg.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%, and I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 20 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome back to the opening trade. Right now, our attention goes to Germany and the weakness of this data coming in from Germany. The composite PMI, 48.6. That is back in contraction territory, not above 50, as had been anticipated. So that's below the prior number and below the survey. Where's that weakness coming from? Well, manufacturing is still weak, but that weakness was anticipated. There's further weakness coming in services. So we're down at 47 on the services reading, and the survey was 49. So this is weaker than had been anticipated. This fits in with a fast-moving story around Germany. Yes, weakness in the underlying dynamics of the German economy, but action being taken by the German government. Let's put all of this together and talk to Monika Schnitzer, who's chair of the German Council of Economic Experts, an independent panel that advises Chancellor Friedrich Merz. Monika, nice to have you with us. I wonder your initial response to the weakness of this data. So we have the German composite PMI at 48.6 and weakness, more weakness than anticipated in the services side of the economy. Does that make sense to you?
It's not really what we expected because, yes, the economy is not strong. We are stagnating this year, but there are signs of recovery in the sense of we have a fiscal package now implemented by the government. This has actually given quite a lot of expectations that the economy will recover, so I'm a bit surprised.
You're surprised. I mean, does this mean that you came out with new forecasts for the German economy yesterday, Monika, and they showed stagnation as your forecast for 2025? Does this apply downside risk to that forecast? There's a risk we could get contraction in the German economy, I suppose, this year?
It really all depends what's going on with the U.S. tariff policy. So this definitely has increased uncertainty tremendously. So companies are holding back their investment. They're not sure, should they move production to the U.S., should they not? It really makes companies hold back their investment. So that's bad. And for consumer confidence, we also see that it's still low. So consumers are holding back their purchases. That's also bad. But on the other hand, as I just said, the fiscal package that is going to be implemented gives hope that the economy will be recovering. So at least on the German side, there's now much less uncertainty than there used to be last year.
Monika, good morning. It's Guy. Let's talk about the exciting subject of economic multipliers. I'm wondering what effect we see from this German spending package, how quickly it comes, how much of an effect we actually get. What is your current thinking around that? Because there does seem to be this expectation that we do see a fairly good read across from extra fiscal into economic data.
Yes, that's actually what our report yesterday was about. We did some projections of how the fiscal package will impact the German economy, its GDP, also the debt. We see that it depends really very much on how you spend the money and how quickly. So let's start with how quickly. Yep. If we get this started this year already, which is unlikely because it takes some time, some planning to do, then of course the effect is stronger. But we expect at least next year to the economy picking up, that already gives our projection of a 1% growth next year. But we do say it really depends on how you spend it. If you spend it on consumption, we are actually very frank, then this is not going to boost the economy a lot. It will boost it to some extent. There's a Keynesian effect then. It will be some effect, but the effect will be so much larger if it's spent on investment, as it should be, because the debt brake that was changed in order to spend it on investment.
What do you think the effect, if we do spend it on investment, if the Germans spend it on investment, what effect do you think there will be on the potential growth rate of the German economy?
So we do think that over the next couple of years, the growth of the German economy, or it can increase the German economy quite substantially, and we could expect a growth rate to go well beyond the 1% that we are projecting for next year. So in that sense, there could be actually quite some impact.
Monica, it's Kriti in London. Talk to us a little bit more about that effect. We had a guest on the show earlier talking to us about how the fact that leaning into defense spending may not be as lucrative in terms of the fiscal multiplier that Guy just mentioned, relative to, say, infrastructure spending or other pieces as well. Can you just walk us through the lag or kind of the limited effect of the defense piece specifically?
Exactly. So defense, it's better than consumption, but still the multiplier that we expect for Germany will be below 1. So it's actually not boosting the economy a lot. It will be larger if it's really spent on investment in terms of infrastructure. It will be larger if it's spent on things like research and development. That has the longest effect and the largest effect. So actually also, if you consider how long the effects will last of this fiscal stimulus, it will be longer, more prolonged if it's spent on investment rather than on defense, rather than on consumption.
So in the other pieces of that investment strategy, you mentioned infrastructure, you mentioned research and development there. Are inflation worries going to factor into that or make that project more difficult, or is that a issue of the past?
So it all depends on capacity, and yes, we see for building capacities that we still have quite some room here. If you think about road construction, for instance, there is less capacity left at the moment, less idle capacity. So in that sense, it's really important that the government announces their plans very quickly, because that means then the companies can prepare for the orders that will reach them, and so then they can increase their capacity. I mean, that's the whole idea. The whole idea is that the economy will grow because also capacity will be extended, and the capacity that is there is going to be used. So yes, if the money would be spent right away and just on one thing and the capacity is not there, then there could be some inflation effect, but this is not how we expect things are going to happen.
Monica, what do you think the priority for the German input into the trade conversation between Europe and the United States? What should the priority for Germany be when it comes to that trade conversation?
It's obvious that some sectors are much more affected than others. So we rely a lot on automobiles, on machinery, also on pharmaceuticals and chemicals. So these are the products where we would be very interested in making sure that the tariffs actually come down. So there will be a strong focus of the German administration to talk about these things.
Monica, a final question to you, if I can. I apologize in advance if this is too direct of a question, but I am curious, as we digest the various trains of thought, from trade worries to inflation to supply chain crises, investors seem to be coming on our show time and time again and saying, the world is a tricky place to navigate, except for Germany, because we have this fiscal spend coming down the pike. Monica, I'm curious, what keeps you up at night? What are you worried most about that project coming to fruition?
Actually, I think this project is one of the biggest hope we have at the moment, that things are going well and will be falling into place. So the worry could be that it takes too long to actually put it into action. But I do think the government has the sense of urgency that is needed now to really make things move fast. And the companies are waiting for the money, they are waiting for the orders, and so are the people in Germany.
Monica Schnitzer, lovely to have you on the program. Thank you so much for joining us. Chair of the German Council of Economic Experts, joining the program this morning on Germany's path, or return, I should say, to growth. Let's go from the story over in Germany to the broader EU, which has to be pragmatic and progress, with the coalition of the willing, even on the economic front. At least that's the view of the commissioner in charge of industrial strategy. Yesterday, the EU unveiling plans to cut red tape for medium-sized companies in an effort to catch up with China and the United States. Stéphane Séjourné spoke exclusively with our very own Oliver Crook in Brussels.
On considère que le modèle européen de décarbonation.
We think that the decarbonisation model and the Green Deal are a social and ecological step forward, and deregulation is a step backward.
Social, environnemental et climatique. Et donc, on essaye.
So we're trying to push to eliminate the red tape as much as possible, while maintaining the objectives of the European model.
Toute la tech, toutes les big five.
The tech sector, the Big Five, which were targeted by the Trump administration, the pharmaceutical and auto sectors, steel and aluminium, these are strategic sectors that drive growth, have a massive impact on European GDP and create jobs.
Et en plus, créer des emplois en Europe.
I have put in place a mechanism to call all the CEOs who were contacted by the Trump administration and to reiterate the positive simplification and pro-business agenda of the EU Commission in the coming months.
De la Commission européenne dans ces prochains mois.
Now you have the plan. Now there's a question of implementing the plan and getting potentially consensus among 27, EU member states. Always a challenge. There's also been an idea, and you've talked about this a little bit, of maybe going about this piecemeal, saying a coalition of the willing, and then they could see they unlock the benefits. How are you sort of proposing to go about this? What is going to be the most effective way to actually make this a reality?
Il faut être là aussi très pragmatique, et je pense que la Commission européenne a par le passé.
We have to be very pragmatic. I think that in the past, the European Commission has been dogmatic by needing all 27 member states to agree before moving forward.
On a choisi de changer de méthode.
We are changing this approach so we can work with coalitions of the willing. This should also encourage others to join.
De rallier les autres.
You just evoked there the idea of potentially closure of the American markets to the European, something that you need to potentially prepare for. What are the chances of that? How realistic a possibility do you think that is?
Depuis maintenant quelques semaines, il y a des discussions, mais des discussions qui sont sur le.
For the past few weeks, there's been discussion on the perimeter, but not on details of the tariffs.
Des tarifs. Je pense que cette période que nous vivons est inédite en elle-même.
I think the period that we're living in is unprecedented due to the uncertainty in markets and the unpredictability of the Trump administration.
Trump, il faut le dire en transparence. Peut-être, et j'espère que.
I hope that things will stabilize and that the Americans will remain simple and loyal partners for the Europeans.
Loyaux, en tout cas, c'est ce que nous sommes et ce que nous considérons être.
Stéphane Séjourné, the EU Commissioner in charge of industrial strategy, speaking there to Bloomberg's Oliver Crook. We'll return to the corporate story next. EasyJet shares under a little bit of pressure this morning at the start of European trading. As you can see, they have narrowed the earlier losses. The budget carrier reporting a bit of a revenue miss. Positive outlook, but revenue miss. We'll dig into the details next. And a reminder that the Qatar Economic Forum is underway in its final day. Currently, Francine Lacroix is moderating a panel on the tech investor outlook. You can watch that panel if you would like to do so. We've got a good show still going on here, but if you want to watch that, live go on your Bloomberg terminal. is the function that you can use.
Learning that AI is able to do, it starts to create what I'll call, well, we're calling it generative AI, but really becoming creative, right? And not just being an efficiency tool. I think that's the utopia that we're all working towards, and as we get there, I think the sort of horizons open up even larger.
I want to actually ask Chris about valuations and whether some of the AI...
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look at what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, and we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Red with a tinge of orange, becoming a little less red. The stock was down quite hard at the beginning of the session. EasyJet now down 1.7%. The company out with a little bit of a revenue miss this morning, and that is obviously a factor in terms of why we're seeing what we're seeing on the share price. But the budget carrier is looking to renew its fleet. It's talking about a fairly solid summer, but it does face supply chain challenges, as do many airlines at the moment. We spoke to the company's CEO, Kenton Jarvis. He says the industry is benefiting, despite all of the headwinds, from a lower oil price.
As we enter the summer, we expect our fuel bill to go down by 8%, and our annual fuel bill is something like 2.4 billion. So that will allow us to offer great fares. We will be looking to pass on the benefits of those fuel savings to our customer, but equally being mindful of other cost positions which may be having different levels of inflation.
On the one hand, on the other hand, there are different factors coming into the mix in terms of what EasyJet is seeing right now. Kate Duffy covers the carrier for us and joins us around the table. You've been on the media call, which was fairly short, and what we're learning this morning is that basically a little bit of a revenue miss, fairly solid outlook for the summer, but still quite a lot of vagueness around what exactly we are going to get from this airline going forward.
Yeah, absolutely. So EasyJet was reporting a strong summer outlook for flights and their EasyJet holidays as well, their package holiday business. So that's looking positive. One thing that he did highlight during the interview was this sort of constrained capacity across Europe. And this is ultimately driven by the delivery delays at Airbus, which is EasyJet is an all Airbus fleet, obviously, but also Boeing, so that's affecting other airlines as well. So
is that why we're getting the vagueness?
Potentially, I think there's a certain uncertainty in the industry about how quickly the manufacturers can get the jets out of the door. And for EasyJet, they're looking to sort of renew their fleet, renew the older aircraft that are more fuel guzzling with these newer jets that are more fuel efficient, so they can potentially save money and be more sustainable in the future. So that's the main worry for EasyJet at the moment, just replacing these older aircraft as we go forward. But as Kenton said, there could be some impact, positive impact with the oil prices and the fact that they're a budget carrier as well, offering these lower fares. That could be a positive.
How does that compare to the problems at Ryanair?
Ryanair has an all-Boeing fleet, so they've obviously struggled with a lot of Boeing delivery delays over the past year or so. They're now coming into the grapple of potential tariffs on their aircraft too, so that's something they're looking out for. But with EasyJet, obviously we're seeing the stock is down, whereas on Monday Ryanair stock was considerably high, in fact record levels, and this is primarily down to the fact that there's potentially a better outlook for Ryanair going forward in terms of shareholder returns, and also the fact that EasyJet has a very UK-focused network, and a lot of consumer sort of cost of living crisis is more sort of centred around the UK at the moment compared to the rest of Europe, where travel is actually looking very, very strong.
And where does that leave the outlook for travel in the summer then, Kate? Because we've heard a lot from maybe the bigger global airlines talking about a lack of willingness to visit the US or weaker transatlantic routes. That doesn't play directly to the disadvantage of EasyJet. In fact, maybe it benefits them.
Yeah, I mean, it's certainly a good time to be a European airline at the moment. You have these low oil prices, and as you said, like these legacy carriers, British Airways, Virgin and Air France and Lufthansa, they've all reported a slight softness in the transatlantic demand between the US and Europe at the moment. Whereas, Europe, there's strong demand. People want to travel. Michael O'Leary was saying on Monday, people in Europe, they want to stick closer to home instead of going across to the US. So that's definitely a positive, but there are still risks in the industry, of course. There is the geopolitical conflicts that we're seeing across the region. There is that potential, do we have to cancel flights? Do we have to rejig our capacity? Airlines are considering this, but also the situation of tariffs, of course, as well. If there are tariffs imposed potentially on an aircraft, for Boeing, then there could be implications for Ryanair, and then what is their next move? Are they going to take aircraft in the UK, or are they going to sort of delay deliveries or even cancel them, as O'Leary has suggested?
Kate, thank you very much. Bloomberg's Kate Duffy with the aviation news of the morning. And in fact, sticking with that sector, Qatar Airways says it could still buy wide-body jets from Airbus in the future, just days after announcing a record order for 210 long-haul jets from Boeing. Bloomberg spoke with the airline CEO at the Qatar Economic Forum.
Our narrow body will continue to be Airbus. We're receiving 50 321 NEOs starting next year. So our whole narrow body fleet will be basically operated by Airbus. We continue to receive 350 1000, and there will always be a chance for another order from Airbus.
The conversation over in Doha with the Qatar Airways CEO over the Qatar Economic Forum. Let's switch focus to, I think, what is our top story of today. We are, of course, waiting on the vote in Washington when it comes to the one big, beautiful bill. Let's get the latest on that and bring in our very own Charlie Wells and Valerie Titel, who are watching this very, very closely. It's rare that at 8:52 in the morning here in the UK, we're talking about what's going on in Washington, D.C., but the House Republicans staying late. Charlie, I'm going to start with you here. Walk us through what we expect in these next couple of hours.
Yeah, Kriti, I mean, we're really getting down to the wire here, right? So we've been seeing them work through the night. And this is really important because Mike Johnson, the Speaker of the House, has set a deadline of Memorial Day in just a few days. So down to the wire. And we know that this bill has passed a key procedural vote over the terms of the debate. It's moving forward. And there are some changes here, and these have been notable. And it just speaks to the sort of cantilever that Mike Johnson has had to try to balance under pressure, where he's got the SALT caucus. So these are Republicans from traditionally blue states. We see an increase in the deductions on that SALT cap from $10,000 to $40,000. So that is kind of trying to assuage their concerns. But on the other end of the spectrum, within that Republican Party, you are seeing the ultra-conservatives, and they have wanted a lot of cuts here. And we're seeing an acceleration of work requirements for Medicaid, that is the entitlement program for lower-income Americans. We're seeing an acceleration of work requirements from 2029 to 2026. But the concern for them still is how this contributes to deficits to the tune of trillions of dollars.
Still got to go over the road. Still got to go to the Senate. How's that going to work?
Yeah, so look, it's a long journey ahead. I mean, today is going to be important, but still, I mean, if anyone looks back at history, they know that when a bill goes from the House to the Senate, there tends to be something of a moderating effect. We know that the Senate tends to be a little bit more moderate politically, but also they're on a different calendar here, right? They have 6-year terms. The president's got 4 in the House. They've got 2. And so that just creates a different set of incentives. And if we think back, say, to the Biden administration, we knew this is where a lot of those big pieces of legislation, they died because of just a few members of the Senate.
Okay, and what does all this mean for markets? Let's bring in Valerie. We've talked a lot about how the bond markets have reacted to this. Do we get any sense of how markets are positioned if we get an approval of this bill or if this bill fails?
Yeah, I think, at least for markets, it's not a make or break moment, this vote today. I think there's still a lot of time on the table to get this bill passed. And so I think the market reaction might be limited unless it fails by a very large margin, which would maybe entail, months of delays. It was interesting to me, though, that the price action we saw going into this is kind of like a reverse TARP. Back in the GFC, we had the markets really urging Congress to pass a bill. It seems like the bond market is urging patience when passing this bill. So that's maybe a bit of word from the bond market on that.
But this was something that was supposed to be easy, at least circa November 2024, that if you have a razor-thin majority in the House, but a House majority nevertheless, a Senate Republican majority as well, Donald Trump was, in theory, at least the way that it was presented, able to actually get in and pass anything. Val, I want to get your take in a moment, but Charlie, weigh in on that.
Yeah, well, I mean, Val brings up this great point about the Obama era. And let's remember, in that first year of his presidency, they had the trifecta. It was looking like this legislation was going to be such a slam dunk. You go into that first summer, 2009, what's going on? You've got these town halls across the country about Obamacare. Do you remember those and how long it took? So going in, thinking this is going to be quick, thinking it's going to be easy, I think that's a mistake.
Charlie sounds scarred from that.
I think we all are. But is that perhaps where the mispricing lies, Val?
Well, I guess you can argue maybe the bullish side to this, Kriti, is that once this bill is passed, this is really Trump's economic agenda done. And that just creates maybe a fall of uncertainty across the cards because he's done the tariffs. He's now, good progress on this tax bill. How many more surprises should the markets be prepared for that?
Many more. What are we? 22nd of May, 2025. Thank you very much to Valerie Teitel and Charlie Wells for setting us up for one of the big items on our calendar, on our daybook, in terms of the trading day ahead, and that is watching this vote that is still taking place or yet to take place over in Washington. We've had data out from Europe already. We have more to come, though, folks, in the shape of the German IFO. That's coming imminently. We also get the UK flash composite PMI, so we'll watch out for those as well.
Yep. We're just waiting for the vote, though, really. That's going to be the main event of the day. We'll keep you covered on what exactly is happening there and what's coming out of D.C. That's going to be the story. We've got it covered right here at Bloomberg. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here at the Qatar Economic Forum in Doha, and these are your headlines. Donald Trump's massive tax and spending bill returns to the House after overnight negotiations on tax deductions and healthcare cuts. Investors push back against the prospect of a ballooning U.S. deficit with 30-year Treasury yields hovering near 20-year highs. Plus, the South African president insists that talks with President Trump were constructive despite being ambushed by claims of genocide against white farmers. Now, first thing is first, we have a lot to get through, a lot of news today on this Thursday morning. But actually, let's look at the markets. Stocks in Europe and Asia are definitely falling, and this is on concern over the U.S. fiscal outlook. That's triggered a broader risk off-tone across markets. Now, bond market, let's focus on the bond market. We're looking at cross assets, really expressing some of the sentiment that the cost of capital is rising. Risk assets, they think, need to be re-justified amid concerns over the U.S. deficit and the tax bill. Now, we're also getting some data points out of the euro area. PMI, composite PMI, falling to 49.5. Forecast was above 50. Now, we also have a bit of IFO business confidence. That index at 87.5, pretty much in line with expectations. Now, U.S. lawmakers are currently debating a new version of President Donald Trump's massive tax and spending bill. The revised legislation including a higher limit on the deduction for state and local taxes and other changes in a bid to win over warring GOP factions to support the multi-trillion-dollar package. Now, voting on the bill is actually expected to take place shortly. For more, let's bring in our EMEA news director, Ross Matheson. Ross, I'm losing my voice, but what's in the bill and what are the main sticking points?
Well, as we can see, there's a debate going on at the moment in the House on this that possibly will run for a few more hours, and then we're likely to get that vote. It's narrow, but at this point, the expectation is that it may pass. Obviously, this is a massive bill. There's so many things in it and so many things being attached to it, which makes it very complicated, as it goes on. But it's for Donald Trump, it's the ability to preserve his tax cuts and say to the American people, I've made good on my promise to do so, and also on his campaign promises to have obviously no tax on tips and on overtime. You know, you can deduct your interest payments on your car if it's a US made cars. So that's obviously trying to push on to the American taxpayer those benefits. But there's also a lot else that's in here, and they're the sticking points, obviously, which are around Medicaid, perhaps some of the accessibility of Medicaid for some American people, and making that quite stringent. That's what Republican hardliners are pushing for. There's also been a long conversation around the ability to make deductions for state and local taxes if you're also paying federal tax, and what that threshold should be. And it seems like there might be an arrangement now around that. And it's also about how quickly to roll off some of the tax credits that Joe Biden put in, the former president, around clean energy. And you can see the impact potentially for renewable companies out of that, and shares moving in Europe, in fact, on that today. So it's sprawling, it's big, it's contentious. The question is, if it gets through the House, then obviously what happens to it in the Senate?
Yeah, I mean, what impact would the bill have if passed?
Well, obviously, it's a big win for Donald Trump in some aspect, because he can say to American voters, I've preserved these tax changes for you. There are big question marks over how much the SALT changes might benefit many taxpayers, how broadly that would benefit. For him also, there's the political question. If you have the Medicare changes brought forward and fewer people accessing Medicaid right into the midterm elections, you know, is that politically tricky for him equally? And for markets, there are fundamental questions. Again, you can see it in the bond market day after day at this point about the fiscal impact of all of this. What does it mean about the level of debt the US is carrying? And you can see the concern about just piling more debt onto that, especially if the debt window gets raised again through this bill. And so the questions of impact, it's a bit hard to know, given we don't know what the final bill might look like once it gets through all the contortions with the Senate and so on. But you know, politically a win perhaps for Donald Trump on one part of it, and a bit of political risk for him on the other as we get closer towards midterm elections.
Ros, thank you very much. Ros Matheson taking us through the impact of what we're seeing developing on Capitol Hill right now. I'm Anna Edwards, just going to jump in for Francine while she recovers her voice live there at the Qatar Economic Forum. Let's go to the market response, though, to all of this politics in Washington. Concerns about the tax cut bill and the ballooning US deficit triggered a sell-off in treasuries. Let's get the details with Bloomberg's Valerie Teitel. So is the bond market sending a bit of a warning signal then here, Valerie? We saw this at the beginning of April, where President Trump conceded that the market had got a bit yippy, in his words. Are we seeing another signal coming through from markets?
The bond market sure did feel yippy yesterday. What a rise in the long end. I think that's telling us that this bill, even though we don't know the full context of it yet, does seem to entail a bit too much spending for what the Treasury market wants to see. Over the last 2 days, we've now seen those 10-year yields, there we go, breach 510 yet again. We are very, very close to breaching cycle highs. Take a look at this next chart, though. I want to point out there was another catalyst that happened yesterday. It was a weak 20-year auction that happened around 6 p.m. London time yesterday. This yellow line is when that auction happened. Not only did it sink Treasury prices around the curve, but it also sank the equity market. The equity market, S&P 500, declined over 1.5% after this week Treasury auctions. These higher yields, Anna, are really, really feeding into risk appetite when it comes to the equity market.
I put the 30-year move in some context for us, Valerie, because I was reading notes yesterday from various houses. They're quite surprised that their attention has had to go to the 20-year auction, because that was not an area that the market usually focuses on. Sure, the 30-year, more tested area of the long end, but give us the longer-term context here.
Well, Anna, we are very close, less than 10 basis points away, actually, from breaking cycle highs in the 30-year yield that was reached in October of 2023. If we do breach that level from 2023, we have to go back 18 years, all the way back back to 2007 to see comparable highs in these 30-year yields. And again, I just want to mark how strange this is to see at this point of the cycle when we're having an economic slowdown in the U.S. We normally see long-end yields rally. That's something we've not seen, and that's due to the fact the market is so focused on supply and demand concerns. The other thing that stands out as odd is normally when we have Treasury yields rising, that does help the dollar out. That's not been the case this week. The Bloomberg Dollar Spot Index hit a one-month low yesterday, and it's down 1.2% so far in this week's trade.
Valerie, thanks very much. Bloomberg's Valerie Teitel with a nice setup on what's happening in the bond markets. Well, no surprise, that was part of the conversation with Jamie Dimon that Bloomberg hosted earlier on today. Jamie Dimon says he can't rule out that the US economy will fall into stagflation. The JP Morgan chief executive says there are huge risks and he believes the Fed is right to hold. Dimon's been speaking exclusively to Bloomberg's Haslinda Armin.
You talk about that kind of complacency. I'm talking about the asset price in the United States, and it's a long list of things. It's QE, it's fiscal deficits, it's global fiscal deficits, it's potential the trade wars, it's these huge complex geopolitical situation, and I look at all of those probably not being properly priced into the marketplace. But we don't know what's going to happen. So, I saw last night's reaction. I don't worry about one day move in bond markets. So.
You don't worry about one day, but when you take a look at yields, they are at higher levels than they were before Liberation Day. I mean, we talked about how 30's higher, and some are talking about 10's getting to 5's, 30's getting to 7%. How are you assessing that? I mean, how high do yields have to go before they reach breaking point?
Yeah, I don't know the answer to that. No, we assess. The way we run the company is we prepare for a full range of outcomes, regardless of what you think. I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting that. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. And the infrastructure needs are inflationary. And now you have offsets. You have oil prices down quite a bit, which is quite deflationary. But with all those things taking place, yeah, you may be surprised.
As we said, it is a higher yield environment, and you have said before that we could see some sort of rebellion in markets around the world. Is that still a possibility? How might that look like? Yeah,
so I would not call it a high yield environment. I mean, if you look at economic history, rates have been far higher than this, and they surprise people over time. And like I said, I think a lot of the longer term trends have inflationary attributes to them. And so the other thing for your person on TV, credit spreads are low. So you can have two things go against you, which is credit spreads gap out and rates are going up. And so we'll see how it plays out. So I don't want to guess how it plays out. I'm on the cautious side. I'm a little skeptical that we're going to have kind of just an ongoing soft landing here.
I'd be remiss not to ask you about the Fed. Given the higher yield environment, which you say it's not, but it is still higher than what it was before. Will it
go higher?
Will it go higher? And also, will it force the Fed's hand?
Yes. I mean, there's always a notion that somehow the Fed is omnipotent and can do whatever it wants. And they do set short-term rates, but they also have to follow the facts. So they raised rates because inflation went up, and they can't control. Even today, trillions of dollars of these bonds are sold every day. That's done by investors around the world. They cannot control all of that. Foreigners own $35 trillion of U.S. financial tradable assets. And so, they have to react to reality, in which and that's not a criticism, they say they're data dependent, but they have to wait and see exactly what happens and then do the appropriate thing.
But the thing is, their reality is different from the reality you have in mind. If you take a look at what Neil Kashkari said, he said the U.S. economy is on solid footing. And some other Fed officials have said that in terms of Fed policy, it is in a very sweet spot. So their reality is quite different.
I think, I don't agree we're in a sweet spot, okay? And I think you have to separate two things. The economy has been doing well. All the facts, we have effectively been in a soft landing. That does not tell you what the future is going to be.
The JP Morgan Chief Executive Jamie Dimon, of course, speaking exclusively to Bloomberg, to Haslinda Amin, in fact. Now, over in Doha, over at the Qatar Economic Forum, Francine is back. We think she's rediscovered her voice. It's been a really busy day, Francine, but I'll let you take it from here. But I'm not going anywhere, just in case.
Yeah, thank you, Anna. I am back, and actually, thank you to the air conditioning, but also to the lockets that now are helping me get back on track. So we're here at the Qatar Economic Forum. Let's get more on how investors are navigating the market jitters as the House debates Trump's massive tax and spending bill. With me now, Christina Minas, Global Head of Acquisition Finance at Goldman Sachs. Christina, thank you for all the time that you give to Bloomberg. I mean, there's a lot going on. We talked about credit, we talked about pockets in the markets that look maybe expensive. What are you seeing?
Well, there's a tremendous focus right now on the convergence of public and private markets. And when you look at the capital needs that are a lot discussed here at this conference, we see sort of a $17 trillion figure that it's bandied about for the investment in infrastructure and energy transition. And watching the capital markets really innovate to support that need is super exciting. And our recent formation of our Capital Solutions Group is going to optimize and really create great, hopeful solutions for our clients. So we couldn't be more bullish on the future.
So where does that capital actually get deployed in terms of region, but again in terms of sectors? Is it difficult to find a home for it?
Not a difficult place to find a home. A couple of interesting statistics. I was on the phone with our heads of our TMT franchise, and it's interesting, 50% of data centers are in the U.S., which means 50% are ex-U.S. Now, that's been historically predominantly in Europe, and now we think a huge opportunity here in the Middle East. So there's a tremendous amount of activity, and around the sectors, I would say, things that you've heard for years around tech, of course, but also healthcare, research, natural resources, energy transition. It's just a significant opportunity to invest in these industries.
Christina, what are you doing in the region?
So in the region, I'm here basically. I was serving on a panel on AI, and my topic was to talk about capital formation, supporting this huge growth of capital requirement. And I think a lot of folks are sort of somewhat daunted by the size of the capital need. But when we think about it at Goldman Sachs, we're very confident that the innovation and the credit markets are there to support this need, and that it's much more about finding the right structures to support these clients.
And so again, it goes back to those public-private partnerships, but a lot of the money, I guess, that comes into the region, maybe stays in the region more than in the past.
Yes, and I think there's a lot of focus to invest in the region and also partner with key strategic players in the region and globally.
Christina, where do you see, some of the Trump policies, again, when you look at syndicated loans, when you get at some of the, the products that you offer at Goldman Sachs, do those change or do they adapt, again, to where money needs to flow to?
Yeah, I don't think there's any change in the Trump administration that affect our credit markets right now. I think they're innovating at a very rapid pace. And again, there's a lot of discussion about somewhat the friction between private credit and the public markets, and we just don't see it that way. We think both markets are very valuable to investors and issuers, and they're growing at different paces, but they're significant markets. And so do I see anything stopping that growth? I don't.
Have your clients' needs changed in the last 6 months? Have your clients' needs actually changed in the last 6 months?
There are more clients looking at the class. Private investment grade is something that wasn't really discussed even 2 or 3 years ago. And so now we see a lot of interest from investors across the spectrum to look at private investment grade. Private credit markets historically were focused on below investment grade.
Yeah, and it feels like it's just at the beginning for that market really to flourish and grow.
Yes.
Right. Is that more than some of the credit? We talked a lot about higher valuations or some of the concern regarding the private markets. Again, what are you hearing on the ground from people saying they worry about top evaluations?
Look, I think valuations continue to be lofty in certain sectors, and there's a lot written about that. I think there are many companies that will potentially stay private for longer. And the good news is there's a tremendous amount of private capital to support those companies. So I think there's a focus on, can these companies access the capital to hit their growth plans? And the answer is absolutely yes.
Well, when you travel around the world, where do you see the biggest opportunities region-wise?
Well, I would say right now there's a very big focus again on Europe, which I would have said a couple of months ago there was concerns. Of course, the U.S. And then I think here in this region, there's a tremendous amount of interest in this region based on all the things this region has to offer in terms of capital, energy, land, research, and science. So we're very excited to be here as well.
Europe, is it defense? I mean, I feel like a lot of the defense spending, certainly from Germany, has given a little bit of a boost to investments across the board.
Yeah, I think in Europe, there's going to be obviously a tremendous amount of investment in defense and security, but also across the spectrum in AI as well, and healthcare and research. So I would expect to see investment in Europe, not just in defense.
Where does it, if you look at AI infrastructure?
Yes.
I mean, it's at all top levels, right? Where do you see the biggest value creation over the next 5 years?
I would say in terms of the opportunity set, in the middle of the stack where there's like the infrastructure build out from a credit perspective, there's tremendous need for capital there. But I think across the entire spectrum from very early stage companies through to applications, there's a tremendous upside. And we couldn't be more excited about that opportunity set for our clients and also being there to support them with capital.
Christina, thank you so much for joining us. That was Christina Mines, Head of Global Acquisition Finance at Goldman Sachs. Now, coming up, the South African president is the latest leader to face a White House showdown. We'll have the details of his meeting with Donald Trump. That's next, and this is Bloomberg.
It's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. This week, Bloomberg brings you live coverage from the Qatar Economic Forum. Bloomberg Horizons Middle East and Africa and The Pulse will be broadcasting live from the conference floor. Then, throughout the day, we'll bring you all the highlights from the key policymakers and market movers on the issues confronting the global economy. Live coverage from the 5th edition of the Qatar Economic Forum continues this week, right here on Bloomberg Television. Context changes everything.
I can categorically state that there is no genocide in South Africa. There are crime problems, there are issues, there are contentious issues around land, and I think President Ramaphosa tried to land that point last night in a very difficult situation. But the beauty was, we saw a government of national unity in action. We saw the leader of the opposition actually back up his president.
Hendrik du Toit there, the chief executive of investment management firm 91, speaking here at the Qatar Economic Forum earlier about false claims by President Trump of a genocide against white farmers in South Africa. Well, Trump's meeting with South African President Cyril Ramaphosa at the White House yesterday was seen as a chance to mend strained relations between Washington and Pretoria. Instead, Trump used the opportunity to repeat his genocide allegations by showing a video that purported to back up his claims that white farmers are being targeted.
If there was Afrikaner farmer genocide, I can bet you these three gentlemen would not be here.
Each one of those white things you see is a cross, and there's approximately 1,000 of them. They're all white farmers, the family of white farmers.
There is criminality in our country. People who do get killed, unfortunately, through criminal activity, are not only white people. Majority of them are black people. And we have now been utilizing...
The farmers are not black.
I
don't say that's good or bad, but the farmers are not black.
Well, I'm joined by Arjit Ghosh, our Africa managing editor. Arjit, frankly, I wasn't sure what we were watching, right? The meeting seemed to confirm the fears of some of Ramaphosa's advisors who believe he was walking into a trap.
Yeah, I think, they would probably be aware that they'd probably see this action there right now. But I think if you just look at the numbers that we have been kind of reporting about 72% of white farmers own kind of the land there, and they are just 7% of the population, really. So the data really doesn't back up what President Donald Trump has been talking about. Again, if I may throw some more numbers at you, there's a huge problem of crime in South Africa. Nobody denies that, and we heard Hendrik du Toit talk about it, President Ramaphosa talk about it. But if you look at the numbers, 27,000 murders in Africa last year. 0.2% were in farms. So again, the data doesn't support the claims that Trump has.
So President Ramaphosa, stay cool. I thought he handled it, pretty well. But where does that U.S.-South Africa relationship go from here?
Yeah, very good point. What we are hearing, we heard the finance minister, Enoch Godongwana, just talk about it as well. He is not there at Washington, but he has been getting feedback. And he says that what he's hearing is that there's hope for a reset between the ties between the two countries, really. That's all behind cameras that, President Donald Trump and President Ramaphosa talked about trade, for instance. So there is hope that there would be some reset in relationships. Ramaphosa wants to see Trump come to the G20 summit in Johannesburg, and he said that he's hoping that Trump will be there.
Yeah, and I wonder, it's not really about diplomacy. I guess it's about, President Trump and the White House playing to a message back home.
That is exactly what is happening in terms of President Ramaphosa's. I think he's getting a lot of support from what we have been hearing back home in South Africa, really. And hopefully that will help the government of national unity as well as they progress into a lot of contentious laws that are coming up, including the expropriation law and the healthcare law that have been in the works for a while now.
Arjit, thank you so much for joining us. Arjit Ghosh, they're in charge of all of our continent's coverage. Now, this is what's happening on the plenary stage here at the Qatar Economic Forum. Rob Barnett, senior energy analyst at Bloomberg Intelligence, is speaking about the race to power AI. Let's listen in.
Quickly, I have a chart up on the screen just showing the solar names. They had a really rough 2024, also a challenging 2023, despite a lot of optimism from the U.S. president and the prior administration. We think they are back to growth in 2025 and future years as well, even with all the discussion about tax policy that's going on in the U.S. So look for solar names and storage names to be geared to the idea that data centers are rapidly propelling power demand. We think that the hyperscalers, despite their ambitions to be carbon neutral in all of their ESG goals, are a very practical lot. They are focused on rapidly scaling AI, and we don't see how you get there without a significant...
Of course, terminal subscribers can continue to watch that on Live Go. Coming up, Israel tightens security at its embassies after 2 members of staff were shot dead in Washington. We'll have plenty more on that next, and this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here at the Qatar Economic Forum in Doha, and these are your top stories. Donald Trump's massive tax and spending bill returns to the House after overnight negotiations on tax deductions and health care cuts. Investors push back against the prospect of a ballooning U.S. deficit with 30-year Treasury yields hovering near 20-year highs. Plus, the South African president insists that talks with President Trump were constructive, despite being ambushed by claims of genocide against white farmers. Now, we're just getting a little bit of breaking news out of the UK. You can see some May services PMI actually rising to 50.2. Remember, everything above 50 means that we're in expansion territory. That composite PMI rising to 49.4. So that's unfortunately below 50, but it is a little bit better than the forecast, 49.3. Now, Israel Prime Minister Benjamin Netanyahu says he's ordered enhanced security arrangements at Israeli diplomatic missions after 2 embassy staff members were shot dead in Washington, D.C. Now, for more, let's bring in Bloomberg's Paul Wallace, who's with me here in Qatar. Paul, police say basically that a 30-year-old male suspect has been detained. What more do we know?
Hi, Francine. So, yes, they've named the male suspect, a 30-year-old from Chicago. It seems as if he was the only person involved in this fatal shooting of a couple. The man and the woman that was shot were in a ship. Obviously, we've seen condemnations of this attack from the U.S. and Israeli officials, and they say they're working together to find out more about this incident, and obviously to ensure it doesn't happen again.
We don't have a motive or anything at the moment.
In terms of the motive, Washington police said the suspect was shouting "Free Palestine" after he was taken into custody, and it very much seems as if this was an anti-Semitic attack.
Meanwhile, in Gaza, Paul, aid trucks have entered for the first time in 80 days.
So aid has started to trickle in for the first time, really, since Israel blocked it in early March in an attempt to put, it said to put pressure on Hamas to release hostages and surrender. International pressure on Israel has been growing, including from the U.S., to prevent an even worse situation regarding food and supplies of medicine in the Palestinian territory. So that started to go, and at the same time, the Israeli forces are stepping up their offensive against Hamas. They say this is the best way to force it to eventually surrender.
Paul, in the West Bank, the IDF has also apologized after firing warning shots at some visiting diplomats.
Yeah, this was sort of a bizarre, strange incident. Important to note that nobody was injured among this pretty large group of diplomats. They represented everywhere from China to Russia to France to Italy to Mexico, Egypt. They were in Jenin, a town in the northern West Bank. They were accredited. They were with the Palestinian Authority, which governs Palestinians in the West Bank. The IDF says, well, that was fine. They did diverge from an agreed course, and it seems as if IDF soldiers saw them in another part of Jenin, presumably didn't know who they were, and fired warning shots. We don't know how close these warning shots went, but the EU and Italy and Jordan and Egypt, among others, have condemned the IDF and said there needs to be a full investigation into what happened.
Paul, thank you so much. Paul Wallace there with the very latest, of course, from the Middle East. Now, the euro charting a course for its best year in 2 decades. Europe's currency is undergoing a resurgence amid concerns over the riskiness of U.S. assets. Now, our next guest is a top EU policymaker who has said the region should take advantage of investor doubts in traditional havens like the dollar and treasuries. Well, we're joined by Pierre Gramigna. He's managing director of the European Stability Mechanism. Mr. Gramigna, as always, thank you so much for giving a little bit of your time to Bloomberg. Now, I have many questions on the possibility of the euro becoming a reserve currency going forward. But first of all, we're also hearing that some countries in Europe are pushing back against ratifying a new ESM mechanism. Could you confirm that, and what's being done to convince them to do otherwise?
Well, first of all, thanks for giving me the opportunity to speak here. We have a revised treaty which is pending because one country is not ratifying. That is not a new situation. Unfortunately, it's not evolving. But this is not dramatic in the sense that we have the founding treaty that is in place, and so we have all our financial instruments available in case of necessity. What is not in place is a backstop to the fund to rescue banks, which has been benefiting from contributions of banks themselves. So that backstop is not in place, but all the rest is in place.
Yeah, have you spoken to the Italians recently? And is there a way, A, of convincing them, and what do you do if they don't budge?
Well, we are speaking on a regular basis with the Italian government. On the other hand, we have to respect the democracies and the rule of law. So a treaty can only enter into force if it is ratified by all countries. So it's up to the Italians to find the ways to ratify. If there is no political willingness, so be it. But it is not preventing us from being active if necessary.
Do you worry at all about some of, I guess, the firepower, the power of the ESM, or whether any remit could be changed?
Well, in fact, we have a firepower of, as you call it, 500 billion euros, out of which 425 are available. And this is extremely useful in these challenging times with the geopolitical tensions, with wars. as we haven't seen them for a long time. So all of this is creating a lot of uncertainty. The European Central Bank declared yesterday, yes, that the geopolitical uncertainty and also tariffs issues worldwide are a danger to financial stability. And let's face it, financial stability is good for peace, and we are in a time of less peace. So obviously this has an impact, and so we're following that very closely. Our role is also to step in eventually for the 20 euro area member countries in case of risks to financial instability. So not only in case of resolution of crisis, but just also having a kind of prevention role. This is tools that we have similar to what the International Monetary Fund has, and it's good to have that available.
But, so how much push do you think will come from certain countries, maybe France, maybe others, to make sure that Europe doesn't regulate too much, that it follows maybe the path of the US and the UK in terms of deregulation? And could you see instability risks arising from that?
Well, I think there has been a recognition by the Commission and by all member states of the EU that there has been over-regulation, and the pendulum has gone too far in one direction, is now coming back, and the goal is not complete the regulation, is simplification, and the omnibus directive of the Commission on deregulation, which is called simplification, is on its way, and it's encompassing lots of things, and so I think it shows the determination of Europe to be more business friendly without compromising with essential issues like climate change or others.
Mr. Gamagna, it's very clear that the Trump administration is actually a full support of cryptocurrencies. What does that mean for Europe?
Well, the jury is out what will come out of the executive orders or the laws that are in preparation in the United States. We're following this very closely in the Eurogroup. We're following this very closely as ESM, as the European Stability Mechanism, as lender of last resort. We're obviously looking at all the things that could have an impact on the euro area, and depending how the regulation on cryptocurrencies or on stable coins is going to be, it could have an impact on the euro area. I think about our autonomy or independence in terms of currency, so it could encourage private companies to issue stable coins. There were initiatives like that in the past that the United States itself did not support, so it needs to be seen if this is a direction in which it's going. I would not like to speculate on it for the time being, but it's something that is on the radar screen of all European governments.
But do you think Europe, we talk a lot about actually U.S. exceptionalism and whether, this is only a bump in the road to more U.S. supremacy, or whether there's actually, a declination of U.S. exceptionalism, and whether Europe, for example, could play a bigger role with the euro as a reserve currency. Is now the time for Europe to make that decision and push it forward if that's what they want?
The quick answer to that is definitely yes. I mean, we've seen in the last months the markets being worried about the status of the dollar as the haven currency in the world for many reasons: the unpredictability of the U.S. administration, the tariff issues, now recently in the last days, the last budget proposals. All of this is producing some pushback by markets, and I was at the IMF spring meetings recently, a couple of weeks ago, and all players told us this is an opportunity for Europe. Investors are looking for places that are stable, resilient, that have the rule of law, that are open to trade, and this is really what we have in Europe. So it is definitely an opportunity for us if we do our homework. And the homework means implementing the Savings and Investment Union, which is also in the LETA report. And we, as ESM, are an actor in this, in making proposals. We will have a conference on this in the weeks to come in June. And there are concrete things and steps that we can take short term, like securitization, which has been left behind in Europe. We need pension products for people that need to be incentivized. So there's lots of ideas on the table of things that we can do quickly. But, you know, Europe can only move step by step. It is sometimes slow, but it is a very efficient in the end.
Yeah, sometimes it comes together in crises. Pierre Gramegna, thank you so much, as always, for joining us. I was the Managing Director of the European Stability Mechanism. Now, Bloomberg understands that the European Union has also shared a revised trade proposal with the U.S. as it aims to inject momentum into talks with President Trump's administration. Well, the new paper is said to include proposals that take into account U.S. interests. It also looks to gradually reduce tariffs to zero on both sides for industrial goods and what it calls non-sensitive agricultural products.
For the past few weeks, there's been discussion on the perimeter, but not on details of the tariffs. I think the period that we're living in is unprecedented due to the uncertainty in markets and the unpredictability of the Trump administration. I hope that things will stabilize and that the Americans will remain simple and loyal partners for the Europeans.
And the European Central Bank says a strong euro and falling energy costs mean that 2% inflation target is not far off. Well, the ECB Vice President Luis de Guindos told Bloomberg that although the impact of U.S. tariffs is still uncertain, he believes it could eventually lead to slower price growth.
We are positive with respect to inflation, and I think that the appreciation of the euro and simultaneously the evolution of energy prices are two positive factors that are going to give an additional downward push to inflation in Europe. The impact of tariffs is something that we have to analyze in detail. No? Tariffs in the short term imply that it's a tax on imports, on imported goods. So it's going to be, negative, in the very short term. But simultaneously, tariffs are going to reduce domestic demand and aggregate demand. And I think that, in the medium term, that drop in demand will more than compensate the initial increase in the price of imported goods because of tariffs. It's clear that trade distortions are detrimental to growth. And simultaneously, that the impact on inflation is much less clear, and it will depend on the time horizon that you're considering, that you're regarding. But I would not dismiss the possibility that that trade distortions and tariffs could have eventually a disinflationary impact on the global economy and the European economy. We have to look at the evolution of inflation. We have to look at the projection that we're going to have. We have to regard as well the transmission of monetary policy. But the disinflationary process is ongoing. And, we believe that sooner than later we will be able to reach our definition of price stability on a sustainable basis.
Well, that was the ECB Vice President Luis de Guindos. Now, EasyJet reporting first half revenue that missed estimates. The budget airline's efforts to renew its fleet are being held back by slow delivery of new aircraft from Airbus, and that's, of course, due to supply chain challenges. But the chief executive told Bloomberg that the industry is benefiting from lower oil prices.
As we enter the summer, we expect our fuel bill to go down by 8%, and our annual fuel bill is something like 2.4 billion. So that will allow us to offer great fares. We will be looking to pass on the benefits of those fuel savings to our customer, but equally being mindful of other cost positions which may be having different levels of inflation.
Well, let's get more now from Bloomberg's Charlie Wells. So, Charlie, good morning. What's the latest from EasyJet?
Good morning, Francine. So the market is not liking what it's hearing from this report from EasyJet, and it really seems to be latching onto this issue of fleet renewal. So this is a main way that a lot of these budget carriers try to grow. They benefit, as you just heard, from that oil price, but they get new fleets that are more efficient, that burn less fuel. And we are hearing from EasyJet this morning some delays from their supplier Airbus there. So that is not feeding well into the share price, despite the fact that we're hearing some positive news on summer bookings. So this is not likely to change the narrative that we've seen over the course of this year, where you've got EasyJet really struggling to take off in the market, pardon the pun, relative to a lot of its competitors like Ryanair, which just had one of its best weeks as far as the markets go, and Wizz Air. So this report unlikely to change the story there.
Charlie, Bloomberg has also learned that LVMH is warning of soft demand. Is that across the board, or is that because they increased prices by too much?
This is some difficulty for LVMH. They seem to be sending out some smoke signals, at least according to some Bloomberg reporting, that there is softness in the current quarter. Now, we've seen over the course of this year, LVMH having a difficult time, really struggling in the market relative to a lot of its peers. This could be a little bit of a conglomerate discount that we've sort of started to be seeing with this company. This could be some of that hard-soft luxury divide, or this could be Asia. We know that Asia is crucial for LVMH. About 40% of their revenue in the prior quarter came from Asia. So when there is consumer softness in sentiment there, you start to see LVMH take a hit. Now, I want to razor in on a particular area within Asia, Hainan province. This is a popular vacation destination for a lot of Chinese travelers when they go domestic. And what Bloomberg has reported is we are seeing continual duty-free shopping declines there. We've seen them month after month. And what we know is that this spills out into not just LVMH, but into other beauty brands, the L'Oreals, the Estée Lauders, and the Shiseidos. And they are seeing softness in that retail travel space. So softness in China, softness in Asia, spilling out to a lot of these large European companies.
So interesting. Charlie, thank you so much. Charlie Wells there with some of the main stocks that we're watching. Now, coming up, highlights from the Qatar Economic Forum here in Doha. We'll hear from some of the speakers, including Donald Trump Jr. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The Trump Organization isn't doing business with any government entities. They're doing it with private investors. I mean, many of the people in this room probably know them or have talked about them with that. And so, there is a very clear distinction between those things.
Our whole narrow-body fleet will be basically operated by Airbus. We continue to receive 350-1000, and there will always be a chance for another order from Airbus.
The U.S. policy direction around tariffs, immigration, now taxes that are causing a lot of focus on Treasury yields is probably here to stay. You have a substantial amount of uncertainty in almost every market.
Some of the leading business and finance figures we've heard from here at the Qatar Economic Forum in Doha. Now, Bloomberg's Romana Bersetchi is currently moderating a panel on building AI's backbone. Among the speakers, Doug Adams, the chief executive of NTT Global Data Centers, Mark Ganzi, the chief executive of Digital Bridge. Now, terminal subscribers, of course, can continue to watch that on Live Go. And the curtain is coming down on the 5th annual Qatar Economic Forum. We're joined by Ziad Daoud, our chief emerging markets economist at Bloomberg Economics, to talk about some of the highlights. Ziad, it's been so great actually being together for a couple of days and being in the region and understanding really what kind of buzz and deal making there is around the world. How much money are you expecting, coming from abroad to be here, being deployed here, but actually stay in the region?
I think in terms of the relationship of the region to the world, what is more important is the money that's going from the world to the region. So if I summarize the way I think about how the region interacts with the world, I think the region supplies the world with 4 things and gets from the world 2 things. It supplies the world with energy. It's an important provider of oil and gas. It supplies the world with capital, which is why, for example, President Trump was here last week, and we have this big conference here this week. It supplies the world with trade routes, like the Strait of Hormuz, the Strait of Bab el-Mandeb, Suez Canal, and it supplies the world with labor. 7% of the world's working age population is from the region. And it gets 2 things from the world. It supplies it with barrels, but it gets the price of oil from the world, which is important for the economies of the region. And it gets interest rates, which is important because monetary policy here is tied to the US, and because what the US does in terms of interest rates determines capital flows and outflows from the region.
Yeah, I mean, on energy, it's an extremely interesting point also because Qatar actually relies a lot on gas. It's LNG that they have the most of, which is linked to the price of oil, which could have a lot of tension with President Trump, who wants a lower price of oil. And within that, you have OPEC Plus also discussing what to do next.
Which is probably why we had the shift in OPEC Plus policy. Because for 5 years, for instance, since 2020, OPEC Plus had a clear strategy, which is basically they will get curb supply, increase prices, and maximize revenue. That changed. That changed last month when they decided to U-turn and surprise market with a larger than expected output hike. That change, and the change was confirmed actually this month when they did the same thing. And there's news today that they might do the same thing in July. And that not only affects oil prices, but also affects gas prices because long-term gas contracts are linked to oil. So it impacts the revenue of the region as well.
Talk to me about the deals. I mean, it does feel, and everyone was talking about the fact that Donald Trump came here, that a lot of deals were signed. Is this a long-lasting partnership? I mean, also a lot of questions about, the aircraft, but we can leave that to one side.
I think, okay, so there is fundamentally, there's a lot of trade and investments going from the region to the US. But if you think about the numbers that came out last week, the 600 billions and the 200 billions and the 1 trillions, I think there is some exaggeration there. We know there was some exaggeration in Trump's first term. He said there was $450 billion of purchases from Saudi Arabia to the US. If you look at the numbers in detail, they're probably less than 300 billion. The region is also spending more domestically, which means it has less money to spend abroad. And also, the biggest economy in the region, Saudi Arabia, has turned from a global supplier of capital to a borrower from the world. And that means, even with lower oil prices, the likelihood of achieving these big numbers, the hundreds of billions and the trillions, are less likely than before.
Yeah, I mean, it feels like there is a dependency, right, between the U.S. and actually the region because they need each other's capital.
Yes, there is the capital dependency between the U.S. and the region, but also importantly, the U.S. is the #1 security partner for the region. There is a sort of implicit pact between the region and the U.S. where the region secures energy supplies to the world, and in return, the U.S. secures the security of the region. But also, there is another big player, which is China. And trade with China has grown significantly in recent years. It has actually outgrown the trade with the U.S. And now trade with China stands at 4 times larger than the trade with the U.S.
And Ziad, very quickly, I mean, this is one of the most interesting dynamics, right, is that you speak to a lot of Qatari officials and they say we don't have to choose between the U.S. and China. Is that true?
I think I'd agree with them. The U.S. is an important security partner. China is the #1 trade partner. the region will find a way not to choose between the two great powers.
Yeah, I guess balancing is really the name of the game if you want to stay in business. Ziad, thank you so much. Ziad Dawood there, Chief Emerging Markets Economist at Bloomberg Economics. Now, coming up on Open Interest, Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. That's at 2 p.m. London time. A lot of the focus, of course, will be on dollar dynamics, on exactly how he sees everything with also treasuries. Now, our very own Jumana Barsetchi currently moderating a panel on building AI's backbone. Speakers, Doug Adams, the Chief Executive of NTT Global Data Centers, Mark Ganzi, the Chief Executive of Digital Bridges. Now, terminal subscribers can continue to watch that on Live Go. We still have a couple of hours of programming here from the Qatar Economic Forum. It is a wrap. It's the last day of the forum. You can continue watching it. I think it lasts until 3 or 2:30 p.m. local. Up next, Bloomberg Brief, and this is Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Good morning from our global headquarters in New York City. I'm Matt Miller in for Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Bond market warning. President Trump's tax plan triggers a broader risk-off tone, and there was a bad auction as well. Wait and see. Jamie Dimon tells Bloomberg the Fed is right to hold and warns himself of stagflation. Plus, an OpenAI acquisition. The company will buy an AI device startup co-founded by an Apple veteran making a push into some kind of magical new hardware. We don't know what it is yet. In terms of the markets right now, S&P futures are up just 0.1% after a really bad day yesterday. Maybe not so bad in percentage terms. It wasn't a 2% loss, but it was 485 stocks down, the second worst breadth of the year after April 4th. NASDAQ futures bouncing back as well, up 0.2%, and the small caps also gaining. For some of the stocks to watch, let's bring in Bloomberg's Joe Easton. Joe, what's on your radar?
Morning, Matt. So take a look at Manchester United shares in the pre-market after this game. Last night we were all gripped to the club. Lost the match against Tottenham Hotspur. Tottenham Hotspur getting their first trophy in 17 years. And Man United now missing out on the Champions League, on the extra ticket sales, on the extra players potentially coming in, and the €2.5 billion prize pot. So a football mover to start the show off. And then over in the data sector, we've got Snowflake looking a bit more positive, some strength in their orders. Their orders up around 25% in the last period for the cloud company. A bit of an AI boost for that one as well. We're up 9%. But that gain is actually surpassed by Urban Outfitters over in clothing retail. The namesake brand doing really well, performing, flying off the shelves, according to analysts. Urban Outfitters, we're seeing that stock gaining around 18% in the pre-market today, Matt. And as usual, all these stories will be on the Before the Bell opening wrap on the Bloomberg terminal shortly.
Yes, I have to thank you, actually, Joe, for Before the Bell. It is a gift to those of us in New York getting up early. Joe Easton there out of London. In just a few moments, we're going to speak with Katie McGee of JP Morgan Asset Management, and then later in the hour, Amy Wu Silverman of RBC Capital Markets. The bond market giving a warning sign to policymakers that fiscal sustainability issues cannot be ignored. According to Goldman Sachs, the move in the 10-year yield is nearing the pain threshold for the equity market. Let's actually ask Katie McGee about that right now. She is U.S. equity investment specialist at JP Morgan Asset Management, joining us out of London. Katie, what's your take on the 10-year yield moving up to 460, the 30-year yield moving up over 5%? How much of a concern is it?
Well, it has certainly been an interesting year for U.S. equity markets so far. Here we are in the middle of May. We're roughly flat on the year, but that masks a fair amount of volatility. We've already seen the market fall roughly 19% at the bottom, but over the last 6 weeks, we've seen the market rally by about 20%, quite a quick rally there. As you mentioned, we saw a little bit of a weaker day yesterday, and I think it's important for us to remember that there will still be a fair amount of volatility in equity markets, but important to look through that, focus on bottom-up company fundamentals, which is what we're trying to do for our clients.
Jamie Dimon says maybe a little too much complacency in that rally. Do you agree?
Well, I think overall, we came into the year in a pretty reasonable place for the U.S. market. Growth was above trend, employment had come down, inflation had come down from peaks, and the earnings that we were seeing from companies were pretty robust. We then, of course, saw a lot of fear come into the market, both around things like trade tensions, as well as things like DeepSeek, and that meant the market sold off pretty dramatically. But as you mentioned, quite a robust rally from there. Part of that has been driven by an easing of trade tensions. It's also been driven a little bit by what we're hearing from underlying companies. We're still in the middle or towards the end of Q1 earnings season. Actually, S&P 500 companies' earnings year on year have come in above what the market expected, looking like they'll grow at about 13% year on year. That's above where the market was picturing at around 7%. So a pretty robust backdrop, but I think still an element of caution. You need to think a little bit about things like valuations and navigating the market in a smart way.
So 13% is still pretty punchy for earnings growth. We've seen a lot of people downgrade expectations on the back of the Trump tariffs. Are you not concerned that that takes a big bite out of corporate margins?
Well, our underlying fundamental research analysts are out meeting with individual companies across the U.S. and around the globe all the time. Coming into the year, we had projected low double-digit earnings growth for the full year, and we thought that would also include a broadening out of earnings growth, not just seeing that strength of earnings coming from a handful of mega-cap tech companies, but actually a broadening out across industries and sectors. Now, as we've heard more uncertainty around trade tensions, we have reevaluated and underwritten those earnings. We've really thought that growth will probably slow from where it was. Inflation will probably remain a little bit stickier. There are individual things that different companies can do. Maybe some companies will take this on themselves, lower their margin. Others might pass on price, but give up market share to do that. At a top line level, we are now thinking that earnings growth for the year ahead will be something closer to about 5%, but then move back up into that low double-digit growth in 2026.
Is AI the only serious driver this year? I mean, what are the other tailwinds?
Well, AI, from a long-term perspective, we absolutely think that generative AI is the next wave of innovation, the next platform shift in technology. The same way that the internet has changed the world since the early 2000s, that mobile has changed the world over the last decade, AI will be the next wave. That said, in the short term, as investors, we need to be nimble around this because we know that the winners of tomorrow are likely not going to be the winners of today. And a big area to think about is that we have seen a tremendous amount of capital expenditure in AI already. From the biggest tech companies, they've already spent about $500 billion in AI. They've got another 320 or so billion to come this year. The big question is, when does that start translating into revenue? That means that in portfolios, we've taken profits in some of those names that have been the big beneficiaries so far, since they've already grown so significantly, but are actually thinking about reinvesting across the broader spectrum, whether that's the data centers, whether that's the electrification companies, the heating and ventilation companies that will feed into this, whether that's utilities, or also thinking about how we can benefit from shifts and changes in consumer spending patterns, maybe finding opportunities in restaurants or off-price retailers. So a lot of interesting opportunities across the space and across styles and sectors, not just in the largest mega cap tech names that have driven markets over the last couple of years.
Katie, what if we do have a Liz Truss moment here in the U.S. driven by the big deficits that Congress is trying to pass through now? If we have a jump in yields on the 10-year above 5%, what do equity investors do? Where do you go?
Well, overall, our expectations for growth across the U.S. have come down. Now, we expect growth to slow from where it was the last couple of years. We're not forecasting, a dramatic recession or contraction here, but probably a little bit more slowing in terms of overall growth. And you'll see that already reflected in the bond markets. An important thing to think about as equity investors, though, is firstly, we're starting at a pretty robust starting point. Profit margins are at near record levels for individual companies. Companies have already gone through the cycle of rehiring those employees that they maybe let go during the COVID pandemic, so we're not getting the sense that companies are necessarily going to make significant layoffs and cuts in the labor force, and that gives us a little bit of overall stability. We're also really focused on helping our clients get invested and stay invested through the market cycle. An important stat or one to think about is that volatility is normal within equity markets. Looking back over the last 45 years, in terms of intra-calendar year declines, on average, we've seen an intra-year decline of about 14%. But that said, 75% of the time, the market ended up in positive territory. So it's important for our clients to think about time in the money rather than trying to time around market volatility.
All right, Katie, thanks so much for joining us this morning. Katie McGee there from JP Morgan Asset Management. Now let's get to the other top stories trending on the terminal this morning. OPEC Plus is looking into another supersized output hike for July. The surge in production would be to the tune of 411,000 barrels a day. That's triple the amount initially planned. The group meets in about a week where a final decision will be made, and oil, you can see, is trading lower this morning at $60.69 on the NYMEX. Rio Tinto CEO Jacob Stausholm will step down later this year after more than 4 years at the helm. The world's second biggest miner has started a selection process to find his replacement. Shares in the London-listed firm are down slightly in early trading. And Jamie Dimon is warning that the U.S. economy may fall into stagflation. Speaking to Bloomberg at the bank's Global China Summit in Shanghai, the JP Morgan CEO backed the Fed's decision to wait and see before cutting rates.
I don't agree we're in a sweet spot, okay? And I think you have to separate two things. The economy has been doing well. All the facts, we have effectively been in a soft landing. And I've already mentioned huge deficits. We haven't finished quantitative tightening yet. There are huge geopolitical issues. There are these inflationary factors out there, and they have to react to all of that. So I think they're doing the right thing to kind of wait and see before they decide.
Coming up, the House debates President Trump's one big, beautiful bill, and we'll give you all the details. This is Bloomberg.
American people don't buy this because they know where these tax cuts are going and intended to help people at the top when it is really the people at the bottom and then the middle who need help.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. This week, Bloomberg brings you live coverage from the Qatar Economic Forum. Bloomberg Horizons Middle East and Africa and The Pulse will be broadcasting live from the conference floor. Then, throughout the day, we'll bring you all the highlights from the key policymakers and market movers on the issues confronting the global economy. Live coverage from the 5th edition of the Qatar Economic Forum continues this week right here on Bloomberg Television. Context changes everything.
The members of the SALT caucus, negotiated yesterday in good faith with leadership, with the administration, and we settled on something that we believe in, that we support. Obviously, we're waiting for the final details to emerge out of the Rules Committee, but obviously we made great progress yesterday, and I feel much better about where the bill is as a result.
And that was New York Representative Mike Lawler after capitulating yesterday, speaking on balance of power, essentially agreeing to make permanent a cap on the state and local tax deduction that New Yorkers have relied upon for over a century until 2017. He gave it up for President Trump. We are still waiting for those final details as the president's big, beautiful bill debate continues in the House. You're looking at a live shot there right now. For more, we're joined by Bloomberg Global Business Editor Josh Galoo. Josh, I guess, the bottom line here is this is a piece of legislation that is going to significantly expand the deficit. We're already looking at more than 100% debt to GDP ratio here in the U.S., and this legislation is going to blow it up potentially to 125% within the next 10 years.
Yeah, there's little to argue that that's not going to happen. This, estimates are now that it's going to add $2.7 trillion to the deficit over the course of 10 years when when really Republicans and Democrats are talking about trying to lower it. And of course, as you know, coming off of the downgrade by Moody's last week, deficits are really in focus here. So, the extent to which this is sustainable and at what point the U.S. is going to have to deal with this going forward is a big question out there. The conservatives within the Republican Party on spending, they seem to have been assuaged by cuts to Medicaid that under this latest negotiation have been sped up. So they're going to kick in 2026, December of 2026, rather than 2029, notably coming after the midterm elections, because this was a massive political liability that the Republicans are now trying to avoid in getting this through. There are roughly 80 million Americans that receive Medicaid, including about 8 million children on the CHIP program. So this is something that has massive political ramifications. They're trying to push it back, and they're looking at that as one of the biggest ways of controlling spending going forward.
How much does it matter what the Congress decides to do now? Because after the House gets done with this, they have to give it to the Senate, right? And the Senate's likely to mark it up significantly before handing it back to the House.
That's right, and they've taken some steps. Senate's been lobbying pretty heavily on certain things, and and they've made some concessions. So, for instance, the most recent one is John Cornyn from Texas has gotten in this $12 billion going back to states that have spent money on border control in the past, on border security. So, they've made some concessions all along, but there's no way that this doesn't get significantly marked up in the Senate going forward. Whether or not it's going to have changes that are going to require some sort of that are going to derail it before getting it to Trump's desk in July is another question. We've already seen him come in this week and twist some arms. He's ready to do the same thing in the Senate. And of course, anybody who stands in the way of one of his biggest legislative priorities is going to face a massive political backlash.
All right, Josh, thanks very much for joining us on this. Obviously, we're going to be talking about it for a much longer time to come. Bloomberg editor Josh Galou talking about this one big, beautiful bill. OpenAI is buying the AI device startup co-founded by former Apple veteran Johnny Ive, joining forces with the legendary designer to push into hardware. It's a $6.5 billion deal. It's the largest in OpenAI's history. For more, we're joined now by Bloomberg Daybreak Europe anchor Tom McKenzie, who focuses really and specializes in tech. Tom, that's your beat. So, this is pretty exciting, I guess, because Johnny Ive has such an incredible reputation, and OpenAI, artificial intelligence, has such potential, right?
This is quite the power couple. And if they can deliver on what they're promising in terms of potentially 100 million units, according to the Wall Street Journal reporting, with production and shipments starting in 2026, then we could look back on this moment as a significant chapter in terms of how AI is being embedded into our devices. It's a reminder of the ambitions, of course, of Sam Altman and the team at OpenAI as they push and start to nibble at the edges, not just of search, but of terms of commerce, and now on the hardware space as well. Johnny Ive saying that his 30 years of experience has brought them up to this point. They're looking at a device that they haven't detailed yet, but a different form factor is what Johnny Ives and Sam Altman have been talking to Bloomberg's Mark Gurman about. And again, potentially with production coming out in 2026. Ive will also be in charge of designing not just the hardware at OpenAI, but also the software as well. And Sam Altman's been quite clear in recent weeks and recent months with his frustration at the UX, or the user experience, of the chatbot and the way that their customers, consumers on the business level and on the individual level are using that, and he wants to improve that. So that's significant as well on the software and hardware front. And then, of course, this opens up questions about the challenges for Apple, Meta, and others.
On the other hand, we have no idea what this is going to be, right? I mean, it's not going to be a phone. I believe they've said that. It's not going to be smart glasses, the Wall Street Journal reporting today. So what is this magical device that they're planning on shipping, 100 million of next year?
I think you have to extrapolate from Johnny Ives' own career and his own products that he worked on, from the iPod to the iPhone, notably, of course. So seamless form factor, something that has very high quality and high-end components in it. You can think of glass, ceramic, high-end steel. Those elements are likely to be part of whatever form factor they come up with. As you say, the reporting suggests they want to steer away from screens. It's likely then to involve voice and interactivity with voice. Apparently, reportedly, something to be small enough that you can put on your desk, next to your laptop, next to your phone, into your pocket, something you feel that you will be attached to that has value, but also interacts seamlessly with you and your environment with privacy controls as embedded as well. That is all speculation, but that is based and iterated on in terms of extrapolating from what Johnny Ives has done in the past in terms of what's driven him. So I think that can be in focus. But again, for Apple, this really puts the feet to the fire, I think, of Apple. They have that touch point, hundreds of millions of consumers. They have the hardware. Now they need to get the AI software component right. Meta also, with the glasses, will be doubling down, you would have thought, on their wearables and devices. This is a reminder that we're getting to this point now. We're moving away from the chatbots. We're into a space where AI is being integrated into hardware.
All right, Tom, thanks very much. Bloomberg Daybreak Europe anchor Tom McKenzie talking about this OpenAI I/O tie-up. Coming up, a look at what else is making headlines around the world on this Bloomberg Brief.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Time now for our front page news. First up, the Washington Post and many other front pages leading with 2 Israeli embassy staffers getting shot and killed outside the Capitol Jewish Museum in Washington. A single suspect is in custody. The shooting drew immediate bipartisan condemnation in Washington, calling it an act of anti-Semitism. Next up on the Wall Street Journal, President Trump telling European leaders that Russian President Vladimir Putin isn't ready to end the war. It runs counter to what Trump has often said publicly, that he believes Putin genuinely wants peace. The White House declined to comment. And on the New York Times, President Trump confronted South African President Ramaphosa in a televised Oval Office gathering. Trump showed a video and leafed through printouts that he claimed showed the widespread persecution of South Africans. This is the Bloomberg Brief.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Matt Miller in for Danny Berger. Let's set your agenda for the day. A bond market warning, President Trump's tax plan triggering a rough auction and a cautious tone in the markets. Wait and see. Jamie Dimon tells Bloomberg the Fed is right to hold and warns himself of stagflation. Plus, the OpenAI acquisition. The company will buy an AI device startup co-founded by Apple veteran Johnny Ive, making a push into hardware. Let's take a look at what's going on in markets here. You do have bounces back from the bad trade yesterday. We were down on the S&P 500, 1.6% at the close, and 485 stocks out of 500 lost ground. NASDAQ also bouncing back up almost 0.25% now, and Russell 2000 futures up. If you take a look at some of the other assets that are driving this market, really the 10-year yield is the most interesting right now at 457.86. It had hit 460 earlier this morning, and then NYMEX crude falling as we get even more output increases out of OPEC+. For some of the stocks to watch, let's get over to London right now. Bloomberg's Joe Easton has a look. Joe?
Hey, Matt, so the one that's really jumping out to me this morning is Manchester United, a football mover to start off. Man United losing that Europa League final in Bilbao, Spain last night, meaning they miss out on the Champions League and potentially a €2.5 billion prize pot that they could have got their hands on, a slice of that at least. And also, potentially, that's going to hit the ticket sales. It's going to hit their ability to attract new players and seal commercial agreements. And Man United falling in the pre-market, about 7% at the moment. Then we've got Snowflake over in data and AI, the company rolling out a bunch of new products using AI to harness their data capabilities, according to the CEO. The earnings showing a 25% jump in growth, and we're seeing that stock up 11% today. And then over in clothing retail, Urban Outfitters rallying as well, close to 20%. We're up 18% at the moment for that one. The namesake brand doing really well, Matt, flying off the shelves according to analysts, and a big boost for their EPS as well. Keep an eye on that one as we head toward the Open in New York.
By the way, dude, big prize missed out on by Man U in soccer, and I know you all pay very close attention to that, but the story in New York the story in New York is the Knicks loss. It was heartbreaking in overtime, and the entire city here.
I'm the wrong man for that one, I'm afraid.
Yes, well, they score points in basketball. It's a game where they actually make goals. Joe, thanks very much for joining us. Bloomberg's Joe Easton wrapping up some of the stocks to watch. Investors are pricing in a higher risk of fiscal deterioration, leading to higher yields and a potential rebellion against government debt. A little bit of a Liz Truss moment is potential. According to Goldman Sachs, the move in the 10-year yield is nearing the pain threshold for the equity market. They say that is definitely 5%, but maybe even 4.7. Let's talk about that now with Amy Wu Silverman, head of derivatives strategy at RBC Capital Markets. And Amy Wu, we saw yesterday this one big, beautiful bill, which is going to drive superinflated deficits, potentially drive superinflated deficits, rattling the bond market, a weak auction. What are you seeing in the derivatives trade?
Yeah, not surprisingly, since the fixed income market is really driving the equities market right now, you're seeing skew pick up, so demand for hedges pick up. You're seeing us cross that psychological threshold again in the VIX. And I think this kind of makes sense. If you go back to Liberation Day, you know, what finally shook the markets was not equities, it was treasuries, and that's kind of leading in again to sort of the sell-off we saw yesterday in the rally.
My co-anchor, Sonali Basak, loves lately the term slow bleed. I prefer drip feed. We have to have this legislation now go, it has to get passed maybe today, then go to the Senate. They're going to make a lot of changes. They're going to send it back. They've got to, do a lot of horse trading. So it's going to take a while. How do you think markets are going to react to that? Because there's not one kind of mini budget moment.
Yeah, I would say it would react to me similarly to how it's been reacting to tariffs, insofar as, you're kind of just stationed in this purgatory, Matt, where, you get these elevated levels of volatility. But the issue is when there are days when nothing happens, then it sort of just peters off again. And then as soon as you sort of get another data point, we can see that spike again. I call it driving around these volatility potholes, but I think we see that continuing. And obviously at the same time as we wait for news on the big, beautiful bill, we're still waiting for news on more tariff deals. And it's just a highly charged environment where these headlines will make a difference day to day.
Are these the two tails? I know you like that phrase, a tale of two tails. Are those tails tariffs and, out of control government deficits?
Yeah, I would say those are definitely part of the two tails. But, when I talk about the tale of two tails, I sort of mean the left tail and the right tail. So you've sort of seen the markets waffle between this exuberance, I would say, post-Liberation Day to, the right tail back to the left tail. I think we're kind of sitting in this left tail now. It wouldn't surprise me if, any incremental good news gets people to put that chase on again. That's the one thing that I think has been a pain trade of this market, and one that you have to continue to watch for, even when there are days of sell-offs. I think investors know that they also can't miss out on the upside, and that's what's been making this market really tricky to trade. It's made it a pickle.
So, okay, those are two, I guess, left tails, deficits and tariffs. What's the right tail?
I think the right tail has just been what we've seen post-Liberation Day, which is you saw this massive degrossing by institutional investors. You didn't see it at all from retail investors. At least round one, they were kind of right. And then the issue is because of the benchmark concentration in stocks like Mag 7, like NVIDIA, which still has yet to report, if they had to jump into the pool real quick, that's your risk to the right tail. And I don't think that's gone away either, even though we do have these two left tails to deal with right now.
What are you seeing in terms of investor reaction to this volatility? Are they selling it here? Are they buying it? Where are we in that sort of stage, in those stages?
Yeah, I would say, one thing I went out to investors with as the right tail started climbing was I just said, look, we now have the left tail again back to below average levels on a 5-year basis. Does that make sense given what we still do not know about tariffs, what we still do not know about the deficit, what we still do not know about the big, beautiful bill? So, really a week ago, post that China-U.S. news of that kind of trade going down to 30% was an opportune time to redeploy those left tail hedges. At the same time, I think, investors who have to jump back in because they degross, they're still sitting on those call buying on the right tail. But in general, a lot of times when you see volatility flag really quickly, but we know there's so much uncertainty on the horizon, it still makes sense to place those hedges, in particular with all the kind of news and catalysts that have to come out and we'll have to deal with.
But the VIX should be, there should be more volatility on the horizon than now, right? In times of calm. And you point out the VIX finally uninverted, so we're looking at a lower VIX now than longer-term options are suggesting?
Yeah, so short-term VIX is lower, but longer-term VIX, longer-term volatility is higher. And one thing I will say is while short-term, you also saw hedges decline, the skew in S&P, so that demand for hedges longer-term also rose. It's the point the market is making is, look, we're having a difficult time figuring out when all these events are going to take place, but long-term, we are pretty nervous. I think that's the bottom line. I think that's what these metrics are telling you. And nothing has been resolved per se, right? They've just been can kicked down the road, and that doesn't make the market feel better in the longer term. So T plus 6 months, it just makes them a little bit more angsty.
All right, Amy Wu Silverman, always great to spend time with you in your brain-bending world of derivatives. Amy is the head of derivative strategy at RBC Capital Markets. Coming up, the House debates President Trump's one big, beautiful bill, and we may get a vote soon. This is Bloomberg.
Small family farmers are in distress. Businesses can't invest. People are not hiring. You are actively crashing the economy, driving America toward a recession.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
The members of the SALT caucus, negotiated yesterday in good faith with leadership, with the administration, and we settled on something that we believe in, that we support. Obviously, we're waiting for the final details to emerge out of the Rules Committee, but obviously we made great progress yesterday, and I feel much better about where the bill is as a result.
That was New York Representative Mike Lawler there, speaking on balance of power. Great name, considering what he's done is essentially sell out some more power of the states of New York and give it up to the federal government. The debate over President Trump's tax bill continues in the House. You're watching a live shot right now. For more, we're joined by Bloomberg Global Business Editor Josh Galou. And Josh, they're still talking there, but it does look like we're going to get a vote fairly soon. How much closer does this actually move us, though, to the end?
This is a massive hurdle. There's a long way to go, as you suggest, right? Getting it through the Senate. But this is a huge hurdle that Johnson has been able to appease the SALT caucus and move that cap from $10,000 up to $40,000 on state and local deductions. This is something that wasn't even, it used to be uncapped, right? And it was Trump in his 2017 bill that decided to cap it at $10,000. That was primarily then aimed at hitting Democratic states with high tax rates. But, since then, it's angered a lot of people. It has been, there are a lot of Republican representatives there that want to help their constituents. It's been a major sticking point. When it moves to the Senate, look, there are other things to consider, and there is going to be pushback, for instance, from Ron Johnson, Wisconsin, who's on the tax subcommittee on spending, because this bill will, all estimates, other than the administration's, of course, which is projecting a lot of growth to compensate, but all estimates are pointing to massive increases in the deficit over time as a result.
Let's talk about the Chip Roy faction. You mentioned the deficit, and it looks like this will add, I think, $3.3 trillion to the deficit over 10 years if the temporary measures aren't made permanent, which it seems like, well, we can see from this example that they almost always are. In that case, it would be, I think, $5.2 trillion that this adds to the deficit. Is Chip Roy, are these, deficit hawks going to be able to block that burgeoning deficit, potentially burgeoning deficit, or have they essentially capitulated as well?
For now, it looks like they've capitulated because, they've gotten really quiet since Johnson has introduced changes to basically speed up the changes to Medicaid, which are, a big part of the cuts. There's Medicaid, the work requirement that's now going to be in 2026 after the midterm elections instead of 2029. They're speeding up the cuts to clean energy subsidies. So these are the things that they're pointing to in terms of reducing costs. But, as I said before, most projections are saying this is going to dramatically expand the deficit in the coming years. So it's hard to see how people in, the Chip Roy faction, those who are really concerned about reining in government spending, how those representatives are really assuaged by this.
All right. Hey, Josh, we're going to keep talking to you about this in the coming weeks and months. Thanks very much for joining us. Bloomberg Global Business Editor Josh Galou talking about the one big, beautiful bill moving through Congress. Now, let's get to tech, because OpenAI is buying an AI device startup co-founded by former Apple veteran Johnny Ive, joining forces with the legendary designer to make a push into hardware. It's a $6.5 billion deal, the largest in OpenAI's history. And for more, we're joined now by Bloomberg Daybreak Europe anchor Tom McKenzie. He focuses in on tech. So, Tom, how much could this shake up the industry? I mean, OpenAI right now is maybe a $300 billion company. Apple is a $3 trillion company.
Yeah, this is potentially a huge threat to Apple, absolutely no doubt. But it's also a threat to other incumbents out there as well, because it's a reminder of the fact that Sam Altman and the team at OpenAI are determined to chip away not just in search, not just in potentially e-commerce, so think of Amazon, but also now in the hardware space, and that's what takes you, of course, to Apple. So absorbing the team from I.O., which, as you say, was set up in 2024 to focus on devices that can integrate with AI. Johnny Ive will be independent, but will have a huge role in overseeing the design of both the hardware and the software at OpenAI, and he brings on board a number of his very, very experienced team and engineers as well. So the way that they are framing this, Ives and Altman, is that this is a marriage met in heaven, essentially. Two leaders, one, of course, on the innovation around AI, and the other, Johnny Ives, arguably one of the most influential, if not the most influential designer, certainly of our generation. But they have to meet the aspirations and the ambitions they set themselves with reality. They haven't actually produced anything yet. They say it's going to happen in 2026, potentially, according to the Wall Street Journal, 100 million units. Not just one device, but a family of devices.
All right, it'll be very interesting, obviously, to see what that device is. Tom, you and I have been talking about it this morning. It's apparently not going to be a phone. It's apparently not going to be smart glasses. I know Carolyn Hepker on your radio program this morning was suggesting it could be a wand or an orb. I'm looking forward to it, as I'm sure are you. Daybreak, Bloomberg Daybreak Europe anchor Tom McKenzie there on the big tech news this morning. In the world's biggest bond market, investors are pushing back against President Trump's tax cut plan. Bloomberg's Haslinda Amin spoke with JP Morgan's CEO, Jamie Dimon, in an exclusive interview at the bank's Global China Summit in Shanghai.
You talk about that kind of complacency. I'm talking about the asset price in the United States, and it's a long list of things. It's, QE, it's fiscal deficits, it's global fiscal deficits, it's, potential the trade wars. It's these huge, complex geopolitical situation, and I look at all of those probably not being properly priced into the marketplace. But we don't know what's going to happen. So, I saw last night's reaction. I don't worry about one-day move in bond markets. So,
you don't worry about one day, but when you take a look at yields, they are at higher levels than they were before Liberation Day. I mean, we talked about how 30's higher. And some are talking about 10s getting to 5s, 30s getting to, 7%. How are you assessing that? I mean, how high do yields have to go before they reach breaking point?
Yeah, I don't know the answer to that. No, we assess, the way we run the company is we prepare for a full range of outcomes, regardless of what you think. I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting stagflation. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. And the infrastructure needs are inflationary. And now you have offsets. You have oil prices down quite a bit, which is quite deflationary. But with all those things taking place, yeah, you may be surprised.
As we said, it is a higher yield environment. And you have said before that we could see some sort of rebellion in markets around the world. Is that still a possibility? How might that look like? Yeah,
so I would not call it a high-yield environment. I mean, if you look at economic history, rates have been far higher than this, and they surprise people over time. And like I said, I think a lot of the longer-term trends have inflationary attributes to them. And so the other thing for your person on TV, credit spreads are low. So you can have two things go against you, which is credit spreads gap out and rates are going up. And so we'll see how it plays out. So I don't want to guess how it plays out. I'm on the cautious side. I'm a little skeptical that we're going to have kind of just an ongoing soft landing here.
I'd be remiss not to ask you about the Fed. Given the higher yield environment, which You say it's not, but it is still higher than what it was before. Would
it go higher?
Will it go higher? And also, will it force the Fed's hand?
Yes. I mean, there's always a notion that somehow the Fed is omnipotent and can do whatever it wants. And they do set short-term rates, but they also have to follow the facts. So they raised rates because inflation went up, and they can't control. Even today, trillions of dollars of these bonds are sold every day. That's done by investors around the world. They cannot control all of that. Foreigners own $35 trillion of U.S. financial tradable assets. And so, they have to react to reality, in which and that's not a criticism, they say they're data dependent, but they have to wait and see exactly what happens and then do the appropriate thing.
But the thing is, their reality is different from the reality you have in mind. If you take a look at what Neil Kashkari said, he said the U.S. economy is on solid footing. And some other Fed officials have said that in terms of Fed policy, it is in a very sweet spot. So their reality is quite different.
I think, I don't agree we're in a sweet spot, okay? And I think you have to separate two things. The economy has been doing well. All the facts, we are effectively been in a soft landing. That does not tell you what the future is going to be.
That was J.P. Morgan CEO Jamie Dimon speaking with our very own Haslinda Amin in an exclusive interview. Coming up, we'll get you set up for your trading day with the Fed speak and the eco data, as well as the earnings on deck. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Let's get a look at what's ahead today in terms of Fed speak. Richmond Fed President Tom Barkin kicks it off at 8 a.m. Eastern. Then New York Fed President John Williams speaks at 2 p.m. this afternoon. Plus, we get more economic data today, as we do almost every day. U.S. jobless claims coming out at 8:30 a.m. These are a favorite hard data piece for economists. And then existing home sales at 10 a.m. at a time when the spring selling season looks pretty bad. We still have retail earnings to come out. Ralph Lauren comes out today, this morning, as well as BJ's Wholesale Club, Advanced Auto Parts, and Ross Stores. All of those report today. And then in terms of individual movers, Nike, the sportswear brand, plans to sell products on Amazon's U.S. site for the first time in more than 5 years. Snowflake, the cloud software company, giving a strong outlook for quarterly sales after launching a slew of new products over the last year. And then Lumen. AT&T will buy Lumen's consumer fiber operations for almost $6 billion. I'm going to speak with the CEO of Lumen, Kate Johnson, on Bloomberg's open interest today at 9 a.m. New York time. We are looking at futures that are higher right now. You can see the dollar index is up as well as the 10-year yield comes down, but still at 458, and crude falls as well. That's it for the Bloomberg Brief. Surveillance is next. This is Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Our political system is showing absolutely no signs of slowing down the borrowing, and this is going to continue to rattle bond market holders.
What the bond market is worried about is that over the longer term, it will increase the deficit.
Congress is not doing its bit, so the bond market has to force Congress to do its bit.
And so I think that's why the long end is scary.
The number one risk right here and now is that long-term bond-term premium.
We could have a debt crisis scare.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, it's Washington versus Wall Street.
You have one or two no's, you never can be certain. I mean, this is a massive piece of legislation with lots of moving parts. So we'll see what happens. But I think we're going to get this job done, and we're going to do it by Memorial Day.
The White House doubling down as Congress makes a move to vote on the tax bill. The bond market pushing back, investors sending 30-year yields back through 5% as the issues are beginning to pile up worldwide. From London all the way to Tokyo, the bond jitters go global.
Absolutely. And right now, what everyone in the United States is focused on and whether or not Speaker Johnson, Jonathan, can land this plane, as he said, this massive tax cut and spending bill. One thing we should note, everyone that's waking up and excited, potentially there might be a vote. Hakeem Jeffries is speaking right now. He is the minority leader, and he doesn't have a clock. He can speak for as long as he wants, so he might want to wake up for more Americans to explain why the Democratic Party does not think this bill should pass. But momentum is behind Speaker Johnson, and he's going to get likely his vote before Memorial Day.
You're looking at live pictures down in Washington, D.C., and here's some live pricing right here on Wall Street. Bond yields, the 30-year, back through 5%. Yields up yesterday, down a touch this morning by a single basis point, 5.08%. My question, I think a question for a lot of people on Wall Street, how much does this matter to these people in that room right now?
I really don't think they care. There's a few individuals like Representative Chip Roy, who yesterday quote tweeted someone who was talking about the terrible 20-year auction we had and said, noted. But does that mean that these individuals are going to stop with this spending package? No, they just are like, yeah, the bond market may be a little bit yippy, but we're all systems ahead and we're moving ahead with our package.
We certainly saw those yips in yesterday's session. We'll see if we have more to come in today's. Coming up this hour, Seema Shah of Principal Asset Management. As bond markets rattle investors, Rob Casey of Signum, and why the big, beautiful tax bill might not make its Memorial Day deadline. And Sam Zeef of JP Morgan on the need to diversify currency exposure. We begin this hour with our top story. Bond yields back through 5% as House Republicans look to strike a tax deal. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, take us into the room. How soon before we get that vote?
Yeah, hey, John. Well, House Republicans are expected to vote really any moment now, but as Anne-Marie mentioned, it's really going to be up to when Democratic leader Hakeem Jeffries stops speaking, and he has unlimited time on the clock, which could delay this further. But ultimately, the signs are looking rather positive for House Speaker Mike Johnson, because this legislation did pass a key procedural hurdle earlier this morning. It was seen as a test vote to get this bill onto the floor, and ultimately, he only lost one Republican member. That was Thomas Massey of Kentucky. No one was really expecting him to vote for this legislation. He has long said that he will not support a bill that adds to the deficit. So we're going to have to wait and see exactly when this vote is going to happen. But at the moment, John, it's looking positive for the speaker.
Tyler, 18 hours they spent in the Rules Committee. Then we finally got the text very late last night of what changes we heard that were being done behind the backroom dealings. What actually happened? Where we are SALT and where are we in Medicaid?
Right, exactly. Those were the two big provisions that we were waiting to see what they agreed to. Now, when it comes to SALT, we have learned that they will lift that cap from $10,000 to $40,000. That number would then phase out for individuals that have incomes over $500,000. Both that income threshold as well as that cap will increase by 1 percentage point each year for the next 10 years. Now, that would be to appease those Republicans from those high tax states like New York, New Jersey, California that were holding up this bill in a bid to appease the other members that were those fiscal conservatives that wanted to see some deeper savings policies. We have learned that they will speed up the implementation of Medicaid work requirements to December of 2026 instead of the originally proposed 2029. They're also going to eliminate those clean energy tax credits under the IRA by 2028. To be sure, not everybody is happy with this final agreement, but it does appear that this could be what ultimately gets the deal done because, Anne-Marie, as you know, President Trump really ramped up the pressure on these House Republicans yesterday, saying that anyone that doesn't vote for it, it would amount to a, quote, betrayal to his ultimate economic agenda.
Tyler, thank you. Stay close. Tyler Kendall down in Washington, D.C. So here's the scene. Hakeem Jeffries, the House Minority Leader, holding the floor at the moment. Early morning in Washington, D.C. They've been up all night. He's going to hold the floor for I imagine the next hour or so. Then at some point, he's got to give it up. And we're going to see a vote in Washington.
At some point. Maybe a minimum he'll speak for 60 minutes. He can go much longer. He actually just recently said while he was speaking on the floor, every time I'm interrupted, it'll add another 15 minutes to my remarks. But once he is done with this, and a lot of this is performative, but he does want to make his voice heard to the American people, and it's very early right now. So maybe he goes for a few more hours. Then there's going to be a vote, and that vote's likely going to pass. But Jonathan, this is the easy part for the House. This is the easiest week potentially for Speaker Mike Johnson when it comes to the one big beautiful bill. The Senate is going to jam him in a few weeks or months' time with all the tweaks and edits that they want to see.
King Jeffries is being heard right now. The voice of the bond market was loud and clear in yesterday's session. Here's the view on Wall Street. Seema Shah of Principal Asset Management writing, the fiscal deal will very likely expand the deficit, attracting bond vigilantes and driving up long-end bond yields. Seema joins us now for more. Seema, welcome to the program. A 20-year auction. Now, a 20-year maturity for a lot of people in the bond market, not a great maturity. A weak 20-year auction for a lot of people in the bond market, not worth paying attention to. Why was it so important this time around? Is it a reason to sell or an excuse to sell?
Hi, John. Well, I think you're right. I mean, I think when we're thinking about this, is it a cause? Is it a symptom? And as you said, a weak 20-year auction is not unusual. It typically has less demand anyway. But we've already seen in the last couple of weeks, and particularly this week, especially after the Moody's downgrade, that there's been this narrative of concerns, which has been like a hum, which has been growing louder and louder, of concerns around the deficit. Now, if we had spoken maybe 3 or 4 months ago, at the end of last year maybe, and somebody had said, you know, when does the US really need to confront its debt issues? A lot of people would have said, you've got another decade or so. Increasingly, it feels like this administration is going to have to confront the problems because the bond market has lost patience and is really going to force the issue through to make sure that there is some realization that continuing to expand its deficit, its debt numbers indefinitely, is simply not something which can continue.
Seema, let's talk about levels. Life above 5% this cycle on the long bond hasn't been sustainable. How problematic is this level? How self-limiting is this move?
Well, I mean, if we think about it in terms of the 10-year, there's always some thresholds which are thrown around. Typically, it's been the 5% level is the bit where the equity market really starts to stumble. I think increasingly, because we've seen growth downgrades over the last couple of months because of all the issues around tariffs, we're probably looking at a slightly lower level in terms of equity market resilience. For us, we're looking at a 475 handle. Of course, it depends the speed at which we get to that point, and of course, what the reason is. If the reason is because of better growth expectations, that's okay. If it's really around concerns around the fiscal side, well, that's a slightly different story. So we think that the equity market already is being somewhat pressured, but I think the pressures would likely grow if you start to cross that threshold.
Seema, we saw the bond market be one of the reasons why Donald Trump, the president, actually reversed course when it came to tariffs. Do you think potentially the bond market has a vote when it comes to this fiscal package?
I think it definitely has some kind of say. And, you know, as to your point, I think one of the reassuring factors for investors over the last couple of weeks is trying to understand and know that Trump does have a pain threshold, and it's not necessarily the equity market, it's actually the bond market. So seeing yields rise, potentially continue to rise, could be the point where you do start to see a slightly different narrative. It is difficult how they step back from here. When I'm looking at the US, unfortunately, I'm reminded a lot about the UK. In that situation where the UK government has got a deficit issue, it needs to introduce some kind of tax increases. The market doesn't like that because of the impact to growth. If it increases tax, well, then it's worried about deficits. So the UK is increasingly locked in a very, very tough place. And unfortunately, to me, it looks like the US is heading very close to that point too.
You say there's a level. What is that level?
Well, in terms of the bond market?
Yes, for the Trump administration and potentially Republicans in Washington.
Well, I think for Trump is one thing, for the Republicans in Washington, it may be a slightly different level. 475 is the handle that we typically are looking at, and especially now we think that the level has come down from a 5% handle just a few months ago or so. But for the Republicans in Washington, I don't know how much notice they could be taking of the bond market. They know it's happening. Whether or not they actually start to act on it is a different one. So really, I think it comes down to the president and how much comfort he feels with regards to how bond markets are moving.
If you're just tuning in, welcome to the program. You're seeing live pictures in Washington, D.C. of the House Minority Leader, Hakeem Jeffries, getting close to wrapping up his comments on the House floor, using the phrase as I close.
As I close. So he's in his final remarks, which means, and I do see here that Speaker Johnson is back on the floor, checking his phone, potentially making sure all of his Republicans are coming to the floor. We could see a vote in the next hour. If he wraps this up, then we're going to go into the procedure of this vote hitting the floor.
Seema, a lot of people are talking about a so-called reverse TARP moment. Not the market forcing Congress to pass a bill, but the market forcing Congress not to. Do you think we're being a little bit too dramatic? How close do you think we are to a moment like that one?
I'm not sure that we're that close. I mean, when you've seen the moves in the Treasury market, it's shocking to some extent, but these aren't levels that we haven't seen in the last year or two. This has been a level that keeps getting pushed. So I don't think it's that point. And you also have to remember that this is a global move. Trump can certainly point to the fact that we've seen the sell-off in Japan, we've seen the sell-off in the UK as well. So I'm not sure how close we are to that point, but I think from Trump's perspective, he does really need to think about the growth story, because one of the factors is that if you have really strong growth, a lot of the equations become much easier. If you've got growth for 2025 sitting around a 1.5% handle and looking to be below trend for the next couple of years, well, then he needs to think about what are the growth-friendly measures he's going to bring in. What does he do with tariffs? What does he do with the tariff revenues? So I think there's a lot of questions which doesn't necessarily come down to specifically this tax bill, but what are the other measures that he needs to consider in this whole process?
Seema Shah, appreciate your time, as always. Seema Shah there of Principal Asset Management, really underlining the global aspect of all of this. It's not just these scenes right here down in Washington, D.C. It's Japan, it's the UK, it's global.
That's a few people actually messaged me yesterday and saying, Amber, I know you're so focused on the fiscal package, but when it comes to bond yields, there are other issues at play. There was a really bad auction in Japan. There was higher inflation in the United Kingdom. You cannot look at this as idiosyncratic just to the United States. But right now, we do have House members debating this package, which the CBO, Jonathan, says is going to add trillions over the next 10 years.
King Jeffries wrapping up his comments on the House floor. Let's cross over back down to Washington, D.C. to catch up with Tyler Kendall. Tyler, walk us through the process here, the procedure. They've been up all night. What happens next?
Right, so they're going to start to vote on this package. And John, the magic number, if everybody shows up that we are expecting to, is going to be 217. That is the number that House Speaker Mike Johnson is going to need in order to pass this bill on the full House floor. Now, that means that with the 220 majority, he can only afford to lose 3 Republicans. We already know one is a firm no. That's Thomas Massie of Kentucky. He did not vote in favor of what was that procedural vote that we saw earlier this morning. But that still gives him some buffer room here. And at the moment, it is looking likely, because those fiscal hawks were really the ones that we were expecting could be some of those dissenting votes, those names like Chip Roy, Ralph Norman. But at the moment, it does seem that they might have been appeased by that compromise agreement to speed up those Medicaid work requirements, as well as speed up the ending of those clean energy tax credits under the IRA.
Tyler, stay close. We're getting closer here. Speaker Johnson on the floor speaking right now. We'll come back to those pictures in just a moment. I want to get you an update on news elsewhere with your Bloomberg Brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. The House is in session right now conducting a final debate ahead of a vote on a new version of President Trump's One Big Beautiful Bill. Minority Leader Hakeem Jeffries just ended his speech. The new version of the bill includes a higher $40,000 limit on the SALT deduction. It speeds up work requirements for Medicaid and puts an end to Biden-era clean energy tax breaks. Meanwhile, U.S. Secretary of State Marco Rubio said Venezuela's oil export license will expire on Tuesday, defying earlier expectations that it would be extended. Rubio posted on X the pro-Maduro Biden oil license in Venezuela will expire as scheduled on May 27. The tighter time frame puts pressure on Chevron's operations in the sanctioned nation. And a deadly shooting in Washington. 2 staff members of the Israeli embassy were shot and killed while leaving an event at the Capitol Jewish Museum. The suspect was identified as 30-year-old Elias Rodriguez of Chicago. Police say when he was apprehended, he yelled, "Free, free Palestine." That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, pushing the tax bill over the line.
We have 1 or 2 no's. You never can be certain. This is a massive piece of legislation with lots of moving parts. So we'll see what happens. But I think we're going to get this job done, and we're going to do it by Memorial Day.
Up next on the program, Rob Casey of Signum Global Advisors joins us next, live from New York City this morning. Good morning.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Speaker Johnson on the House floor right now live in the nation's capital in Washington, D.C. Moments ago, it quite literally is morning again in America. Good morning, Mr. Speaker. Good morning to all of you tuning in. They've been up all night. I hope you've had some rest. In this bond market, this equity market, our attention is on these scenes right now as the House inches closer and closer to a vote in Washington, D.C. Equity futures at the moment elevated by just 0.1%, up 0.2% on the NASDAQ. In the bond market, yields coming back very close to multi-decade highs at the long end of the curve. The 30-year yield this morning is lower by almost a basis point, 5.08%. Under surveillance this morning, pushing the tax bill over the line. Here's the latest. The full House vote on the president's tax bill could come any moment after a revised version was released overnight in an attempt to win over Republican holdouts. Joining us now, Tyler Kendall down in Washington, D.C., Rob Casey of Signum Global Advisors. Tyler, I want to come to you first. How close are we and how tight are these margins?
Yeah, hey, John. Well, we're getting some new information that the margins might be even tighter than we expected. I mentioned this before. It appears the magic number that House Speaker Mike Johnson is going to need is 217 Republicans to vote in favor of this. That means he can only afford to lose 3. We already knew one, which was Thomas Massie, and just in the last few minutes, we've heard from another. That's Warren Davidson of Ohio, Republican from Ohio, who had already started to discuss his concerns when it comes to how this will increase the deficit going into today. Yesterday, he actually posted on X about his concerns when it came to the bond market. But just in the last few moments, he posted on X saying that while he loves many things in this bill, promising someone else will cut spending in the future does not cut spending. So it appears now that that means Mike Johnson only has one more vote that he could lose.
Rob Casey, your thoughts on the numbers and whether this passes?
Well, up until yesterday evening, we did not expect this to pass today. I think for the simple idea that A, the House Freedom Caucus members were not there yet in terms of what they actually saw in the package, and B, they've worked through the whole night. There's no deadline tonight. There's no deadline today, except for Speaker Johnson's, made-up deadline. So to his credit, it does seem as though he's really rushing this through, and people are convinced that today is the day. Overnight, we did see some coalescing around the bill as it exists today. So, you just heard from Tyler. It's still really, really tight. We haven't heard from Chip Roy and others, but they voted for the rule. And as of this morning, Johnson is projecting confidence. So I think that they're much closer than they were 6, 12, 18 hours ago.
And they all just sat down in the Oval Office with the president just hours ago. Did he close this for the House Freedom Caucus members?
I think he did. What he didn't do was close it on Tuesday morning. It does seem as though the second meeting on Wednesday, a little bit more targeted towards the House Freedom Caucus. In fact, very targeted. Not, once they got the Saul deal over the line, the Freedom Caucus members were the only holdouts. It does seem as though that meeting helped.
Do you actually think Speaker Johnson would bring this to the floor if he didn't think he had the votes?
I think he actually would. We used to see Speaker Pelosi. She essentially never lost a vote on the House floor. I think Speaker Johnson takes a little bit of a different approach. He's willing to lose a vote, first vote, second vote, if it gets him to the winning vote, third vote, fourth vote. But it seems as though, he's pulling together the numbers earlier than later.
Help us understand what you think the ultimate compromise will be. How has this bill changed in the last few days? And what do you think the compromise looks like at the very end?
Well, really interestingly, the changes that we've seen over the past couple of days are essentially moving in the opposite direction of where the Senate is going to take this bill, right? We've seen a higher SALT cap. There are no senators from New York, New Jersey, and California, so there are no senators who are going to be happy with that. And we've seen, earlier phase outs of some of the IRA spending, in fact, a lot of the IRA spending, and some of the Medicaid cuts. And There are certainly some senators who are happy with that change. There are other more moderate senators, who hope to stick around in their seats for quite a lot longer. And I think, generally speaking, they would be more willing to kind of look the other way on some of these cuts.
Tana, this is the ultimate problem. This is the beginning of the end of the beginning. We're nowhere near getting this done. And once you get it done in the House, it's got to go to the Senate. And the biggest question we've all had is, can you please the Soul Caucus and the Hawks in the Senate at the same time? And obviously that's going to be very, very challenging in Washington.
Very challenging, John, and there's just a whole list of items that we already know that the Senate wants to change in this bill, including making permanent the 2017 tax cuts, since the House version only extends them temporarily. Not to mention that we're talking also about lifting the debt ceiling. This House package lifts it by $4 trillion. The Senate wants to see that up to $5 trillion. Not to mention, when we are talking about these individual provisions, like we know that the Senate doesn't want to touch when it comes to Medicaid. When you talk about SALT, John Thune, the Senate Majority Leader, historically not a fan of lifting that SALT cap. In fact, December of 2021, he wrote a pretty strongly worded op-ed entitled "Salt in the Wound." That was when Democrats were trying to lift the cap back then, and he said that he just couldn't support it.
You know the timeline. It's Memorial Day, self-imposed for the House. They want this done by Independence Day, wrapped up on the president's desk by July 4th.
Speaker Johnson, his final words there when he's speaking on the floor, predicts they're going to deliver to Trump's desk by Independence Day, and says the Senate, Trump is waiting with his pen. So basically saying to the Senate, you got to get a move on. If we're hitting Memorial Day, you need to get it back to us to give us time to get this to Trump's desk July 4th. There are some people in Washington, D.C., like Terry Haynes of Pangea Policy, who thinks 80% it's done by July 4th. I spoke to Libby Cantrell yesterday, too. She says, I think more like August.
Bond market jitters kicking in the last 24 hours. A 30-year yield back through 5%. Rob, how important is that? Does anyone in that room right now care about what's happening on Wall Street in the last 24 hours?
I think very few people do. The House Freedom Caucus, Chip Roy in particular, likes to tweet about it, and I think to the extent that Moody's downgrade changed any of these conversations, it was giving the House Freedom Caucus some further ammunition to demand further cuts. I think the same can be true of bond market reaction, right? Chip Roy, among others, can point to it and say, we have to find some more cuts. There just aren't that many more cuts to find.
So it's convenient for them right now. The bond market's pushing back. That's all it is.
Yeah, exactly.
It's convenient.
Exactly.
Do you think the president, though, cares? Not members of Congress. The president cares when he sees these yields. And Scott Bessent, the Treasury Secretary, cares, given the fact that we know they've been squarely focused on the 10-year yield.
Yeah, I think they do care. But I'm not sure that that is the reaction that's going to, knock this package off the rails. They've put in more than 6 months worth of work at this point. If they can get it through the House as of today, they will immediately turn to getting it through the Senate, right? Pushing it through the Senate. Whether or not they can roll the Senate or not, in the short term, I still take the over in terms of timing. But I do not think that bond market reaction is what kills this package. I think it's the House and the Senate each wanting their fingerprints on the bill from here.
Well, the Senate's going to jam the House. This, I've been saying, is actually the easiest week for Speaker Johnson if you look at long-term where this bill is going. The tweaks, it's going to get moderated in the Senate. How does he get the votes when it comes back?
I think it's going to be really hard for him to get the votes. President Trump is going to have to either return to the Hill or welcome members back into his office, maybe more than once, as he did this week. It's why I still take the over, right? It's not to say that we don't expect this bill to get done. I mean, the truth of the matter is it really has to get done, or else we'll see historic tax increases under a Republican trifecta. But as we were talking about, made-up deadlines, it either gets done before the debt ceiling, we hit the X date, or it doesn't. We still take the over there.
At the very least, you extend TCJA. What is the extra? Can they go beyond just doing that?
I think they can go beyond. I mean, we've talked for months about how there are not many members in Congress who like no tax on tips, no tax on overtime. I mean, quite literally, you talk to them in the room and they say very explicitly, it's not very good policy, right? It's not pro-growth policy, but it's what the president has demanded. So they've actually written those parameters very narrowly. They're in the bill, but kind of in name only.
They were key campaign promises, not just by the president, by the way, but also on the other side of the aisle. Kamala Harris, when she was running, made some of the same promises.
Absolutely. And the president yesterday, there was a White House memo sent around that said this would be the ultimate betrayal to the American people because he ran plan on these policies, not just the extension of TCJA, but all those extra sweeteners, no tax on tips, et cetera. He wants to see them in the bill because he wants to deliver what he promised on the campaign trail.
Rob Casey of Signum Global Advisors. We're going to push you to stick around, if that's all right. Tyler Kendall down in Washington, D.C. All eyes on the House as we push for that first vote on that one big, beautiful bill. This bond market pushing back in yesterday's session, a 30-year yield back through 5%, and we held on to those levels. The 30-year this morning just about unchanged, 5.09%. Up next, we'll talk about tax policy and trade policy too, with the former senior Trump trade advisor, Kellyanne Shaw.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Two days of losses on the S&P 500 this morning so far, positive by just 0.1%. Yesterday's losses triggered by developments in the bond market. Typically, the 20-year auction is not something you pay a lot of attention to. Nothing to worry about. It's the 20-year maturity, which isn't something that's like that much in the bond market. But I have to tell you, yesterday, that worried people. On top of all the other worries, in Japan, in the UK, a big tax bill going through in Washington, D.C. Yields are higher at the long end of the curve in the last 24 hours, back through 5% this morning. Just a little bit of stability. The 30-year, 5.08%. 0.87%. With 3 hours until the cash open, your morning movers look like this. Here's Yahara. Hey, Yahara.
Hi, John. No worries for Urban Outfitters. That stock is up 18%. Now, it blew past first quarter expectations, and they see no signs of that slowing down, with shoppers still hungry for fresh spring fashion. So they expect the second quarter to be strong as well. As for how they're handling tariffs, they're negotiating costs with suppliers and say they want to limit price hikes to only higher end items. Next up, we have some M&A action for you. We are seeing shares of Lumen rising 13% after AT&T agreed to buy its residential fiber unit for $5.75 billion. And the reason why Lumen is soaring is because the move allows it to offload a non-core unit and focus on its enterprise customers. Not as much love for the buyer, though, AT&T. And last up, we have Manchester United. Those shares are falling 7% after a costly loss in the Europa League final. The defeat to Tottenham means no Champions League next season and no European competition at all, which of course has a lot of financial ramifications for them. But we're happy for the Spurs here, who had been waiting to hoist the trophy for 17 years. John?
Brutal. Yahara, thank you. I have to say the quality of the football yesterday evening has no place in the Champions League. That's my saying all of that. On a radar this morning, the House set to vote any moment on a new version of President Trump's tax bill. The latest version was released overnight in an attempt to win over Republican holdouts. We're following the scenes live in Washington, D.C. Just how performative is this moment?
Well, overall, it's very performative because in the end, this bill, if it passes, and looks like it likely will, even though we do know there are 2 Republicans who are a no at this moment leading into this vote. Right now, we are on a procedural motion to recommit, which is a Democratic procedural. But if this passes, it goes to the Senate. They are going to sanitize this bill. They are going to change the edits the House made when it comes to Medicaid, when it comes to SALT. Rob Casey brought up a great point. Do you see any Republican senators from high-tax states like New York? No, they have no impetus to want to increase the deduction. So a lot of those things are going to be rolled back. And then Speaker Johnson actually has the big fight. That's going to be in a few weeks, few months' time.
I'm wary of overplaying this, but there is this interesting tension evolving now, starting to emerge between Washington and where it's going and Wall Street and where it's heading. And we saw it in the soft 20-year auction yesterday, $16 billion of 20-year bonds coming in just a little bit weaker. More auctions in the next week or so. We'll be watching the 2-year, the 5-year, the 7-year, and they're going to get more and more attention as the weeks and months go on as this bill comes together.
Right. So for the fiscal hawks, for the House Freedom Caucus, the auction, the bad auction, was a good excuse at the right time to say, look, what's happening in the bond market? We should be fighting for less spending. You saw that with Representative Chip Roy, which we don't know yet how he's going to vote on this bill this morning. He was talking about the horrible bond auction yesterday on X, as well as Representative Davidson, who already said he's going to be a note on this, talked about the rising bond yields. But overall, does Congress actually care? I would say no.
That's the situation in fixed income. I just want to turn to commodities. The president getting what he wants here as well. Crude's lower. WTI's back to 60. Brent's back to 63.80. OPEC Plus members are mulling a 3rd consecutive oil production hike in the month of July. Sources telling us here at Bloomberg they're discussing tripling the amount initially planned. The final decision will be made on the 1st of June.
So this is a combination of things. One, they are frustrated with the likes of Kazakhstan, Iraq, other individuals who Saudi Arabia and some others will say are freeloading on their discipline when it comes to the market. 2, now might be a time to go after market share. And 3, if you want to go after market share, you're willing to sweat out some of the lower oil prices. Why not do it at a time when it scores you, as Will Kennedy was talking about earlier this morning, a massive policy win to the President of the United States, who came to your capital and gave a transformative speech when it comes to foreign policy and where he sees countries like Saudi Arabia.
It seems like this unwritten agreement right now between that region and the president. Crude is lower by 1.7%. That's the situation in markets. Here's the situation with policy. Let's turn to trade. The EU sending a new proposal to the US aiming to secure a deal with President Donald Trump. Sources telling Bloomberg the new plan focuses on US interests, including economic security and a gradual reduction of tariffs to 0 for select goods. The former senior Trump trade advisor Kellyanne Shaw joins us now for more. Kellyanne, welcome back to the program. It looks like we can strike deals with countries like the UK. How much harder is it going to be to come to an agreement on Europe? Because we've spent a lot of time on this over several decades and still can't get it done.
Yeah, thanks so much for having me. I think of all the countries who are lining up for a deal with the United States, the European Union is going to have the hardest time for the reason you've mentioned. We've tried to get a deal with them for the last 20 years unsuccessfully. Now, I do think it's helpful that they're proposing a new set of commitments to the United States. They had previously been taking more of this wait and see approach, see what other countries are getting, see if the president loses his political support for some of these tariffs. But it looks like they're trying to engage a bit more now, so that does open up an opportunity to at least try at another kind of deal, maybe similar to what the UK got.
Kellyanne, this morning we're looking to advance a tax bill through Congress, and I wonder, and I'd love your thoughts on this, if they manage to pass this by Independence Day, given the timing of the 90-day window that closes for trade negotiations, do you think this could embolden the president to go even harder on trade?
Well, I think clearly getting the tax bill over the finish line is going to help the president in terms of his tariff strategy. And that's exactly what Secretary Bessent was saying on Saturday on CNN when he was talking about, look, the tariffs may do one thing, but the tax bill is going to do another in terms of deflationary effect. So you have to look at our entire economic package. Now, I think the other thing that would help embolden the president is getting several more of these deals under his belt, showing that this plan is successful on the tariff front, but clearly some of these domestic measures are also going to help the president in terms of advancing his overall economic agenda.
Kellyanne, he has said a few times that there's a number of deals in the, quote, hopper. Who's up next to ink a deal?
Yeah, I think countries like Japan, South Korea, Vietnam are close to getting a deal. The administration keeps talking about 18 different countries who are key trading partners who have made serious offers with whom they're seriously negotiating. I put Switzerland in that mix, Israel in that mix, potentially some of the Latin American and Central American countries as well. But at some point, they're just going to run into this capacity problem, which you've heard several administration officials and the president talk about, where they're not going to be able to negotiate these individual deals. Rather, they're going to use the deals that they have and then use those as templates moving forward for other countries with whom there are potential negotiations down the line.
Building on John's initial question about the European Union, where are they in the Excel sheet? What number are they ranked?
Yeah, I mean, clearly the EU is a very important trading partner. The transatlantic trading relationship is one of the largest in the world. But in some instances, in some cases, the Trump administration is probably going into those negotiations not particularly optimistic that they're going to be able to get a deal because, again, of the dynamic that John started with, which is this is just something that has eluded both parties for nearly 2 decades. Now, that said, it's certainly worth trying, but I'm just not sure that that deal is really going to come together at the end of the day. I'm not particularly optimistic about it, but I think it's helpful that they've at least tabled potentially cuts to some agricultural tariffs, which are a huge priority for the Trump administration.
Kellyanne, we know Giorgia Meloni, the Italian leader, has a very good relationship with this administration. What I've been struck by is how many times the president talks about Ursula von der Leyen very warmly, the head of the European Union. Do you think that she is playing this very well when it comes to Trump and trying to get a deal across the finish line?
Yeah, I was also struck by comments where he referred to her as fabulous and fantastic. And I think that's really smart of the European Union. I saw staffing the president with a number of world leaders that where that chemistry is real and where those relationships are real, the overall dynamic between the two nations just went much more smoothly. And during Trump 1.0, the EU and the European leaders had a really hard time building an organic relationship with the president. So we've seen Meloni, we've seen von der Leyen, and we've seen others really making an effort this time. And I do think that that's helpful. I think that's a positive sign.
Kellyanne Shaw, the former senior Trump trade advisor. Kellyanne, wonderful to catch up with you. Thank you. We've said repeatedly this could be the harder deal. The Europeans versus the president.
Absolutely. And there's going to be other issues when it comes to the European deal. Secretary Rubio was just talking about NATO and how their defense spending is going to go up. So there might be other levers that Europe can pull. But this is going to be so challenging because it is a collective group of individuals, states, and countries. And this president likes to deal in a more bilateral manner.
Rob Casey of Signum is still with us. Rob, I just want to talk about a couple of dates. One, for the tax bill, the goal July 4th. The other, for the 90-day pause, expires July 9th. How important are those two dates? Does one relate to the other?
Well, I mean, we were talking offline. I think that they could relate to one another in that if they get this tax bill done by July 4th, then it gives President Trump some more latitude, some more leeway to say, listen, we've gotten to the end of the expiration, and in fact, we've been talking to 18 countries. We've gotten a deal done with the UK, and we're not at deals yet, and so we're going to slap tariffs back on, right? So I do think if they succeed by July 4th, maybe there's more leverage. If they succeed by July 4th, then I will have been wrong because, again, we still take the over when it comes to how
When you say the over, what kind of date are you thinking about? End of summer, into the fall, end of the year?
Well, I think that the most salient deadline is the X date as of today, right? And so we've heard that that's going to come in August, which means that the Senate has to pass their bill before their August recess, kick it back to the House, and they have to essentially agree on two bills before the August recess. Honestly, if we get close to the X date, I think we could see Republican leadership pull a debt ceiling solution out, which actually has the convenient, additional change of forcing some Democrats to vote for it, right? I think getting some Democratic names on a lift of the debt ceiling, it might be better than worse.
This is exactly what I wanted to ask you, because then does that help the individuals from the House Freedom Caucus to then maybe sign up for the one big beautiful bill if the debt ceiling is a separate vote?
Exactly, because members like Thomas Massie and Chip Roy then don't have to vote for an increase in the debt ceiling, which is not to say that Thomas Massie will vote for any of this ever, but if they don't have to vote for the debt ceiling, indeed, maybe they come back post-August recess, and, the mood music's a little bit better, the tensions are a little bit lighter, and they're able to get this done in September.
Rob Casey of Signum is going to stick with us. We'll continue to monitor developments down in Washington, D.C. as we get closer and closer to that vote in the House. In the bond market at the moment, things are stable. We're settling down. Yields are down by about a single basis point on a 30-year to 5.08%. On 10s at the moment, let's call it 4.58, and down by close to 2 basis points. That's the situation in financial markets. Let's give you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. U.S. House members have been working through the night to try and push President Trump's tax bill over the line, which you were just discussing. A new version of the bill includes a higher $40,000 limit on the SALT deduction, speeds up work requirements for Medicaid, and puts an end to Biden-era clean energy tax breaks. A vote could start at any moment. Meanwhile, President Trump says he's considering taking the U.S. mortgage giants Fannie Mae and Freddie Mac public. The companies have been under federal government oversight since 2008 when they were bailed out during the financial crisis. But in a post on Truth Social, Trump said Fannie and Freddie are doing well, throwing off a lot of cash, and the time seems right. And shares of Nike are higher in the pre-market, up 2.2%. The world's largest sportswear company announced it's returning to Amazon's online store for the first time since 2019. The return to Amazon is part of Nike CEO Elliott Hill's push to revive relationships with retail partners, including stores like Dick's Sporting Goods and Foot Locker. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, Washington versus Wall Street.
The bottom line is that this bill is going to lead to probably 3% growth again, just like we promised last time. That's going to create a lot of certainty in markets.
Up next, we'll catch up with Sam Zeef of JP Morgan Asset Management, live from New York City. You're watching Bloomberg TV.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
my life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Things are a little bit calmer as we inch towards that first vote on the One Big Beautiful Bill. Down on Capitol Hill in the House. Equity futures at the moment on the S&P up by about 1/10%, up 0.2 on the Nasdaq. Lots of drama in the bond market yesterday. No real drama this morning, but we hold on to those levels on a 30-year, closing above 5%, 5.0859% this morning. Yields just about unchanged. Under surveillance this morning, it's Washington versus Wall Street.
The bottom line is that this bill is going to lead to probably 3% growth again, just like we promised last time. That adds $4 trillion in revenue. It makes it so this bill pays for itself. That's going to create a lot of certainty in markets. There are way more spending cuts to come this year because of all the savings that we're finding.
Here's the latest this morning. Markets pushing back on Washington's big, beautiful bill. The White House responding, saying economic growth will outweigh Wall Street's fiscal concerns. Sam Z for JP Morgan writing, we're shifting to a bearish stance on the dollar. Diversifying currency exposure can mitigate potential losses associated with dollar depreciation. Sam joins us around the table. Sam, good morning.
Good morning. Thank you.
Here in New York on Wall Street, we like to believe that down in Washington, D.C., they have a live feed of what the bond market is doing and they follow these auctions really closely. How close to the truth is that?
Well, I hope that they are, because the market is going to vote on this itself, right? And I think you're starting to see signs, and it's not just in the bond market. I know we've talked about it all this morning, but the currency market is starting to vote with its feet also, differentiating between the currencies that have countries that have large trade surpluses, that rely on a lot of external financing for their budget deficits. Those currencies are getting punished. It's not just the dollar that's under pressure, British pound is under pressure, and the currencies that have trade surpluses, budget surpluses, are actually being rewarded, Norwegian krona. And so the FX market doesn't always trade this way, and so I hope that they are paying attention.
I'm pleased you picked up on this, and I think a lot of people are talking about the same thing up on Wall Street. The toxic mix between what's happening in the bond market and in foreign exchange at the same time. Yields are higher, but the dollar's weaker. Where's the money going with that in mind?
Yeah, and it does seem like global investors, rightfully so, have built up very large overweights to U.S. assets over the last 5-10 years. We are starting to see incremental signs of, it's not that there's a lot of selling of U.S. assets, but incrementally less inflows. So the one that I think is most interesting is European investors are actually putting money to work in their own equity market. They used to get inflows and then put it all to work in the U.S. And if the U.S., just because it has such a large trade deficit, has such a large current account deficit, just incrementally less inflows allows the dollar to leak lower. That's a key part of our thesis.
Is this a blip or is this a structural change?
No, we think this is actually the beginning of a dollar downtrend. And how long it lasts is anyone's guess. But the dollar from a starting point, 5-10% overvalued still, even after the move that we've had. We think that the dollar is going to stay under pressure over the next 6 to 12 months.
What does dollar downtrend mean for potentially de-dollarization?
Yeah, and so I'd focus that this isn't a view on global, let's say, financial institutions moving away from the dollar for cross-border lending, cross-border trade, You know, the dollar is still the center of the global financial system, but it is an effort to reduce the amount of dollar overweights that global investors have, or the amount that they've let their dollar assets kind of go unhedged, let's say. I think that those are really in play.
I've seen a lot of takes in the last 24 hours. This one jumped out. It's from Dario Perkins of TS Lombard. Over in London, it feels like that the Europeans are more angry about the situation than most at the moment, and this guy's based in London. Who knew that if you dilute the basic hedging properties of government bonds through supply shocks, attacks on Fed independence, and thinly veiled threats against foreign investors, you would have to sell your bonds at a discount? Now, I'm trying to work out how much of this is repairable, reversible, with a change in policies. Markets have short memories. You can move on quickly. How much can be done in Washington to repair this?
Yeah. I think it's a slow process, right? I mean, so I was in London, and if you can bring that up in 2022, and when there was a little bit of a bond market riot against fiscal policies there, the trust moment, we all call it, and that form of government, the parliamentary system, was very easy to reverse, right? They got together, trust was removed, reversed all of those policies. This bill goes through in the U.S., regardless of how the market takes it. The U.S. system is not easily, lends itself to quick reversals. Not that I'm saying that that's necessary, but I think that, the U.S. process is just much, much more slower moving and harder to reverse, whichever way you go.
We're following that process right now in Washington, D.C. Anne-Marie, getting closer.
Right, we are getting closer. The House actually started voting on the One Big Beautiful Bill. This is through the process of reconciliation. 217, Jonathan, the number to watch. We already know going into this, Johnson had 2 no's when it comes to Representative Davidson and Massey. Potentially, is he going to land this plane? We'll wait and see.
Rob Casey of Signum still with us as well. Rob, just walk our audience through what's happening now and what happens after this.
So, I mean, they're voting now, quite literally, but we like to say in the office, the numbers that you're seeing on your screen are not final, right? Any member can change their vote between now and the end of the vote, right? So if it turns out that we see 3 nays on there and then 4, there's the chance that Johnson could reel back a member or 2 and actually get this bill over the line. So those numbers are sort of interim. And then from there, right, the attention moves to the Senate. We all get our Memorial Day weekend off, right? Washington shuts down for 4 days. And then attention very quickly moves to the Senate and just how significantly they change what is coming out of the House.
They always need a holiday, a vacation to get something done. And it's a very good point that this is the vote count right now, not until it ends, that's going to be the final tally, because we did have one Congress member briefly was a no, then switched to yes. So how long can this vote maybe stay open? Is Johnson going to have to do some wheeling and dealing live on the floor?
Well, I think he certainly probably is doing wheeling and dealing live on the floor. I've also read just on Twitter some great reporting being done that he's also getting handshakes and backslaps and hugs, right? So it sounds like maybe there's a little bit of a premature celebration coming from Republicans. It sounds premature to us, right? We don't know how they're going to vote. Maybe they all know that 2 nay on the board, that's where it's going to stand.
Let's do the big picture. This is just one piece of a very long battle for Speaker Johnson. How does he get the votes when the Senate jams him?
It's going to be really, really hard. So I think he's going to need President Trump, right, first and foremost. He also, I think, is going to have to demonstrate to his members that they are going to be the ones to have to, essentially argue and debate with the Senate, right? He gave SALT members essentially what they wanted, and he then said to them, you have to go out and convince the Senate, right? You, Mike Lawler, you, Elise Stefanik, et cetera, go over there, right, on the other side of the Capitol and talk to your colleagues about why this is important to you and your constituents. And if they can't do that, I'm not sure that Speaker Johnson is going to be the one to mend those fences. He can't do it alone.
If you think politics is frustrating, now for the market part, this is where it gets interesting. Is this positive or negative for financial markets? Now, we're told it's a net positive, good for stocks, but it could be bad for bonds, which could be bad for stocks. Sam, when you think about this bill, if this passes in Washington, D.C., is it dollar positive or dollar negative?
It's a great question. I do think that just given where we're coming from, dollar overvalued, we think that this global asset reallocation story is already underway. We think that story continues, that this question over the U.S. Fiscal outlook, this increase in term premium we're seeing in the bond market will continue to be dollar negative. I think when it comes to markets, though, you've really got to segment. There's the dollar, there's risk assets, there's bond markets. Even within the bond market, there's different segments of the yield curve. Honestly, the more term premium rises in the long end, the more the long end of the yield curve tighten financials conditions, then the more the front end needs to stay low, needs to stay anchored. The Fed needs to offset that. So honestly, the more that we see volatility in the long end, the more comfortable we get in the front end of the yield curve.
Sit on that. Do you think the long end of the yield curve, cross-asset right now, is in the driving seat?
Yes.
And it drives the US dollar too?
Yes.
But in ways that typically we're not familiar with, which is yields are up and the dollar's negative.
Yep.
How much of a problem is that going to be going forward for a lot of people that have to hedge these issues?
I think that's the really main thing. It's not just that the long end of the yield curve is in the driving seat for the dollar, but also for risk assets. And what we've actually seen is a really sharp shift in the correlation between the dollar and risk assets. Usually the dollar exhibits these very strong safe haven properties. Risk assets sell off, dollar appreciates. But actually that correlation is now positive. For global investors, thinking about folks in Europe, folks in Japan, that have been used to having the dollar as this offset, this hedge to their U.S. assets, that shift in the correlation, even if it's been going in the right direction and U.S. stocks have been going up, still argues for increasing those hedge ratios that they've let fall. And again, that's what can put downward pressure on the dollar.
And this is a massive change. We're all trying to track. Sam, it's good to see you. Sam Seif there of JP Morgan, Rob Casey of Signum, Anne-Marie, getting closer to the outcome of this vote down in Washington, D.C.
We are getting closer, and Chip Roy, that Texas congressman that everyone's looking at, is going to vote yay, nay. He voted yes. So that's a win right now for Speaker Johnson as he tries to inch close to 217.
What did you make of the president's argument, which is basically just pass this thing? It's going over to the Senate, it will change, and we'll be talking about this again in a few weeks' time.
I think it's a good argument from the president because the bill's going to look completely different when the Senate sends it back to the House.
This market might look different too. Equity futures on the S&P positive by 0.1%, and just a bit of stability in the bond market. The second hour of Bloomberg Surveillance up next with Alicia Levine of BNY Wealth, Bloomberg's Tyler Kendall, Eric Fish of HSBC, and Greg Peters of PGIM Fixed Income. Live from New York, you're watching Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we can do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television, you need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
chatter on the consumer is not strong. Outlooks from companies about the consumer were weak.
Corporate and personal balance sheets are in really good shape.
The pressure is eased, but the upside catalyst for earnings is not as robust as it was.
As you get into the summer, these potential downside risks to both EPS and GDP become a real issue.
It's a little bit fragile out there.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. For our audience worldwide, live pictures down in Washington, D.C. as the one big, beautiful bill leaves the House and heads to the Senate. That passing just moments ago.
Passing moments ago, this is a huge win for Speaker Johnson, who promised a vote before Memorial Day. He still has days to spare. He was able to land this plane, as he said last night, coming back to the Capitol after having this meeting with President Trump and House Freedom Caucus members. And it does seem that the president was able to close the deal here, telling these individuals, vote for this bill. We all know it's going to change in the Senate, and then they're going to send it back to you, and then that's really when the fight's going to start.
And as that bill passes, look what happens in the bond market. Yields start to climb again, just by a basis point, but after a big move in yesterday's session, the 30-year yield right now, 5.1%. This bond market had its say yesterday in a big way.
The problem is, Jonathan, the bond market's having its say, but to who? Is anyone in Washington, D.C. listening? It is convenient that yields were rising yesterday when the likes of Chip Roy and Congressman Davidson were saying, look what's going on at the 20-year auction. Look at these rising yields. We have a deficit problem. We need to cut. We shouldn't be spending more. Okay, it was convenient for them. You don't take this vote if you really care. They don't care right now.
This doesn't happen often. Washington, D.C. getting some work done before Wall Street even gets to work, but it happened this morning. We begin this hour as the House of Representatives passes President Trump's big, beautiful bill onto the Senate. Tyler Kendall joins us now from Washington, D.C. for more. Tyler, welcome back to the program. A big development and unexpected around this table.
Yeah, hey, John. Well, a big round of applause for House Speaker Mike Johnson as they passed this reconciliation package. The math changed on us a little bit because 2 Republicans were not there to vote, but it passed 215 to 214. One member voted present. That was Andy Harris, the chair of the House Freedom Caucus, who was raising those concerns about what this bill will do when it comes to adding to the deficit. Now, we did see some of those holdout members that we were sort of expecting to be on the fence here, including Chip Roy, ultimately vote in favor of this package. Now, what it does, of course, just to quickly recap, it will extend those 2017 tax cuts, also include some of those provisions we were watching, like temporarily eliminating no taxes on tips and overtime pay. When it came to those key agreements that needed to be included in this in order for a deal to be reached, it's going to lift the SALT cap from $10,000 to $40,000 and also speed up Medicaid work requirements to go into place by December of 2026, not to mention eliminate some of those clean tax credits under the IRA by 2028. Of course, as you've been covering, a lot of this is going to change once it gets over to the Senate, but this is considered to be a pretty big victory for House Speaker Mike Johnson this morning.
Absolutely a victory for Speaker Johnson. He promised this vote. He landed the plane. But Tyler, what's on the chopping block in the upper chamber?
Right. Well, definitely changes when it comes to Medicaid. We know that this is something that senators have already been pretty vocal about, that they're going to roll back likely some of that timeline when it comes to implementing the work requirements. Not to mention, they also have some issues with how the tax provisions currently stand. They want to see them made permanent. Not to mention also, of course, increasing the debt ceiling. Now, the House plan, as it is passed, it would increase it by $4 trillion. The Senate wants to see that number boosted up to $5 trillion. Also, the IRA tax credits being rolled back. Many senators have already voiced concerns about what this will mean for the private sector and companies that have already been banking on using them, not to mention some of those states that are trying to transition their economies when it comes to clean energy. And then lastly, Anne-Marie, keep your eye on what's going to happen to SALT, because Senate Majority Leader John Thune historically hasn't been in favor of lifting that cap.
Tyler Kendall with the latest in Washington. Tyler, stay close. You've pleased some people in the House. Does that just annoy some people in the Senate? And are we back to square one again?
Well, I think the Senate just looks at it like, okay, the House, you've done your work. You've been extreme in some measures. Now we are going to, what I think they really view as moderate or sanitize this. And I think SALT is going to be #1 on the chopping block, because you have senators here who have no impetus to want to raise the SALT cap. Why would they do that? There's no Republican from a high tax state in the Senate. So this is the high watermark for $40,000 on raising that cap, and I think, if anything, it's going to go down.
This is the latest down in Washington, D.C. Here's the view on Wall Street. The bond market's sending a warning to Washington. Alicia Levine of BNY Wealth writing this: yields over 4.5% will bring volatility to equities. And Alicia, they did just that yesterday, which begs the question, and welcome to the program. Is this good or bad for markets?
Well, it's interesting. This is probably the first budget reconciliation bill that the bond market's actually paying attention to for the last 30 years or so. So, you know, we were in a bond bull market for all that time. And with lower defense spending, and you know, politicians were put on earth to give things away, and so anything that supported the economy and households lowering taxes, that was always positive for the economy. I think we've gotten to a place where you're running $2 trillion deficits over the last 5 years, and if you don't impose austerity, which has negative consequences for growth, you've gotten to the place where the bond market's now paying attention to the politics of this, and you've gotten to a place where now we're at equities at 21 times forward earnings after that remarkable 23% recovery off the low, and you're in a place where equities are vulnerable here to what the bond market is telling us. I mean, there has been a disconnect in the conversation between the growth, the tariff conversation here, the earnings conversation on the one side with equities, and the fears in the bond market and the signals coming from the bond market this entire time.
There's a more constructive way to look at this. You could say that the passage of this bill, if we manage to extend the TCJA, the tax cuts from there, and if we manage to do just a little bit more, it could insulate this economy from the policy volatility of the last month regarding trade. Do you not take that view?
I do take the view, because ultimately most of our client portfolios are in equities, and for the most part that has always been the right place to be. So it's less about the tax bill itself and the effect of the taxes on growth. Yes, we want to avoid the negative fiscal drag of the $400 billion if this doesn't get through. The real issue is, I think, the deregulation and what's embedded in the bill, which is the immediate expensing of investment, the immediate expensing of CapEx and of building structures. That's actually very growth positive. I'll also say that the movement forward on AI is extraordinary. And so productivity gets the U.S. economy out of this kind of mess that we have, where it's very hard to impose austerity while at the same time keeping the deficit in control. Productivity can get us there. So what's embedded in the bill is getting us there. It's not the tax cuts per se. It's just the avoidance of a negative.
Do you think the bond market is more nervous about this bill altogether or tariffs? Because we saw a pushback already twice within Trump's first 100 days.
I think overall it's the message that there's a lack of political will to address the issue. I think that more than anything. It's not the bill per se, but it's the message that, you know, imposing austerity to keep the bond market happy imposes negative growth consequences. And so there's no political will to do this at all.
If you're just tuning in, welcome to the program. Bond yields are a little bit higher, up a single basis point on a 30-year, getting closer to 5.11%. Just moments ago, about 20 minutes ago, the House passing a revised tax bill. The one big, beautiful bill heads now to the Senate. Alicia Levine of BNY is with us around the table. Also with us, Rob Casey of Signum. Rob, I said a surprise for some of us around the table. You weren't expecting this. How much of a win is this for Speaker Johnson?
I think it's a huge procedural win. And Speaker Johnson has proven himself to be a really phenomenal speaker, right? Somebody who can bring his caucus, together around the things that he has to pass, sometimes overnight, frequently overnight. I think it's it's a very big procedural win. I'm not convinced it's an ideological win yet, right? I'm not convinced, as Anne-Marie has said, first of all, this is nowhere near what the final package is going to look like. And overnight, we also saw a number of changes that were on small things, right? Taxes on gun silencers and tanning beds, right? And to me, those things, as random as they sound in a tax package, they were to bring individual members on board, right? So it's not to say that there is a majority in the House of Republicans who believe in all of this. It's that there was a little horse trading overnight while some of us were sleeping. A lot in D.C. weren't. So I'm not convinced that it is the resounding win.
Whose district has a high concentration of tanning beds? Can we figure that out?
Mar-a-Lago, maybe, although they've got...
Florida, New York, New Jersey.
Yeah, they've got a lot more sun in Mar-a-Lago than we do in New York this week.
So the Senate is back June 2nd. How long for them to edit this and send it back to the House?
I still take the over. I think it probably, we wind up in mid-July, right? And then we're really talking about the debt ceiling and hitting the X date. It's still my expectation that they wind up pulling debt ceiling language out of the reconciliation package, passing it regular order. They force Democrats to vote for it, probably with very few concessions in the Senate, right? So then it's a bipartisan lifting of the debt ceiling. And we land in September. and we passed the one big beautiful bill X the debt ceiling, right? And as a matter of fact, we roll into Q4 and we could be talking about a fiscal year 26 reconciliation package. I don't think
it could leak into next year.
If they can't get it done by the August recess, I think the most salient deadline is the X date. And then it's September, and then it's the next fiscal year. And if they do it in January, right, nobody's paying 2026 taxes in January. So I do think that if not by July, which we don't think, there's not a great next deadline.
This is the challenge, Alicia, for a lot of people to take a 12-month view on this economy. What will the policy mix look like 12 months out? Will it be favorable to markets or not?
It's been fascinating to ask that question. I think overall it's positive because we actually upped our growth expectations for the year when it was clear that the administration's rolling back some of the more extreme tariff proposals. I think they got the message from markets that you've got to control this thing and you better start announcing some deals. You know, here's the outline of the deal. So I think it's positive for markets ultimately, but growth is going to be slower in the next 12 months. It's unavoidable. You probably have a slowdown at the end of the second quarter going into the third quarter here, simply because we've already had the shock. We've had the freezing in place of plans. So, yeah, we had the freezing. Some things are moving again. We see, you know, full container ships from China. That's great. But I think you just have this slow patch. Again, you know, if you're looking at a 1% economy, a 1.25% economy this year, you can still have positive returns in equity markets, but it's harder from here. And the vol's going to be there. The key thing is the stomach for the vol. That's what it's going to be living with us because we have the bond market now raising its objections to what's happening.
Speaker Johnson just started that news conference just moments ago. Steve Scalise speaking now. So let's head over to there and listen in.
Really important wins for the American people in this bill. And we had 11 committees come together and meet in hearings. Some went on over 24 hours. Rules Committee went over 20 hours. You had, you know, of course, the Budget Committee. Chairman Arrington is the lead author of the bill. All of the people that had to come together in our conference, and I think a lot of you know we don't all think alike. Democrats made it very clear they didn't want to have any part in helping get America back on track again, but we were never deterred. When this bill could have failed 10 times over, we said we were going to get this done and failure is not an option, and we meant it. We knew we were fighting for the families who've been struggling for way too long under the failed policies of Joe Biden and all the Democrats who did have control of Washington for too long. We watched higher interest rates and higher inflation and lower wages and a demise of the American dream that we knew should not be permanent, but was only going to turn around if we passed a bill to get America back on track. We knew we had to prevent a massive tax increase, so we put it in the bill. We knew we needed to secure America's border, as President Trump ran on all across this country and won the election on. And we put it in this bill. We ran on and said we would produce more American energy, and we put it in this bill. All the things that we knew we needed to do to root out waste, fraud, and abuse in government. Focus on those families who are struggling. All of that is in this one big, beautiful bill. And yes, now the House has come together and passed this bill against all odds, but we're still working on the rest of the process. It still goes to the Senate. The Senate has a lot of work to do too. That's why we've been talking to the Senate for a long time, but it's their turn to take this bill and move forward. But I'll tell you, none of this would be possible without the leadership of President Trump, who every step of the way not only laid out the vision, ran a campaign on this vision, but every step of the way too said, whatever you need, let me know. And he was there to help us. Our great speaker, Mike Johnson, who was never deterred, probably hasn't slept in a few days, but never wavered in his commitment to get this done. And this whole team has come together. And our whip has never relented and never stopped pushing to get this done. With that, I bring up our great majority whip, Tom Emmer.
Thank you, Steve. On November 5th, the American people rejected the failed policies of the Biden-Harris administration and overwhelmingly endorsed President Trump's America First agenda. Using his executive authority, President Trump hit the ground running on day one to deliver on the promises he made to the American people. Today, House Republicans followed suit. Our one big, beautiful bill fulfills the mandate for change we were given last November. It allows President Trump to continue his successful border security and deportation operations by investing in more Border Patrol agents and ICE officers, funding the continuation of the border wall, and equipping our men and women on the front lines with the tools they need to keep us safe. Not only will the one big, beautiful bill help to make America safe again, it will also help to make America wealthy again. America's economic revival has already begun under President Trump's leadership, but House Republicans back it up in this bill by making the 2017 Trump tax cuts permanent, eliminating tax on tips and overtime, and throwing out regulations that burden American businesses and suffocate American innovation. From promoting the safety and security of our great nation and giving much-needed tax relief to American families, to unleashing American energy and bringing accountability to important government programs, there are wins in this bill for every corner of America. Take this as a lesson. Don't bet against the House Republicans. We've shown time and time again that we deliver for the American people, especially when it matters most. By taking hold of this historic opportunity, I truly believe we've unlocked the opportunities for generations to come. With that, I turn it over to our conference chair, Lisa McClain.
Thank you. Well, good morning, everybody, and a good morning it is. We just made history and passed the one big, beautiful bill, despite the Democrats' fear-mongering. Shocker, we haven't seen that lately, have we? And the hours that they spent stalling the votes on this entire process. The Democrats tried to derail this bill. And guess what? It didn't work. They failed. Not only did the Democrats vote against the bill, but they introduced hundreds of meaningless amendments, spewed misleading talking points, and now they have nothing to show for it, except voting on the record for the historic tax increase and to kill jobs of the small and medium class business owners in America. Frankly, Democrats voted to put Americans last, and it's a shame. But thank God for House Republicans, and thank God for our president, Donald J. Trump. His vision, alongside the work of my colleagues, made today a historic day. Behind me is what you see, a unified Republican conference with phenomenal leadership. And this Republican conference works as a team. This transformational legislation will provide safety and security for generations to come. Whether it's at our borders or in our pocketbooks, Americans will be better off thanks to the one big, beautiful bill. Our committees had difficult tasks, and they delivered. And some doubted that this was even possible. But at the end of the day, we all came together. House Republicans did not miss the moment. And because of our work, we will put more money in the pockets of hardworking Americans. We will prevent the next Lincoln Riley or Rachel Warren from being murdered. And we will save another family from the heartbreak of fentanyl poisoning. And to think the Democrats voted against all of that. But I am thankful for the House Republicans that they stood up for the American people. We put them first. This is what real leadership looks like. This is what winning looks like. And this is what America looks like under President Donald Trump and House Republicans' leadership. Safe, secure, and prosperous. And now I will turn it over to the chairman of the Transportation and Infrastructure, Mr. Sam Graves.
I'll be brief, but I'm proud to stand up here with my
chairman colleagues, and I want to thank them for all the work that they did, the Republican leadership, and especially President Trump and his team for helping to get this across.
That's the latest on Capitol Hill. After the passage of the One Big Beautiful Bill leaves the House and heads to the Senate, I can tell you the bond market's got its say on things right now. Yields are higher by 2 basis points, the highest levels we've seen going back to 2007 on a 30-year maturity. 5.11 is the yield this morning. So that's what you're waking up to. We managed to pass the vote down in Washington, D.C. in the House. It makes its way to the Senate. It's likely to get kicked around a few times here, but ultimately we make some progress, and the bond market's still pushing back.
Bond market pushing back, huge momentum for Republicans right now. And Jonathan, you quipped earlier, they're doing work before Wall Street even wakes up. It is 7:20 in the morning, and you have all these Republicans lining up saying how great of a job we did to get this bill. But guess what? This bill is not going to look the same when it goes to the Senate and then it comes back to the lower chamber.
If you're just tuning in, welcome to the program. Under surveillance this morning, Speaker Johnson delivering for the president.
On this vote, the yeas are 215, the nays are 214, with one answering present. The bill is passed.
So here's the latest this morning. The House passing President Trump's signature bill, sending it on to the Senate. Bloomberg's Tyler Kendall joins us now from Washington, D.C. That news conference ongoing, Tyler. What stood out for you?
Yeah, hey, John. Well, House Speaker Mike Johnson really did take his victory lap here, and he said, as I'm sure you heard, that he's hoping the Senate will consider this in a timely manner, as we know that he's already starting to court that upper chamber to not make many changes to this, even though it's already our understanding that they have a few items that they'd like to see on the chopping block. He also made sure to say that the goal right now is to still see the entire reconciliation package passed by July 4th. That's going to be important to this White House as they try to really wrap up this part of their economic agenda by, as House Speaker Mike Johnson said, Independence Day. Now, I note that as part of this deal, we did see a lot of these fiscal hawks end up getting on board, and it's our understanding that in a late-night meeting with this White House, the administration did promise to work with these Republicans on future efforts, perhaps hinting at some executive orders that we could see down the line. So I would start looking out for sort of messaging and rhetoric around that in the coming days ahead to see if any of that ends up being part of the deals that are struck in order to keep this bill closely aligned with the House version once it gets to the Senate side. For example, after meeting with those House Republicans last night, we had President Trump refloating the idea of privatizing Freddie Mac and Fannie Mae, of course, something that has been previously brought up as a way to potentially help reduce the deficit. So things like that I would pay attention to here as they sort of start to carve out what this will look like ultimately in the Senate. And just lastly, John, I'd also mention this, I'm sure you picked up on it, but many of these Republicans during this press conference were also talking about the idea of how this will help to advance deregulation. Often we hear this administration talk about there are 3 economic prongs when it comes to tariffs, taxes, and then deregulation. I'd expect to hear the conversation start to sway a lot more towards that too in the coming weeks ahead.
Tyler Kendall in the nation's capital. That's the scene down in Washington. Here's the scene on Wall Street. Alicia Levine of BNY Wealth is still with us. Alicia, yields are pushing higher again by a couple of basis points. It's not too dramatic, the size of the move this morning, but the levels are getting our attention. 5.11 on a 30-year, the 10-year at 460. How problematic is that for equities?
Well, I think you saw it yesterday, right? That was the message. It's just going to be a struggle here. I think to the extent that yields stay above 4.5 on the 10-year, it's going to put a bit of a cap on where the market is. There's some technical levels, a little backfilling that we have to do because of the rapid V-shaped recovery we had from the bottom. So those are likely to get filled. But ultimately, you're sitting in a place now where we're looking at the labor market at 8:30 today, as we have every Thursday, we have the new claims data. That's the most coincident indicator that we have of what's happening in the labor market. So that's the next thing to look at. Does growth hold up here, right? Because the equity market has recovered remarkably well, even with the understanding, and I think the conversation is we're going to have a 10% universal tariff regardless. So that's already giving you about $200 billion in tariff revenue coming in. So that's a tax on the economy. So we've recovered from that. The next place is a grumpy consumer is still a consumer if that consumer has a job. The question is, do they still have a job? And that's really what's going to hold up the economy here. So far, so good. And I think defying all expectations thus far, the labor market's held up. So you can be grumpy, but if you have a job, you're still spending, right? Americans shop when they're unhappy as well as happy.
I'm pleased you mentioned jobless claims because we haven't talked about it yet. 8:30 Eastern Time for jobless claims. Rob Casey of Signum, I just want to give you a final word. What you made of what you've seen so far this morning, and just articulate the next steps down in Washington from here.
So what we've seen this morning was a big success for Speaker Johnson, right? But as we've said around the table for the past hour, it is really only the first major step of a number to get to a final reconciliation package. It now goes to the Senate. The Senate has 38 legislative days between now and August 1st when they are supposed to go into recess. That includes Mondays and Fridays. The Senate's not working very hard on Mondays and Fridays usually, right? Today they were up early or up late. The Senate has to build essentially their own package, right? Because they can't just take this for what it is. Then it gets kicked back to the House. Republicans hope it gets on President Trump's desk in July. That is still a very heavy lift, despite what we've seen today, which is momentum, progress in the right direction for Republicans.
Rob Casey, Alicia Levine, thank you to the both of you. Progress in the wrong direction for the long end of the yield curve. 30-year yields higher by 3 basis points, 5.12 on a 30-year, a level we haven't been at since 2007. More on the passage of this bill down in Washington, D.C. in just a moment. Plus, we'll catch up with Eric Fish of HSBC, with U.S. retailers wrestling with higher tariffs. From New York City this morning, good morning. You're watching Bloomberg TV.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Here's the scene in Wall Street. Equity futures right now just about unchanged on the S&P 500 following 2 days of losses. Those 2 days of losses followed 6 days of gains with a gain of more than 5% over that period on the S&P 500. This morning, just about unchanged, but in the bond market, we're making some moves. Look at the front end compared to the long end. At the front end, we're bid, yields are lower, but at the long end again, yields are climbing by 3 or 4 basis points, 512.75. Anne-Marie, a deal going through in Washington.
A deal going through in Washington on the House side, Jonathan. Now it goes to the Senate, and it's going to be changed in the Senate, especially when it comes to things like SALT and Medicaid. They're going to have their own version of how they want to edit this bill, and then it'll come back to the House. So this is the start of a very long process, but we should note this is a huge win for Speaker Johnson. He promised to vote before Memorial Day. He promised to land the plane, and he did that this morning.
And what it means this morning for the bond market is high yields. The highest yield we've seen on the long bond going back to 2007. That's the situation in fixed income, 2 hours away from the cash open. Let's get you some morning movers with Yahara. Hey, Yahara.
Hi, John. We start with the health insurers falling this morning after the Centers for Medicare and Medicaid Services said that it will audit all Medicare Advantage plans annually as part of a wider crackdown on improper payments. So as a result, we're seeing Humana shares down nearly 4%, while United Health, the nation's largest insurer, is falling 2.8%. But that stock just can't catch a break these days. Next up, we have Navitas. Those shares are skyrocketing, up 176% now on news that it's teaming up with NVIDIA, getting that NVIDIA glow as we've all come to know it. The two will develop technology that basically powers AI data centers more efficiently. Navitas says that the system will cut cooling costs while boosting power efficiency. Of course, all key for NVIDIA's GPU-heavy workloads. And staying on the technology sector, we do have Snowflake shares. Those are also rising nearly 10% now after the data warehousing company crushed expectations in its latest results. Hear this. They saw product revenue growth of 26%, hitting nearly $1 billion in the first quarter. And they see no signs of that slowing, with demand staying strong for its new AI tools. John?
Yahara, thank you. More from Yahara later this hour. On our radar this morning, our top story, the House passing President Trump's big, beautiful bill. The bill includes a $40,000 limit on the SALT deduction, speeds up work requirements for Medicaid, and puts an end to Biden-era clean energy tax breaks. It now heads to the Senate for their consideration.
Now heads to the Senate, where we're going to see changes in a lot of those provisions, Jonathan. Higher SALT deduction limit, that $40,000. Potentially that's a high watermark, and this is going to come down. There's not a lot of senators that are interested in increasing the SALT cap because there's no Republican senators from high tax states. Things like Medicaid. Potentially this is just too aggressive for some senators to sign up for. And those clean energy incentives from the Biden era, all those grants, a lot of those tax subsidies went to Republican states. You have someone like Senator Tom Tillis. He doesn't want those to go away. He wants them to last as long as possible. So the Senate is going to make this a lot more moderate and then send it back to the House. And that is when Speaker Johnson's job gets incredibly difficult.
And this is the ultimate point of tension, and we've talked about it a million times. This is where the real challenge lands at the feet of the President of the United States to attempt to broker a deal. How do you please the SALT caucus and the fiscal hawks in the Senate?
It's going to be very challenging because I really have a question this morning seeing this vote count. What did the president promise the Freedom Caucus last night in the Oval Office that so many of them were willing to either vote present or vote yes, like Chip Roy, when it comes to this bill? It is going to be very challenging because he has to please a lot of different individuals and factions, but their margins are so slim. So everyone is going to get a little bit of something, but everyone's going to get everything they want.
None of this is pleasing the bond market, particularly the 30-year bond. The JP Morgan Chase CEO, Jamie Dimon, saying the U.S. faces stagflation risk thanks to geopolitical tensions, deficits, and price pressures. Dimon adding he thinks the Fed is right to remain on hold. The 30-year yield this morning, higher now by close to 4 basis points. We're basically closing in on 513 on that yield now.
And right now, Washington isn't exactly paying attention. I'm sure Jamie Dimon is. He says the economy is doing well. Effectively, we are in a soft landing, but does not tell you what the future will be. And he talked about huge deficits. He talked about The Fed hasn't finished quantitative tightening, and he talks about huge geopolitical issues. And all of this is why he's talking about this idea that he doesn't agree we're in a sweet spot and thinks potentially there could be these stagflationary fears.
Let's get to the higher prices. Nike raising prices on some of its products. Reuters reporting the hikes will begin next week. Prices for clothing and equipment set to increase between $2 and $10. Items between $100 and $150 will see a $5 hike. Shoes over $150 will see a $10 jump.
So once again, we have another company coming out and saying we are going to have to raise prices. How they talk about it, I don't think they mentioned trade tariffs or the president, knowing squarely that if they do, they might get blasted by this White House. But obviously there's concerns with trade, especially given the fact that Nike has a lot of manufacturing in China. One thing I thought was very interesting and potentially an olive branch, this White House, and the fact that they know that it is back to school. They're not raising prices on children's sneakers. That is a huge item for American families and parents when they're getting their kids ready for September.
Nike in the pre-market is higher by 1.5%. Let's stick with retail. Eric Fish of HSBC writing, because of all the front loading on shipping, we don't totally know the true impact of tariffs yet, but the picture will become clearer as we get to the end of summer. Eric joins us now for more. Eric, good morning. It's good to see you.
Good morning. Thank you.
Just walk us through the state of play, just how things are, because it's really difficult for us, because of the front loading, to understand what is real, sustainable demand and what is just flattered by all of the front loading.
Yeah, I think that's a great question and something no one will be able to answer till we start seeing sales through summer, into fall, into back to school. I think what's important to differentiate is consumer sentiment from consumer spending. Consumer sentiment, all-time low, scary headlines. People keep spending. We're seeing that through the April numbers even, after Liberation Day. And so I think what's interesting is some of that sort of panic pre-buying? Maybe. But you generally don't go out and buy 5 pairs of jeans because you think prices are going to increase. That's more an iPhone story.
For economists out there, are you basically saying don't follow the University of Michigan consumer sentiment number, watch the labor market, watch jobless claims?
To me, jobs are paramount. People shop when they're comfortable in their employment, and regardless of savings almost, and then vice versa is true as well. When people are concerned about their job status, even if they have significant liquidity, they pull back on spending.
But right now, we do see in surveys, people are saying they are worried about the labor market.
Yeah.
But spending continues.
But continue to spend. And that's not dissimilar from what happened during COVID. People were genuinely terrified, but continued to shop.
I'd love to get your take on how these retailers talk about prices going up. They're taking different tacks, and it sounds like they are nervous about retribution from this White House. How do you view this situation right now between Washington and the C-suite?
Yeah, I speak to retailers, wholesalers, manufacturers. Everyone is trying to manage the process and share the pain. So we are seeing a split. We're seeing people on the factory side and then the wholesale side absorb some of the price increases. I think it really is different price point by price point. If you're selling a $300 sweater and it goes to $350 in the fall, that customer is not super price sensitive. If you're selling a $9.99 item and it goes to $11.99, that's a significant difference in demand. So price point by price point, it differs.
So when the president says eat the cost, who is eating most of the cost?
Yeah, it really ends up being almost a third, a third, a third. The shopper is a third, the retailer is a third, and then the factory is a third. Now, for that low price point, people are trying to trade off some margin to hold the volume. Because as you raise prices, it's a pretty precipitous drop in demand.
What did that split that you just described look like back in 2022? What did it look like coming out of the pandemic?
Yeah, I would say it was much more on the factory side. When it was a smaller increment of tariffs, people were able to put pressure on the factory to absorb more of it. This is a more significant amount, and so people are sharing it.
I just meant in terms of consumer confidence and the ability to really pass this on to the end consumer. Do you think there was a lot more confidence to sit there and say, you know what, consumer can eat this, let's pass it on? Have things changed in the last few years on that front?
Yeah, I think that's fair. Demand was strong then, and so to the extent that prices went up, we didn't see a significant change in consumer demand. I think shoppers have really shifted more dollars. First of all, everything costs more. More dollars have shifted to items other than discretionary consumer products. And so when you're chasing fewer dollars, you have to be more careful.
Seems to be what's hurting Target right now. that shift from discretionary to necessities. Who's in the sweet spot? If there can be a sweet spot in a moment like this one, who's in it?
Good brands, good products that will always win over the consumer. So if you're on trend, if you have the right product, you are more insulated from price changes.
But which retailer is in the sweet spot?
I'm not going to name a specific retailer. Many of them are my clients, but you know, you look at things that are on trend, that have high demand, that are.
But is it fair to say if you're bigger, you can withstand all of these challenges right now?
Yeah, absolutely. Size matters, but I would say at both ends of the spectrum. So if you're small and nimble, we've seen the same thing with our clients, where you can shift. If your production process is more streamlined, you can shift that production to another country a lot faster than a massive organization.
Target talked yesterday about improving agility, and I think some of that speaks to what you're talking about. Eric, thanks for dropping by. Fantastic to catch up. Eric Fish there of HSBC, and what's happening with the retailers at the moment. We need to talk to you about what's happening in the bond market at the moment off the back of the passage of the bill down at the House in Washington, D.C. Yields are higher by 3 basis points, 512. It's been a theme of this program so far this morning, Washington versus Wall Street. Fact of the matter is, for a lot of people, very engaged with the people that operate down in Washington, D.C., what happens on Wall Street, they don't pay a ton of attention to until they really have to. And apparently 512 is not the number that gets that done.
That's definitely not the number that gets that done, not this morning. And we need to remind our viewers that this is the first step of a very long hurdle when it comes to the 13B, the One Big Beautiful Bill. It's going to go to the Senate, and it's going to get moderated. There's going to be a number of changes across the board: clean energy incentives, the SALT deduction, things like Medicaid. It's going to be almost sanitized in the Senate, and then it's going to come back to the House. And that's when the fight really begins.
Bond yields just a little bit higher. Equities a little bit lower, just turning negative on the S&P 500 after being positive by about 1/10 or 0.2%. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahira. Hey, Yahira.
Hi, John. Well, recapping what's happening in Washington, the House narrowly passing President Trump's One Big Beautiful Bill by a vote of 215 to 214. The bill now moves to the Senate, where debate will begin on June 2nd. The upper chamber will make changes to the bill before sending it back to the House. Speaker Johnson hopes to deliver the bill to the president's desk by July 4th. Meanwhile, a rally in Bitcoin, the original cryptocurrency, topping $111,000 at one point earlier. The latest milestone comes as President Trump prepares to meet with the biggest holders of his meme coin at a dinner tonight at his golf club just outside Washington. Bitcoin is up 18% so far in 2025. And in sports, Game 1 of the NBA's Eastern Conference Finals was one to remember after the Pacers came back to beat the Knicks at Madison Square Garden. The Knicks were up 14 points with less than 3 minutes to go in the fourth quarter, but the Pacers stormed back and tied the game on a wild buzzer-beating shot from Tyrese Halliburton. Indiana held on to win in overtime, 138 to 135. Ouch. That's your Bloomberg brief. John?
Yahira, thank you. More from Yahira in the next hour. Up next on the program, Jamie Dimon, unfazed by the bond market.
How high do yields have to go before they reach breaking point?
I don't know the answer to that. I don't worry about one-day move in bond markets. I just think there's a chance that you'll have stagflation.
Up next on the program, we'll catch up with Greg Peters of PGIM as bond yields at the long end of the curve go through levels we have not seen since 2007.
the President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China. In 2023, it's something like $40 billion. And whatever the tariff rate ends up being on China is going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The reason we were so aggressive, and I know some of y'all smiled and probably mocked me a little bit when I said early on we were going to do this by Memorial Day. You didn't believe it. I know you didn't, Reese. Most of you didn't. But the reason we did that was not because we had a pride of authorship or because we were trying to, raise some banner. We did it because we need to get this relief to the American people as soon as possible. And President Trump made these promises on the campaign trail, and we did as well. And we wanted, as Jim Jordan likes to say, we're going to do what we said we were going to do. And that's what this bill represents. And so the timetable is important. We also have the debt ceiling approaching. We've got the relief that the people need. And the sooner they feel that relief, the better. So we did our job, rolled up our sleeves, got it done. And we're really proud of that effort. One more question. Yes, ma'am.
Is there anything that the Senate might be considering in terms of changing this bill that you all will not accept?
I'm not going to draw any red lines. Look, I told them there's a lot of different opinions over there as there is here. They have a small margin as we do. We had a 3-vote margin. By the way, I just want you to know for the record, we really had 217 votes this morning. Andrew Garbarino did not make it in time. He fell asleep in the back. No kidding. I know. I'm going to just strangle him. But but he's my dear friend. And then David Schweikert was going to vote and slipped his card in right at the last minute. So it looks like a razor-thin margin, 215 to 214 and one present. It was really 217, okay? We all put a footnote somewhere in history on that thing. They're both going to go on record saying that's how they would have voted if they got the card in time. Thank you so much for being here. Bless you all. Thanks all these guys. Thank you.
Speaker Johnson wearing a big smile this morning from New York City this morning. Good morning. To those of you just tuning in, Speaker Johnson up all night, and this bill passing the House, making its way to the Senate for their consideration. The one big, beautiful bill advances in Washington, D.C., and this is what it does on Wall Street. Equity futures just turning a little bit lower. I won't make too much of this, but at the long end of the curve, that move continues. Bond yields at the long end higher by a few basis points, call it 3 or 4. We're at levels we haven't seen since 2007, 512. 86.
The bond market is looking at this and looking at the trillions of dollars this is going to add to the deficit. This is a huge win, though, for House Republicans. Speaker Johnson there, though, I think the most interesting line was, I'm not going to draw any red lines when it comes to what's going to happen in the Senate, because he knows very well, especially given the conversations he's had with the president and senators and Majority Leader Thune, that this bill is going to get changed.
Greg Peters of PGIM Fixed Income is with us in the studio. Just the perfect guest to talk about what's happening in the bond market. Greg, good morning.
Good morning.
What do you make of these moves to the long end of the curve? I don't want to make this too much of a big deal if it doesn't have to be. We have sustained levels around 4 to 5% for quite a number of years now, and the economy's been okay. What does 512, 513 mean to you on a 30-year?
I think it's the direction, right, not the level. And so there is just a
pushback globally on the back end of the curves. So if you look at what's happening in Europe, you're looking at Japan, obviously the U.S., investors are basically having a timeout on the back end. And so consequently, you're just seeing the 30-year, 20-year yesterday really trade heavy just because there's not that investor demand. I think investors' concerns are manifesting itself in term premium and kind of wait-and-see mode in the back end of the curve. And that makes sense to me.
Can you help us understand the things we should care about and the things we should ignore? Typically, a 20-year maturity isn't something that investors like anyway, and it's auctions that we don't typically follow. All of a sudden yesterday, 20-year auction, self-demand, and everybody cared about it. And I sat there and I just thought, if you care about 20-year auctions, you have no place in the bond market. What did you make of how much weight people put on that?
Well, so the 20-year definitely is an orphan type of maturity bucket. But what it says is about the duration. So forget about a 20-year, 30-year. It is adding duration to the portfolio. So that's where the pushback is. And 20 years are trading poorly everywhere as well. So it is an anti-duration trade. And what you're seeing in the back end curves globally is that they're behaving like risk assets, not like the typical kind of defensive risk-adverse assets. And that just kind of feeds upon itself, which is why you have two separate bond markets. In the front end, you have yields and prices driven by central bank policy. And as you move further out, it's driven by all these other factors, from debt and deficits to inflation to the uncertainty to all these
Greg,
factors.
what you're saying is so important. If we've diluted the risk mitigation characteristics of the long bond, what does that mean for how people invest? And what are you telling clients of PGIM that they should do?
Yeah, it makes it really tricky. And what you're seeing is kind of manifold. First, you're seeing just investors kind of diversify globally. So you're seeing less of a sole focus on the U.S. bond market. So you're seeing in gilts, you're seeing in JGBs, you're seeing it across, just to get that diversification in. And then, second is front end of the curve, right? You want to be attached to something that you think you have a better understanding, and that is the central bank reaction function. So in our minds, you want to be as close to that kind of 2-year front end point as you can. The further you drift out, the more vagaries you introduce into your portfolio. So to get defensive, I think, is to kind of stay front end. And that includes spread and carry as well. So we're very defensive. We think valuations are exceedingly expensive. I mean, just kind of think about it in really simple terms. Credit spreads are well through kind of the average, and I think all of us would admit it's probably above average uncertainty out there and risk, and so just kind of think of it in that simple way, and you want to be defensive.
And that uncertainty is emanating from Washington, D.C. Can we talk about that relationship? Is there a line you think that Congress actually starts paying attention to?
It has to get worse. So the only arbiter out here right now is the bond market. So it's kind of back to the 90s, right? Kind of Carville's revenge. And so absent that, there's no political will. You saw this bill last night. It was casting dogs and all these things. No one wanted to cut, and all these things were added. It's not the political will of Congress to kind of tighten the belt. And what you're seeing from a market perspective is really worrisome outlook on the debt and deficit. And quite frankly, it is worrisome. It is a really bad place, right? We never took our deficit to a better place when the economy was doing well. And so what I really worry about is not the here and now, but let's say when and if we do enter a recession, then what? There's one or two options. One is Congress doesn't do anything fiscally, which means you have a longer, harder recession. Or they do as they always do, they spend, and then you come out the other side, and the debt and deficit is exceedingly worse, and then you put us in a real precarious position.
$1 trillion question. Can I just jump in quickly? Forgive me. What you just said is so important. Typically in developed markets, what happens is you go into a downturn, yields drop, and it enables fiscal authorities to act counter-cyclically.
Yeah.
This is also important to investors because they understand that's the ballast in their portfolio. You get into bad times and bonds rally. That is the definition, for me at least, of a developed market. That's what happens in DM. In DM, you have problems, other things happen. Are you suggesting that if we go down into a downturn and the deficit, just by definition, blows out, that yields don't drop, that they actually might climb?
there's that potential. I think it's a level of uncertainty that is introduced that we typically don't have to worry about, right? And just the fact that we're having that conversation and that question just changes behavior. So, you know, what we saw in 2021, 2022, when inflation moves higher, as an example, there's nowhere to hide, right? So this is a kind of a similar story in a way. So that's the worry. It's not my base case, by the way. I don't want to be all dark and dour here, but at the same time, that is a real risk that investors face.
This is just a really important thought exercise that I think is happening on investor committees around the world right now. I just wanted to finish with the level that we're at the moment. So 5.14 now, almost on a 30-year yield. When I started the conversation, I talked about somewhere between 4 and 5. We have lived with that through this cycle so far. But when you get to the upper end of where the range is for the whole cycle, which is basically through that level right now, life up here hasn't been sustainable. Is this self-limiting? How sustainable are these levels?
I think to a degree it is. So I do believe there'll be a crowding out effect, so to speak. So if you continue to move yields higher, that just changes the incentive structure, right? So investors are much more apt or willing to invest in treasuries, let's say, vis-a-vis investment-grade corporates and equities. And so there is this great kind of modulator, regulator function with yields itself. But at the end of the day, you have to have a higher level of certainty of what you're investing in. And so, yes, as yields go higher, that compensates you more for that uncertainty.
Yeah.
But typically, you don't see investors jump in when they don't know what they're jumping into.
They're not jumping in right now, that's for sure. Greg, appreciate your time, as always, sir. Thank you. Greg Peters there of PGIM. Up next on the program, we'll catch up with Scott Cronin of Citi, John Navallo of UBS, Nita Richardson of ADP, and a whole lot more.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country, and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read?
It's a challenge with the digital age because people they're reading on tablets, so we do count that as reading. If you have an ebook, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries as, and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Our political system is showing absolutely no signs of slowing down the borrowing, and this is going to continue to rattle bond market holders.
What the bond market is worried about is that over the longer term, it will increase the deficit.
Congress is not doing its bit, so the bond market has to force Congress to do its bit. And so I think that's why the long end is scary.
The number one risk right here and now is that long-term bond term premium.
We could have a debt crisis scare.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
What a morning already. Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. The game is between Washington and Wall Street. The House passes its bill onto the Senate, and Wall Street pushes back. Equities are down by 0.4%, but check out the bond market. This is the move. It's the move in the long end of the curve. The 30-year yield higher by more than 4 basis points, call it 5. The yield this morning, 5.14, a level that we haven't spent much time at, if at all, since 2007.
Well, Jonathan, Wall Street's pushing back. Is anyone in Washington listening? They're not. They just voted on this bill. But we really need to talk about the fact that this is the start of a very long process. There are reports that the speaker's now going to get on the phone with the president. Clearly, they're going to be excited. They delivered. But it's going to be an uphill battle. I think the most important line that came out of after this vote was Speaker Johnson saying, I don't have any red lines, because he knows that he is going to have to do a lot of gymnastics with his caucus to try to get them to vote again once the Senate makes massive changes to all these negotiations he just spent the whole week inking.
Let's go through the timeline and then frame the problem. So here's the timeline. Get it passed through the House by Memorial Day. Done. Get the whole thing signed, sealed, delivered by Independence Day, July 4th. Here's the challenge. The challenge is trying to satisfy the SALT caucus in the House at the same time you satisfy the fiscal hawks in the Senate. How are they going to achieve that in the next several weeks?
It's going to be very challenging, and there's going to have to be, as Rob Casey said, some individual levers being pulled, provisions put in the bill just to get a single individual to vote. I think SALT is going to be the hardest for the Senate. There is not a single Republican senator from a high-tax state like New York. There is no impetus for any of these senators to say, yeah, I'm willing to vote for a bigger SALT cap. It's going to be very challenging. So this is where President Trump is going to have to get involved when it comes to this negotiation between the lower and the upper chamber.
There's a lot of self-importance on Wall Street. I get it. You make the world go round. I'm right there with you. Yields are higher by 5 basis points this morning, 5.14. The feeling I get, though, from you and other people that spend a lot of time in Washington speaking to these people is that these moves don't really matter that much to these people down in Washington, D.C., and I think you saw that playing out quite clearly this morning.
It was just convenient for a lot of these individuals yesterday that have been going on for their entire career, that the fiscal health of the United States is on a trajectory that's going downward. So individuals like Chip Roy, they're coming out and saying, noted, I see what's going on in the bond market. Look, yields are pushing back on our one big beautiful bill. But no one in Congress really cares. They want to get this bill across the finish line. There are 2 people in Washington who do care, though, about the long end of the yield curve. And that's the President of the United States. And we saw him reverse his tariff policy when the bond market was, quote, his words, yippee. And also the Treasury Secretary. He sat around this table and told us that he cares about the 10-year yield.
The 10-year yield this morning, 4.62. Coming up this hour, Scott Cronin of Citi. As risk appetite on Wall Street fades, we'll catch up with John Navallo of UBS as home builders signal resilience in the face of higher rates, and Nisha Patel of Parametric reacting to the latest economic data. We begin this hour with the House passing President Trump's signature bill, sending it on to the Senate.
On this vote, the yeas are 215, the nays are 214, with 1 answering present. The bill is passed.
Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, the bill is passed. What next?
Yeah, hey, John. Well, it was interesting to get some color from House Speaker Mike Johnson there afterwards when he took some questions from reporters, saying that there were a few different moments during this past week where he thought the whole thing was going to fall apart. So we do know, of course, that he had to really do some of these big deals behind the scenes, and that's going to have to happen again when this bill moves over to the Senate. He then was also asked if he's concerned about whether or not the Senate's going to completely change this legislation, since we know there are a few items here that are definitely up to be potentially on the chopping block or changed altogether. And he said that ultimately he is already starting to make his case to senators that there is a delicate equilibrium, as he called it, just to get this through the House, and that they need to recognize that ultimately at the end of the day, they're going to have to work with the lower chamber to get the entire reconciliation package done. John, of course, there's a few different pressure points here that are going to come into the picture when it comes to getting the Senate to move on this. One, of course, is the White House, but the other is that X date and whether or not Republicans can get this done by August, which is where we're currently seeing those estimates land, as the White House wants it done even before that, by July 4th.
Tyler, how likely is July 4th, honestly?
We're going to have to wait and see, Anna Marie, of course. We didn't really think that this Memorial Day deadline was considered to be pretty ambitious. So at the end of the day, it's going to definitely take some more of these deals. What that will look like, we're going to have to wait. Of course, we know that likely there will be changes to how House Republicans have currently implemented those work requirements going into effect perhaps ahead of schedule, now slated for December of 2026. Also watch out for how those IRA tax credits when it comes to clean energy end up getting rolled back. We know that many senators here have already expressed concerns about rolling them back quickly, since some of these companies are already banking on using them. And then the SALT cap, will that really remain at $40,000? We're going to have to see what sort of deal is worked out there, because at the end of the day, it does need to agree in both of these chambers if President Trump wants to see the one big beautiful bill fully realized.
Tyler Kendall down in Washington. Tyler, thank you. The latest developments in the nation's capital. The latest developments here on Wall Street, yields up by 4 basis points. The 30-year, 5.14. It's just a bit of a perfect storm. Typically, we wouldn't talk about a 20-year auction. That 20-year maturity, as we heard from PGIM and Greg Peters, a bit of an orphan on the yield curve. If you just look at how it sticks out, a bit like a sore thumb. People don't really like it anyway. But the fact that people were concerned by that yesterday, you add in maybe the hot inflation in the UK, you add in the issues that we had in Japan, you add in the bill that's gone through Washington, D.C. this morning. It's all of that. It's a global story, not just a domestic one.
Yeah, Neil Dutta actually pushed back on me on this yesterday. We were chatting, and he said, look, this isn't idiosyncratic what's going on in the United States. Look what's going on globally. But what is happening is in the United States is we saw the bond market push back on Trump's tariff policies. We saw him reverse. Now we're talking about, when you look at CBO scoring, you look at Penn Morton scoring, we're talking about trillions of dollars, north of $3 trillion over 10 years being added to the deficit. And the bond market's saying you are not doing enough to control spending, and they are pushing back. I thought what was so interesting about Greg Peters is he's talking about this direction of travel, where things are going. Because I think the bond market's smart enough to know that this bill that was just passed is not going to be the end destination for this specific one big beautiful bill. But it's the direction of travel where the fiscal health of the United States is headed.
Equities down this morning by about 1/3 of 1%. This is the view on Wall Street from Scott Cronin at Citi, writing the following. Recent signs of consumer slowing are concerning. We bias in favor of a combination of defensive names and secular growers that have been more heavily investing in their businesses. Scott joins us now for more. Scott, welcome to the program, sir. We need to take a bit of a beat and talk about what's developing in the bond market and what ultimately it means to you and the team in equities, Scott. What happens when we get to these kind of levels in bonds? What does it mean to you?
Jonathan, well, it means a couple of things. I think first and foremost, you look at the potential impact of higher rates in terms of a slowing effect in terms of demand for new credit. That's pretty straightforward. Additionally, from an equity perspective, it's mostly about valuations. And essentially, when you're looking at how to value securities, it's a combination of where you think near-term fundamentals are going, but it's also how you discount future earnings 5-10 years down the road and assign a valuation to terminal values. And so what ends up happening here is when you back up yields, you begin to change the math, and those future earnings are worth less now. So the bottom line is that from a valuation impact, when you look at this current trajectory in 10 years in particular, where we focus, it's a gating factor potentially on future economic activity, but essentially real time, it's an overhang in terms of the valuation setup for U.S. equities.
When you look at the policy down in Washington, Scott, we do have the one big beautiful bill passing through on the House side, and the bond market seems to be pushing back on a number of issues. But what if they didn't do anything and we would have a tax hike at the end of the year? What would the bond market do then?
It's kind of pick your poison, right? So what you would get with the tax hike, which was where we were a year ago at this time looking at potential presidential election outcomes, is that you would have a different influence where you would probably begin to slow aggregate spending levels. You would crowd out essentially expenditures because more of your income is going to taxation. So essentially, it's to be careful what you wish for. The bottom line, Emery, is that we've been living in a fairly fiscally stimulative environment going back to the pandemic. That's when you really began to see your debt to GDP rise. And now with the Fed rate policy in the rearview mirror, you're also looking at the debt service component kick in as well. So essentially, from my perch, from an equity perspective, you get the deficit spending. That's fiscally stimulative. That's actually pretty good for economic activity and probably for corporate fundamentals. But the offset is what you're doing in terms of paying forward now for future pain in terms of the risk of higher for longer rates, the valuation impact, and the ultimate slowing effect that can have on economic activity.
So, Scott, as you know, the economists over at Citi, your colleagues, are worried about a downturn, a hit to the labour market, and they think we're going to see a real reduction in interest rates. I can tell you in fixed income, the conversations we keep hearing is that they don't know what defence really looks like anymore, and they don't want to play out on the long end of the curve. They want to aggressively shorten duration. Scott, how does that apply to equities? How are you thinking about defence now compared to maybe years gone past?
You know, Jonathan, we pulled out, a month or so ago, our in old playbook, a tactic of ours, where when you go into these periods of economic concern, we like to pull out growth as defensive as our approach here. And so what I'm getting at is that you're dealing with lots of issues in terms of economic activity that affect the way you think about traditional cyclical parts of the market and also traditional defensive parts of the market. However, when you look at longer term, where are the best underlying structural growth dynamics at work? There's still the AI play here, but you can broaden it across sectors. We've been writing more recently within the consumer discretionary sector as an example. But my point here is that one antidote to a lot of the issues that we're discussing right now in terms of rates, economic activity, deficit, is show me the growth, where I've got more confidence in longer-term structural growth drivers at a company-specific up to a sector, maybe even market level. That, in our view, is the more appropriate way for navigating the current period of uncertainty that we've got from a fiscal and economic perspective.
Scott, when you screen for those things, does it scream Mag 7?
It has to start there, because where you go with this, Jonathan, is let's look at where companies are spending. Capital spending, for the most part, is very concentrated within the S&P. The mega cap growers that are attached to the AI trend are certainly driving the bus right now. And what we saw with Q1 earnings is that there's not much of a risk to that materially changing in the short term. However, when you look across sectors, again, I mentioned consumer discretionary, you can find companies that are showing capital expenditure profiles well above depreciation, where their fundamentals are also less cyclical, and the correlation of their fundamentals is less tied to economic activity. Those are the types of names that we want to keep a focus on. And I think that's an appropriate way for thinking about the valuation issue we have with broader equities, as well as how to think about navigating this current macro setup, which certainly is noisy at the very least.
Scott, when you put consumer discretionary and you break it up, how much performance dispersion are you seeing within that group of stocks at the moment?
There's a lot, because at the same time, consumer discretionary and staples right alongside, that's ground zero for where tariff effects are kicking in, particularly as it relates to the China aspect on this. So what we've seen through the tariff discussion over the past several months is a very strong dichotomy in performance within the consumer part of the market, where you got companies that are more directly exposed to China feeling the real brunt of that. But again, I'd come back here. It's less about the inflationary component of tariffs. It's more about the gross margin pressure that potentially emanates from your higher cost of goods that you're importing. So Bottom line is that there's a lot of performance dispersion, and so we're kind of cutting through all that noise with let's keep a focus on companies that we think structurally are in a pretty good position to perpetuate ongoing growth, again, regardless of the macro circumstance right now.
Scott, appreciate your input. As always, what a morning already. Scott Cronin there of Citi breaking down the equity market for you. As this bond market breaks down a little bit, yields up by 5 basis points on a 30-year. We're looking at 5.15 now at the long end of the curve.
And you wonder who in Washington, D.C. is actually running a bond board right now, besides maybe the Treasury Secretary and the President of the United States, who we do know the bond market reacted negatively with yields rising when it comes to his tariff plan. He reversed course. They're not going to reverse course on this bill, but what this bill will do is it will become more moderate in the Senate. So that SALT cap might not be as high. Those Medicaid cuts actually might be pushed out, or the work requirements might start later on in a few years, not in 2026. So this is the start of a very long process, but I don't really think anyone in Washington, D.C. is paying attention.
Some of these issues are why a lot of investors have thought about aggressively shortening duration, and why many guests on this program over the last several weeks have talked about the so-called belly of the curve. They like the 5-year. The 5-year is rallying this morning. Yields are down by 2 basis points, and you've got this curve steepening taking place where the front end, the yield is dropping, and the long end is selling off. The yield is climbing. And the difference between the two now, 5s and 30s, is through 100 basis points. They're the moves on the screen this morning. Let's get you some stories elsewhere. With your Bloomberg Brief, here's Yahira. Hey, Yahira.
Hi, John, and it's because of this, the House narrowly passing President Trump's One Big Beautiful Bill by a vote of 215 to 214. The bill now moves to the Senate, where debate will begin on June 2nd. The upper chamber will make changes to the bill before sending it back to the House. Speaker Johnson hopes to deliver the bill to the president's desk by July 4th. Meanwhile, Disney is suspending Venezuelan workers following the Supreme Court's ruling that allowed the Trump administration to revoke protections for 350,000 Venezuelans. Disney notified its Florida-based employees who are losing temporary legal residency that their jobs would be terminated next month. The company said about 45 workers are affected. And OpenAI is buying the device startup co-founded by Apple veteran Johnny Ive in an all-stock deal worth nearly $6.5 billion. Ive and OpenAI CEO Sam Altman will work together to create new devices around artificial intelligence, with their first product expected next year. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. Equities making new lows here as this bond market yields make new highs. Up next on the program, the morning calls, plus John Navarro of UBS as home builders signal resilience in the face of higher rates. Live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today, and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Washington loves a long weekend. Don't they love a long weekend? That was the incentive to get this done before Memorial Day. Speaker Johnson did exactly what he said he would do, passing this bill by Memorial Day with days to spare. It's on to the Senate for their consideration. Equity futures on the S&P 500 negative by 0.5%. On the NASDAQ down by a similar amount. On the Russell down by more. We're down there, softer by 1 full percentage point. It's the bond market that gets your attention again today. Check out the front end, compare it to the long end. Yields lower at the front end by 3 basis points to break a 4%, and we add some weight to the long end again. The 30-year down, yields up by 5 basis points, 5.14.15. We'll come back to that in just a moment. That's the price action. Let's get you some morning calls. First up, Bank of America downgrading target to neutral, citing the company's uncertain outlook. That name is down by 1%. Your second call from JP Morgan, upgrading Urban Outfitters to overweight, pointing to positive sales growth across brands. That stock is flying by 17%. And finally, Wells Fargo, raising its price target on Toll Brothers to 130, expecting outperformance following better than expected earnings. That name is down just a touch by 1%. Let's stick with Toll Brothers, the company maintaining its 2025 outlook, citing resilience among its affluent buyers. John Lovallo of UBS reiterating his buy rating and 183 price target, saying we remain positive on shares given the company's consistent execution. John joins us now for more. John, welcome to the program, sir. Before we get to the stock-specific stuff, I just want to talk about the broader story for the home builders right now and what a 30-year of 514-ish means for the industry you cover.
That's a great question, John. Thanks for having me. Look, I think it's important to understand that the 30-year fixed rate mortgage is at around 7% right now, maybe slightly above. The builders have executed at levels well above this. And I think that it just demonstrates the changed business models and the ability to really navigate tougher environments. Now, look, if we take a broad step back and just look at sales this year, we're up slightly on a new home sales basis, but it's been driven by incentives. Keep in mind, an average incentive for a home builder is about 3% of the sale price of a home. We're up around 8 or 9%. So the builders are offering a lot to get these sales across the line. Now, because sales have been a little weaker, the builders have done the rational thing and have pulled back on starts. And this is very synonymous with this new business model that they have, where they're much more diligent about how they're kind of putting inventory into the market. Now, importantly, this pullback in starts has allowed them to maintain margin and maintain some pricing. Now, keep in mind that intent to buy is still very strong in the U.S. Our recent survey, Global Housing Intention Survey, which is the longest standing on the street at UBS, signaled that 32% of respondents intend to buy a house over the next 12 months. That compares to the long-term average of 30%, the pre-COVID average of 25%. So intent and desire is not the issue. It's just getting affordability right.
Well, the CEO of Toll Brothers said that they believe the long-term outlook for the new home market remains positive. How is it so positive if yields remain so high?
Hey, Anne-Marie. I think it comes down to a couple things. One, underlying demand, as I mentioned, and intent is still very strong. There's a very strong wave of first-time buyers coming through the market right now that are reaching prime home buying age. This is a good example of the millennial generation. They've done things a little bit later in life. They're better financed. And oh, by the way, they're receiving part of this $64 trillion of generational wealth transfer from the baby boomers to help with down payments. 25% have said that they're receiving down payment assistance. And so as these folks have life events like getting married, having children, it necessitates more space. And this is really, really driving strong underlying demand for housing and will continue to over the next 5 to 6 years.
John, I'm sure you can break down the numbers to some degree. Toll Brothers, that's a super, super affluent customer base. How many of those are borrowing money? How many of those are paying cash?
It's a good question, John. Look, I think a couple things with Toll Brothers. They do have an average selling price of $1 million, that's for sure. But they span a wide spectrum. They go from $300,000 up to $5 million. So they do have a pretty good broad spectrum across the group. About 25% of their buyers pay all cash. The rest are getting some kind of financing. But look, it is a more affluent buyer for sure. Even at the first time level, I would tell you that their first time homes are generally around $500,000.
Out of all the names you covered, John, who do you think is most exposed to this rate story? Which is the company that you're less constructive on?
From the home builder space specifically, we're pretty constructive across the board. We favor, to answer your question, still, believe it or not, the entry-level players. Now, we do take a bit of a barbell approach where we like Toll at the high end, but the entry-level players are bringing product to the market that is affordable. Keep in mind, the median home price in the U.S. for existing homes is $408,000. That's above the median new home price, which is $402,000. And then you get a company like D.R. Horton or a Meritage, for instance, that are bringing new homes to the market at $30,000 below that price, and that's compelling. And if you can couple that price with, a mortgage rate buy down, all of a sudden the wheel starts turning and you can get more folks qualified for homes.
Hey, John, appreciate your time. As always, sir. John Navarro there of UBS on the home builders. The home builders in focus for obvious reasons with this move in the bond market. The move in the bond market off the back of the passage of the bill down in Washington, D.C. through the House. Hearing from the president right now, the one big, beautiful bill has passed the House of Representatives. He goes on to say, now it's time for our friends in the United States Senate to get to work and send this bill to my desk as soon as possible.
He says there's no time to waste, but this is where the president is going to have to do a lot more work on Capitol Hill in the upper chamber and the lower chamber, trying to converge all these factions to get to yes at the end of the day. This is the start of a very long process. There's a lot of senators that do not like what's currently in this bill.
It's amazing how happy Washington is this morning. For good reason, they're passing this on time. This was an objective they campaigned on, but then at the same time, just this nagging feeling that the bond market's got something to say about it. 30-year yields up by 6 basis points, 5.15. Up next, some data. Jobless claims just around the corner.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. The countdown is on. Every everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
We've got a really interesting session coming together down in Washington, D.C. They've been up all night. That bill has passed, the one big, beautiful bill, making its way to the Senate for consideration. And this equity market is speaking loud and clear. Equities near session lows. On the S&P, we're down by 0.5%. On the Russell, that's where your underperformance is, negative by 1.2%. In the bond market, check out this move. At the front end, a rally, yields down 3 basis points. At the long end, a sell-off, yields up 5 basis points. 5.15, a level we haven't seen since July 2007. And this Congress, Anne-Marie, didn't blink.
Didn't blink at all. They passed this beautiful bill along. The President of the United States is celebrating right now on Truth Social. The most important line, though, in here is now it's time for our friends in the U.S. Senate to get to work, get it to my desk as soon as possible. This is the start of a very long process, and this bill is not going to look the same when it comes back to the House after the Senate does their tweaks.
We've got to talk about some economic data, so let's look at jobless claims, initial jobless claims, together with continuing claims. Jobless claims coming at 227. The estimate was 230. The previous week was 229. Continuing claims rise a little bit. The wrong kind of upside surprise. But jobless claims at 227. This is where the debate down in Washington is interesting to me. We're running a budget deficit of 6% of GDP, with jobless claims still very close to historical lows at 230. Unemployment still around 4%. By definition, at the headline level, and I know there's a lot of bifurcation beneath the numbers, but at the headline level, these are good times, supposed good times, and we're running monster deficits in Washington.
Absolutely, and people say during the good times, which you're seeing right now potentially, this is when they should be working on trying to bring the fiscal house in order. And what you see right now with this bill is that this is going to add trillions, whether it's the CBO, whether it's Penn-Morton budget model, which is a little bit more of a dynamic scoring. This is going to add trillions over the course of the next 10 years. But Jonathan, what's the alternative? If they do not do this, which the baseline of this bill is extending Trump's first era TCJA tax cuts, it's going to be a massive tax hike for American families. And that is something that is politically untenable for this Republican Party.
Nita Richardson of ADP has dropped by to catch up with us this morning. Nita, good morning.
Good morning.
Let's start with jobless claims. 227. Just continued resilience, which is a theme that you keep going back to repeatedly. What underpins that resilience at the moment?
Well, the labor market, if you look at it in a snapshot, is really, really stable. Companies are keeping their workforce. They're not letting them go. That's why we see such low initial jobless claims, and workers are by and large staying put. So the snapshot of the U.S. labor market is solid. The problem is if you look at the labor market in motion, the churn is gone. People are not leaving. Firms are not hiring in mass. And so you don't see the dynamism that has defined not only the labor market, but productivity growth. And if you really want to look for the crack in the labor market, go back to the last measure of labor market productivity. Output per worker was down 1.4% year over year. That's a sign of the drag that's going on right now.
When you see a low churn dynamic like the one you described start to grip the labor market, typically when you look back, how long is that sustained before things break one way or the other?
I don't think we can go back to priors. I mean, if I look at the great financial crisis, for example, the unemployment rate was above 7% for several years. Now, we're not even at the starting point of that great financial crisis. We're at 4.2%. The unemployment rate has been remarkably stable, and I think that's because there's so many demographics that are shaping that rate. Lots of retirees, a slowdown in immigration. There's going to be labor shortages that are persistent. So it's hard to really capture the labor market in one number, harder than it has been in the past.
What do you think about immigration policy? Do you see the unemployment rate actually going down?
don't see that, actually. I actually see those shortages in certain pockets of the labor market. What's interesting about this labor market versus 2022 or 2023 is that there are no superheroes. We could rely on leisure and hospitality to be the stalwart in the labor market, or healthcare more recently. We're not seeing that now. So who's going to save the day and bolster jobs into the future? Well, there's no sector that's doing that. Immigration is actually the lack of the labor supply is likely to keep wages very tight and robust, which is a problem for the Fed, who's looking to bring inflation down.
If there was to be a superhero, though, wouldn't it be AI and the supply chains around that, these data center build-outs?
You know, that is a long-term play. I do think that AI increases what contributes to American exceptionalism, which is productivity growth. And so if AI can make workers more productive, then there is a chance that we grow our way out of some of these problems. But the problem is, it's not just the technology, it's the people. And right now there's a gap between the two. Is the technology hitting the workforce in a way that increases labor productivity? We have yet to see that.
Let's talk about a potential problem. This morning, yields are higher, up by 5 basis points. The very long end of the curve is getting all the attention. The 30-year at the moment at 5.14. We've sustained this expansion. We've been running GDP around 3%. With rates close to where they are now, these are cycle highs. We're through those levels, granted, but between 4 and 5%. We've seen Fed funds between those levels now for a couple of years, and we've sustained the expansion. Is there any reason to believe that this breakout puts the brakes on this economy?
You know, there's so much, as Anne-Marie was saying, there's so much to be determined in this particular bill. We can't think that the levels are sustained at where they are today. There's going to be a lot of movement. And I think it's also the speed of the increase that matters in terms of yields. So it's not just the levels, it's the churn and the volatility in those numbers that will ultimately decide the short term. But longer term, this country is built right now, the economy is based on interest rates that are much lower than where they are now. Yes, housing, mortgage rates were higher in the 1980s, but house prices were a lot lower. And now we live in a world where house prices are very, very high, and you match that with higher interest rates, you're really going to get a cold breeze in the housing market, which trickles into other parts of the economy.
Well, this is the problem the Federal Reserve's got. As you know, Neela, they cut rates by 100 basis points and mortgage rates went up. Yeah. Have they lost control of the long end of the curve, if they ever had control of the long end of the curve?
That's not their sweet spot. That's not where they make those money moves. They make it at the short end of the curve, and maybe at best the 2-year. But really the 10-year, that is reflective of not just the U.S. economy, but the global economy. And if the global economy shrinks away from U.S. debt, not necessarily because of preferences, but a slowdown, then you're likely to see those mortgage rates continue to hold at the levels they are, or even edge higher.
Well, Neela, when it comes to the Fed, they've been talking about the fact that they don't have all the, dotting the I's, crisscrossing the T's, but they have some now. They have a little bit of a blueprint of what's going to happen fiscally in Washington. Do they start talking about that now?
It depends on how much they want to show their hand in terms of whether they increase rates or lower rates. And I still think that's an open question for the Federal Reserve, because as you know, there are a lot of things that are changing in the macro economy. And those changes right now look to be inflationary. And so I think they want to give it a little more time to be certain that the next move is a rate cut before they start contemplating that publicly.
Neela, it's good to see you, as always. A lot to think about. Neela Richardson there of ADP. Also need to think about this rates market and what's happening at the long end of the curve. Yields just off session highs, the 30-year now at 5.13. Ira Jersey of Bloomberg Intelligence is jumping on to weigh in on all of this. Ira, as you know, new cycle highs at the long end of the curve, levels we haven't seen going back to 07. Over the last few years, when we've got to these levels, it's been difficult to sustain them. Either people have stepped in and they've bought, or it's forced corrective action at Treasury. Ira, do you believe these levels can be sustained at the long end of the curve?
Yeah, there is a big buyer base that likes these types of just over 5% levels, but we haven't seen people taking advantage of that the last couple of days. So I do think that at least temporarily we could probably sustain the long end above 30 years. Keep in mind, the last time that we were close to these levels, so the last time we, the cycle highs back in 2023, the yield curve was much, much flatter. So we have to keep in mind that there is different dynamics for both supply and demand for the 30-year and, say, the 10-year. So you have seen a very substantial steepening of the yield curve over the last couple of months, and that just keeps on continuing the last couple of days. Whether it's 10s, 30s, 5s, 30s, 2s, 10s, all of those yield curves are steeper today than they were just a couple of months ago.
And apparently 20s matter too. I've got to get your thoughts on this. Since when did the 20-year auction move markets as much as it did just yesterday?
It never has. I mean, granted, 20s are a relatively new and unloved sector in many respects. And this narrative, by the way, that everyone's saying that the 20-year auction was weak yesterday, it wasn't. It was actually better than February. It was way better than November's auction. So, and those were the last two refunding auctions. So the idea that it was very weak, it was a matte auction. It wasn't great for sure, but it wasn't terrible. And I think that this just shows that the psychology has shifted, particularly in the long end, because maybe of the long-term fiscal risks that remain out there with the new budget deal not being as as contractionary as people thought. They're still going to have very high deficits. I think there is a certain amount of fear out there that there's not going to be any type of good budgets anytime soon, and that means that it's that people are just shying away, particularly from that long end of the curve.
Ira, to your point, the 20 is considered to be the orphan on the yield curve, and you can see it for anyone that brings up the chart. The belly of the curve seems to be the sweet spot for a lot of people in fixed income, which brings me to next week when we get these auctions. 2-year supply at the front end of the curve comes next Tuesday, I believe. On Wednesday, we get 5s, and on Thursday, I believe, we get 7s. Do you anticipate any problems whatsoever when we get issuance across those kind of maturities?
So I think the 7s are going to be the most interesting of those three because, as you mentioned, there is this bid because, especially in the front end, the 2-year would have to almost double in yield in order for you to lose money over the next year. So there are a lot of people who are buying the front end as an alternative to buying money market assets, and particularly those people who think that the Fed's going to cut interest rates sometime over the next 12 months. But the 7s are kind of the spot that's in between the long end and the short end. So I think that's the auction that might have some trouble. That's exactly what happened, by the way, in 2022 when we saw a few weak auctions. It started with the 7-year.
And the 7-year this morning is just about unchanged. Ira, appreciate your time, sir. Ira Jersey of Bloomberg Intelligence stuck right back in the middle of that tension between the front end and the long end. The front end's rallying, yields are lower by 2 basis points on 2s, 3.99. At the long end of the curve, 30s are by 4 or 5 basis points this morning to 5.14. Nisha Patel's with us here in New York now, joining us from Parametric. Nisha, good to see you. It's been too long.
Yes, it has. Good to be here.
The long end of this curve, does it get bought? Can we sustain levels at these kind of levels?
I think we're starting to hit that ceiling, right? You start to hit yields north of 5%, and you take a look at everything that's been priced into the equity market, right? We've seen a very sharp rebound. Equity market is saying, look, everything's good, nothing to worry about. A lot of optimism, I think, in the equity market. I would argue in the bond market, we've almost priced in a lot of what has been feared, right, especially in the debt and deficit side. So I think this is kind of a ceiling where you start seeing buying opportunities. Look, I think for fixed income investors, the biggest thing we've been lacking for many years has been the income aspect. The duration play is another story, right? So going out on the long end, you're taking a duration play, which you can make an argument at this point in time with no slowdown or recession risk in the markets being priced in. I almost think that that's being undervalued, right? Fixed income investors may not be positioned for this slowdown. We had a claims number this morning, came in maybe right in line with expected. But if we start seeing any cracks on the job side, in labor markets, in consumer spending, I don't think we've seen that being priced in the bond market, right? And that's something that I think we're not fully taking into account.
In years gone by, that would be a good argument to anticipate lower yields on the long bond.
Yeah.
But now people are coming on the program suggesting that given the concerns that are dominant at the moment, that if we go into a downturn, you could see, and I don't think it's the base case of the consensus view right now, but you could see yields climb, not fall, because the dominant concern right now is the deficit.
Yes.
How much comfort can you take from the 10-year and out in a downturn?
Yeah, I mean, look, I think also you've had kind of this trifecta of three things happening in a short period of time, which is why you've been seeing kind of long end pricing in a lot of concerns around deficits, right? So Moody's downgrade, you have a tax bill which is coming in nowhere near the amount of cuts that people were expecting or wanted to see. And, you know, you have kind of just further concerns in regards to tariffs and that not coming in anywhere close to the revenue that was originally being generated. So I do think that 10+ year part of the curve, look, you're going to continue to see some volatility, right? Finding natural buyers in that part of the space is going to be very tricky. But I think this is an entry point where you do start to see, again, looking at real yields, you're starting to see very attractive yields in that part of the curve. I think for our fixed income investors with, you know, kind of an income bias, we would even argue stay in the belly of the curve, right? It's all about stepping out of cash, moving out a little bit in the yield curve. And there's, I think, a tremendous opportunity from an income perspective.
Since Trump won the presidency, everyone just kept telling me this tax bill is priced in. So why all the consternation now?
Yeah, I think it's a few things. Up until this morning, last night, we really didn't know what was going to be kind of fully implemented. And we still don't know, right? I mean, this is the House version. There's a lot that's going to be changed. So even early on, again, what I would say is while a lot of these components were known, I think it's a little bit of a confluence with the Moody's downgrade, right? And you have kind of now these reignition of debt and deficit concerns. Keep in mind the economic data has held up fairly well, right? So it's like the bond market's like, look, we're not worried about that for now. So we're going to focus really on the debt and deficit side. So I think you're seeing that now being priced in. And again, there is this worry that this bill, again, does not have enough. And that's basically what the bond market is saying, right? So it's going to be very tricky for the Senate. Look, they don't have to take any of these components, but to really come up with something that is going to satisfy not only bond markets, but overall markets to really suggest that the administration's doing, you know, kind of a significant enough job here. And then again, the tax cuts aspect, that's something that this administration definitely wants to do. It's getting very challenging to come up with the pay-fors on the other end to make up for it.
You mentioned the downgrade from Moody's
Yes.
in the last week. If I go back to the previous downgrade from Fitch, I think that was back in 23. And that landed around the same time we had the quarterly refunding announcement, which spooked this bond market and ultimately forced a degree of corrective action from the Treasury Secretary, then Treasury Secretary Janet Yellen, who tightened up the average maturity and started issuing a ton of T-bills. Do you think we need this time around also corrective action either from Treasury or from Congress in some form, maybe reshaping this tax bill going through Congress right now to put a lid on some of the volatility, some of the moves we're seeing at the long end of the curve?
I think those tools are definitely there, and I think that's a great example. It might be too soon to really come out and say anything needs to be implemented, but I think this is where kind of your Treasury auctions, again, to your point, you're going to have to see a different structure of issuance at debt financing to really help support the long end of the curve. This shot up in yield has happened, I would say, relatively kind of recently in a short period of time. But I think we need to see a little bit more. Again, more economic data. I don't expect anything to happen over the next 2 to 3 months, whether it's from a monetary policy standpoint or even in terms of Treasury Secretary coming in to kind of step in. I think the economic data here is going to be the focus. July 4th time frame is going to be very important. And I think that's, you know, we're all hoping for a quiet summer here, but I think that may not be the case. So, I mean, look, for our clients that, again, have a higher quality kind of typically mandate that are looking at fixed income as a ballast, look, we're suggesting if we haven't been kind of, if you've been underweight fixed income, here's an opportunity to at least step out, lock in some income. And again, this bond market, I think, has become almost too optimistic. We have completely priced out any, I would say, slowdown risk. I hesitate on the word recession, but any risk of slowdown.
Greg Peters of PGIM said that. Jamie Dimon at JP Morgan said that in the last week as well. And Nisha Patel at Parametric just said it right now. Nisha, it's good to see you.
Yes, good to see you too.
You're in good company, that's for sure. We need to talk about this bond market. Look, if I was in the Treasury, and we've not caught up with Secretary Bessent for a number of weeks, but I imagine he'll engage with the media over the weekend at some point again to talk about this. I'd be pointing to what was happening elsewhere as well. What can they do about the BOJ? What can they do about the Japanese government bond market? What can they do about the debt load there, the hot inflation in the UK, the stimulus bonanza that the Germans are about to go on as well?
Well, these conversations likely happened. He is right now at the G7 finance ministers meeting and central bank ministers meeting in Canada. Yesterday, he met with his Japanese counterpart. He met with his German counterpart. So I'm sure these conversations are happening. How much we could report out of them, potentially, that might be a little bit challenging. But these conversations are happening because this is what Neil Dutta said to me yesterday when we were talking about the fiscal package. He's like, you can't just think of this as an idiosyncratic U.S. government issue. This is happening around the world.
Really interesting moves developing in fixed income. Yields up at the long end by 3 basis points. Off session highs, we're back to about 512. How much will that constrain this equity market? At the moment, this equity market is bouncing, so we'll see what the open brings. We're now negative by about 0.2%. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross back over to Yahara. Hey, Yahara.
Hi, John. Recapping the latest economic data, U.S. jobless claims fell last week to 227,000, the lowest level in 4 weeks. The median forecast in Bloomberg's survey of economists called for 230,000 applications. The data adding to signs the job market remains healthy. Meanwhile, President Trump taking to Truth Social this morning to congratulate Speaker Mike Johnson and the Republicans who voted yes for his tax bill. Trump said the bill is arguably the most significant piece of legislation that will ever be signed in the history of our country. The bill narrowly passed the House by a vote of 215 to 214 and now moves to the Senate. And a check on Nike shares, they are higher by 0.7% in the pre-market. The world's largest sportswear company announced it's returning to Amazon's online store for the first time since 2019. The return to Amazon is part of Nike CEO Elliott Hill's push to revive relationships with retail partners. That includes stores as well, like Dick's Sporting Goods and Foot Locker. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the program, we'll set you up for the day ahead and get you the latest from the nation's capital, which is shaking up Wall Street big time at the long end of the yield curve. Live from New York City, you're watching Bloomberg TV.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Over the years, it's been difficult to sustain these levels across the yield curve north of 5% on a 30-year maturity. Typically, investors step back in, or it forces corrective action down in Washington, D.C. It proves to be somewhat self-limiting. This morning, we're just off the highs. Yields now up by a basis point or two, 510 on 30s. We'll see if we can sustain these kind of levels. That's the bond market. In equities, we recover just a little bit, going into the opening about 36 minutes away. Equity futures negative by just 0.1% on the S&P, and the Nasdaq 100 flipping into positive territory in the last couple of moments. Interesting session already. Interesting session as we work our way towards the long weekend. This Thursday into Friday. Your trading diary looks like this week. 9:45 a.m., your next data point, PMI data. Then at 1 p.m., a White House press briefing. Look out for that. Friday, the U.S. Treasury market closing at 2 p.m. Eastern time. Monday, of course, U.S. markets will be closed for Memorial Day. As we look ahead to next week, Wednesday, the big earnings report. Why do we have to wait so long? NVIDIA finally reports earnings next Wednesday, so look out for that. I want to touch base with Washington and head down to Tyler Kendall now, just for a quick beat. Tyler, it's passed the House. For people just tuning in, that one big beautiful bill has advanced to the Senate. Just describe what the next few days, the next several weeks, all the way through to July 4th might look like.
Yeah, hey, John. Well, it's going to be a pretty tough battle when this House text does get over to the Senate. We should say it's Memorial Day. They're all getting out of town. They'll be back on June 2nd to pick this back up. But if there were concerns about deficit spending in the House, wait until we see what ends up happening with the Senate, because they've already raised some pretty big concerns here about some of those saving policies that fiscal hawks push for, like those work requirements when it comes to Medicaid and rolling back clean energy tax credits under the IRA. So we're going to have to see exactly what sort of deals end up shaking out here, as we know that this White House wants to get it done by July 4th. Perhaps lawmakers will have a little bit more buffer room, because the real hard deadline is going to be that X date, which right now is projecting to come in August.
Tyler Kendall, thanks for the word this morning. Looking forward to your reporting through the day. Speaker Johnson with a big smile this morning. He got it done.
Self-imposed deadline, and he was able to land the plane as he promised last night. He thought they were going to be able to do it. A lot of backroom dealings. I want to know what was promised. The fiscal hawks, the House Freedom Caucus last night in the Oval Office with Speaker Johnson and the president. But the Senate's going to rewrite this bill. This is the first chapter.
Let's take a beat. They get the long weekend, you get a long weekend, you're leaving today,
I'm on DC
right?
time.
You go and enjoy yourself. We'll be here with you tomorrow morning with Sebastian Page at T. Rowe Price, Dan Greenhouse of Solace Alternative Asset Management, the Kayak CEO, Steve Hafner, and Nadia Lovell of UBS. Plus, Bramo's back to talk about this bond market. Looking forward to that. From New York City this morning, good morning. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure. And there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
All right, let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
All right, rocky morning for futures, but we're doing absolutely nothing right now. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Bassett. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, a win for 1B3. President Trump's signature tax bill narrowly passes the House after a dramatic all-night session. And words of warning, Jamie Dimon says he cannot rule out the U.S. economy entering a period of stagflation. More from that exclusive interview. And fiber frenzy. AT&T's deal to buy Lumen's consumer business raises the stakes for cable competition. Sonali, what are you watching?
Yeah, and as Matt was talking about, the $5.75 billion AT&T Lumen deal. It will help AT&T reach its goal of putting fiber optic lines in 60 million locations by 2023. You do have shares a little bit soft this morning. Lumen, though, soaring at 2030. I'm sorry, that's when they'll reach those customers. Let's flip up the board here because we do have Lumen CEO joining us in open interest later this hour. Of course, Kate Johnson will tell us where she's headed next. Matt.
Yeah, looking forward to that interview, Sonali. Also, Snowflake's new AI products are seeing strong demand, with the firm raising its full-year revenue forecast. You can see those shares up by almost 10% in the pre-market. It's really all about AI for this market. Well, the upside, Sonali, is all about AI, right?
That's where the upside is, maybe. But right now, to the upside, the bond markets, they are sending a warning to the U.S. government about debt sustainability and the potential impact of the tax bill on the deficit. J.P. Morgan's Jamie Dimon says there are other economic risks to keep in mind as well.
I just think there's a chance that you'll have stagflation. I'm not saying it's going to happen. I don't want the reader to say he's predicting that. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing.
On Capitol Hill, House Republicans passed a new version of President Trump's massive tax and spending bill that includes a higher limit for SALT deductions and faster cuts to Medicaid. Bloomberg Politics reporter Tyler Kendall is in D.C. with the details. Mike Johnson taking that victory lap, but of course it now heads to Senate.
Yeah, hey, Sonali, a pretty big victory lap from House Speaker Mike Johnson, who got it done by his self-imposed Memorial Day timeline. Now, you mentioned it there. There were some pretty big agreements that came together relatively last minute in order to get this over the finish line. That includes lifting the SALT cap from $10,000 to $40,000. That amount then will get phased down for those making more than $500,000. Both the income threshold as well as the cap will increase by 1 percentage point over the next 10 years. The other side of this was also in a bid to try to appeal AT&T, some of those more fiscal conservative members, they're going to speed up Medicaid work requirements going into effect by December of 2026, moving that up from the originally proposed 2029 timeline. They're also going to speed up the phase out of some of those clean energy tax credits under the IRA. Of course, broadly speaking, Shonali, this bill also extends President Trump's 2017 tax cuts and makes good on some of those campaign promises, such as temporarily eliminating taxes on tips and overtime pay. To be sure, not everybody was happy with this vote at the end of the day, but ultimately it was enough to get it done amid some pretty big pressure from this White House and President Trump.
Yeah, no, absolutely. I mean, a lot of people in my district are going to be angry that the SALT cap remains. Remember, it was uncapped for 104 years before President Trump took that deduction away for the most part in 2017. What about the deficit, Tyler? I mean, Chip Roy can't be very happy because this expands the deficit that the Trump administration was supposed to try and reduce.
Right, exactly. But at the end of the day, it seemed that it was enough to get some of these fiscal hawks like Chip Roy ultimately to vote in favor of this bill. And I will say that our reporting indicates that there was perhaps some last-minute deals between the White House and some of these House Freedom Caucus members to work together on potentially some future initiatives, some future work down the line. That's signaling to us that maybe we could see some sort of executive orders. It was interesting to see President Trump float on Truth Social yesterday, re-up this idea of privatizing Freddie Mac and Fannie Mae, which of course has been in the conversation about potentially helping to reduce the deficit there. So we're going to be watching very closely if some of those provisions end up coming out, if they don't make some significant cuts to the deficit spending when it gets over to the Senate side, because we should say at this moment, if there's concerns about deficit spending with this House bill, the Senate's already raised some concerns when it comes to those savings policies, including those Medicaid work requirements, as well as the IRA tax credits.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall in Washington, going to be covering this for months. Bond investors are pushing back against President Trump's tax cut plan and deficit blowout. The 30-year yield topped 5% yesterday in a warning sign to lawmakers over that swelling deficit. Bloomberg's chief correspondent for global macro markets, Liz McCormick, joins us now to explain. And Liz, we had also a pretty difficult auction as a result of this plan.
Yeah, I mean, the 20-year bond auction, which, you know, people kind of say is usually not the favored one, so it's a bit wonky, but people are really focused on how demand is for these auctions. So it didn't go well, like Kathy Jones of Schwab said to me yesterday. And so that just kind of ginned up more fears and sent yields higher. You know, these 5% levels are, you know, kind of causing people to take notice. And, you know, like Tyler mentioned in your earlier spot that, yeah, we got through the House and now people are maybe worried what comes out of the Senate could be worse as far as the outlook for debt and deficit. So the story is not over. And like we talked on Monday, Matt, that the Moody's downgrade, maybe it didn't cause a huge reaction, but it brought this more and more to the forefront, the fiscal situation, which bond investors think is troublesome.
At what point does Congress listen to the bond market? Because, of course, this bill did pass the House regardless of what you saw even just yesterday in the longer end of the curve. You see that extending into today and maybe, as you say, potentially into next week, depending on what the Senate does. But at what point does it matter?
Yeah, it was interesting, Chanel. I talked to an investor and said, you know, he said, is the Washington going to care about this? Maybe not. You know, it may take more pain. I don't know. But I believe in our reporting from D.C., there was a few concessions like Tyler laid out. It still leaves, like Andrew Hohenhorst at Citi was saying, it was a little better than he thought in the end. Deficits are still about 6% of GDP for now with this. But the bond market just is saying this is on an unsustainable path. So I don't know, you know, if there's going to be, like some say, a bigger Liz Truss kind of moment where something changes, but people are less than hopeful that the Senate, it'll come out much better. They think it may be worse, like we said. So I think for now, the bond market, this is going to keep, you know, brewing this fiscal issues. And like Jamie Dimon was saying, if we see inflation pick up, you know, those fundamentals will be a problem with people not thinking the Fed can cut until later. So there's just a lot of uncertainty and concern in the bond market, keeping people away from long-term debt.
Bloomberg's Liz McCormick, thank you so much for joining us. Of course, that 10-year hit above 4.6 just yesterday, and we were watching the 30-year look as high as it had been in more than a decade.
I will say the 10-year actually was at 4.6 early this morning. I was in at like 3 o'clock this morning, and in the early trade, it jumped up there. We just had Chris Waller on Fox News saying that if the Trump tariffs settle around 10%, then the central bank could cut interest rates in the second half of 2025, and that seems to be what's moving markets right now.
And maybe that'll help out the shorter end of the curve, and maybe that'll help out the consumer. We're going to talk about the consumer because on the corporate front, Nike and Amazon shares are rising in the pre-market. The sports retailer is returning to the e-commerce giant's online store after leaving it in 2019. We're going to unpack the decision with Bloomberg Intelligence senior retail analyst Poonam Goyal joining us now.
For both of them, it obviously adds more appeal to the Amazon marketplace now that you can get such a fabulous brand on the platform. But for Nike, it really opens up distribution in a meaningful way. We know when Nike pulled out of wholesale, it hit them significantly where it opened up doors for competitors. So going back to Amazon, where millions and millions of people shop every day, is going to bring more eyeballs to their brands and really help them win back some of that market share that they lost.
So are we going to see prices on their products, though, rise? Because obviously Nike doesn't make any of its shoes in America.
It doesn't, but it makes its shoes largely in Vietnam, and the current pause tariff on Vietnam is 10%. So we heard that Nike will have some price increases, but they're selective. So they're not raising prices on shoes under $100, which means that the low-income consumer who is more strapped for cash isn't going to feel the pinch. When they do increase prices by $5 or $10 on select footwear, I think that's a small amount that the customer who is buying those over $100 shoes could end up willing to pay for. They're not taking up prices on children's, which is also another area where we think, parents would pull back if that was the case. So we think they're doing this strategically, and it shouldn't really curb demand meaningfully or even at all for Nike.
All right, Poonam, thanks very much. Poonam Goyal there of Bloomberg Intelligence talking to us about the Nike-Amazon deal. We'll watch those stocks throughout the day. Some more retail movers, though, on our radar. BJ's maintained its earnings guidance as it expects mild growth throughout the year under current conditions. Investors react positively to that. Ralph Lauren revenue topped estimates, and the polo maker raised its dividend by 10%. Investors like that. And then Urban Outfitters posted net sales that beat estimates, with analysts noting strength in its namesake UO brand. What, 20% the gain on Urban Outfitters?
Pretty incredible, but of the group, it's actually down the most on the year. BJ's is up more than 30% on the year. You would not think by looking at these numbers we're sitting in the middle of a trade war. You do see Williams-Sonoma down, though, more than 5% pre-market after reporting.
It's tough for us.
It is tough for us, but maybe they'll lower prices.
Yeah, maybe we'll get some deals there. All right, coming up, Lumen jumps as AT&T buys its consumer fiber business. We're going to give you details on that next. This is Open Interest.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road.
we're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Let's get now to high interest. Look what's making headlines around the world. BYD sold more electric vehicles in Europe than Tesla for the first time, overtaking the American brand that's long dominated the continent's, well, the global EV market. Sales at China's leading automaker were up 169% from a year earlier. Meanwhile, Tesla's registrations plunged nearly 50%. And Walmart is cutting about 1,500 jobs in its global technology team as it looks to trim costs. A spokeswoman said the changes reflect the company's growth strategies and are not related to tariffs. The downsizing follows a reorganization in February when Walmart cut some jobs and asked employees to relocate to Arkansas and California. The company employs a total of 1.6 million people, making it the largest private employer in the country. And 2 members of the Israeli embassy staff were killed outside the Capitol Jewish Museum in Washington last night by a gunman who chanted "Free Palestine." That subject is now in custody, and Israel is boosting security around its embassies and staff. The attack was condemned as an anti-Semitic hate crime by officials, including President Trump. The shooting victims had planned on getting engaged next week in Jerusalem, according to the U.S.-Israeli ambassador. Shonali?
We're going to turn back to the AT&T and Lumen deal, Matt, because AT&T is agreeing to a deal to buy Lumen's consumer fiber businesses for nearly $6 billion in cash. It is subject to regulatory approval and is expected to close in the first half of next year. Joining us now, Chris Palmieri. He leads Bloomberg's media and entertainment business here, or reporting lines here. Chris, you know, you have a significant jump that we saw when we first reported this deal at the end of March. Of course, this was a Bloomberg scoop now coming to life with the deal announcement. We are seeing some softness in AT&T today. What does AT&T gain ultimately?
Well, if you look at the big picture, we've seen a flurry of deals. We just had Verizon and Frontier, $20 billion. And then another story we broke, Charter and Cox, 2 of the biggest cable companies merging. So a lot of activity in the telecom space. And the reason is, if you're a big U.S. telecom operator, your business is kind of mature. If you're in wireless or you're in internet access, there's not a lot of new markets to tap. And so it's a big market share battle going on. And that's what's behind here. AT&T is making a big push into fiber, offering higher speed internet access in all kinds of new markets it wasn't in before. And at the same time, the cable guys are offering a lot more wireless phone products. So it's a big market share battle.
How much is this driven by AI? I mean, how much is AT&T trying to position itself to be able to deal with that kind of traffic?
Well, one of the rationale for all this is that everyone feels comfortable that there's going to be a lot more demand for data, in particular high-speed data lines like these fiber optic lines that everyone's buying or building. And that's driven largely by the just enormous data needs of artificial intelligence.
Chris, what about for the other side here? This is for Lumen trying to transform their business. I know that when we speak to Kate Johnson a little later, one big question is why not sell it all? I mean, not the whole of Lumen, but at least they kept the copper part of the business here too.
Well, the business side of this is a little less competitive. I don't want to say it's not competitive, but if you think about the scale you need to compete in the U.S. consumer internet or wireless market, it's just huge. And so from a business standpoint, a lot of these services have still been growing, and they can sell all kinds of additional services to business customers that they really can't with consumer. And so that's the business they want to stay in.
Chris, thanks very much. Chris Palmieri there from our Los Angeles bureau. Keep it here on Bloomberg. Lumen CEO Kate Johnson is going to join us in about 30 minutes to discuss this multi-billion-dollar deal. Coming up next, though, Morgan Stanley's Mike Wilson. Is he still buying the dip in U.S. equities? We'll ask him after the break. This is Open Interest.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Earlier this week, Morgan Stanley's Mike Wilson told investors to buy the dip following Moody's downgrade of U.S. credit. Now, Wall Street appeared to listen. The S&P 500 closed in the green on Monday. Mike Wilson, Morgan Stanley's chief U.S. equity strategist and CIO, joins us now. They bought the dip, then they let it go for a few days, really.
If that was a dip, right?
If that was a dip. Define a dip here. What kind of dip would you buy?
I mean, 1% sell-off isn't really a dip worth buying. I would say 5% is a dip, 10% is a correction, 20% is a bear market. That's kind of the way we, talk about it. So we do think a 5% correction or dip is possible based on the move in rates. That's kind of been our view. And quite frankly, we're still stuck in that range that we identified earlier this year, 5,500 to 6,100. So we got closer to the upper end of the range. Now we're going to get a dip. I'd be surprised if we take out the 5,500 unless something really, deteriorates again on the tariff side, okay? And we go through that in our mid-year update. Like a lot of things now have turned the corner from a rate of change standpoint. That's going to make it hard to return to a sub 5,500 price in our view.
Is the tariff the only left tail risk? Because it seems that a blown out deficit with this new tax, this one big beautiful bill, is concerning markets, at least when you look at rates, right?
Well, that's right, and that's exactly why we can't break through to the upside, because there's two things going on the rate side. Number one, you have excess supply. The deficit now is a problem again, potentially for the bond market, but also the Fed's on hold, right? The Fed has been a bit, overly focused on inflation, and so you don't have any rate cuts in the near term, and you now have this supply risk and the fiscal deficit blowing out. So that took rates back about 4.5%. That's always been our level where multiples come in. That's a 5% move historically. That's not a 10%, 20% move in isolation. Now, if that leads to something else where we have another growth scare, for example, because rates are higher and all of a sudden recession risk comes back on the table, that's a whole different ball game. That's not our view.
Okay, so for long end rates, at the very least, at what point do they become a bigger problem for the equity market?
Yeah, I think 5% is where it becomes a real headwind for
10-year.
Yeah, for consumer, like everything's priced off the 10-year, right? So then all of a sudden you're looking at, oh my goodness, we have now recession risk potentially is back on the table. But in that instance, just think about it, the Fed will act then, right? I mean, so we have this sort of, it's going to be back and forth like this for the next 3 to 6 months. The way you got to think about the first half of the year, most people came in very bullish. We came in more, not that bullish about the first half because of the sequencing of policy. But that policy now has flipped to a more pro-growth sort of stretch. And that's what the market's going to start to think about. That's why it's going to be really hard to take out 5,500.
That is, by the way, my question of the day, Shonali. Like, at what level do yields really start to put pressure on stocks? And you're saying 5%. Goldman Sachs was out this morning saying 5% as well. Chris Waller was speaking, I think he was on Fox this morning. Are you looking at me funny?
Yeah, I forget exactly where he was as well. I just saw the headlines.
Okay, but he was saying, like, if tariffs stay at 10%, the Fed is good to go in terms of cuts in the second half of this year. What are you expecting from the Fed in terms of stimulus? Because that is important to the stock market at the end of the day.
I think it's critical. It's another factor, though, the rate of change is going to turn more positive. Don't forget that, the big rally last fall was driven by, a lot of it was driven by Fed cutting into an economy that was fine. And then they stopped in December. That was really the beginning of the correction that we saw, not tariffs, okay? So, yeah, I think that the Fed will be either communicating that they're turning more dovish or they'll actually be cutting. Our official House view is no cuts this year, but then they have 7 cuts for next year with no recession.
Yeah.
So that's pretty bullish. So, I mean, if we get 7 cuts with no recession next year, stocks are not going down.
A little more on the tax bill here, too, for a moment here, because as it makes its way to the Senate, more fighting, right? I mean, we're not going to necessarily see the same bill clear Senate. We're going to at least
It's true.
see...
Maybe the Senate says no more SALT cap,
What happens from here? How much more uncertainty, and where does that take markets as they hash this out?
There's 2 ways to think about this. So number one, I mean, obviously, I would like to see the deficit cut. I think most Americans would like to see that. That's not happening in the near term. I still hold out hope for DOGE having impact next year and the year beyond. I think there's still initiative there. It's going to take longer. However, from an equity market standpoint, okay, do you want fiscal contraction or do you want fiscal expansion? So as long as rates don't completely blow out and the Fed and Treasury can keep a lid on that, we're kind of back to where we've been the last couple of years. A little aggressive spending that helps growth and rates stay under control. I think the big risk is that it prevents the Fed from actually, doing something on cuts or helping out with the balance sheet.
I think that's a really important point, by the way, that we all kind of theoretically, we want the deficit to be reduced. We want government spending to come down because we're fiscal conservatives, right? But from an equity market standpoint,
likes that fiscal sugar.
Of course, and from a growth perspective also, you need that spending. If you start cutting government spending and firing federal employees, it's going to take a toll on growth, it may. Mike Wilson, you're going to stay with us. We are really appreciative that we get you for a couple of blocks here, so he's going to stay with us through the open. That is coming up next. Take a look at futures. We're just about to see the bell ring at the New York Stock Exchange and on the NASDAQ. This is Bloomberg.
we're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points.